Welcome back to the stream. We are playing Undermine. We are listening to Bitcoin podcasts. We are together here today on this beautiful August 13th. Bitcoin ripping to 121,000. Well, 122,000 came back to 121. And it's way too hot outside to be outside. That's how I feel. Record highs in Michigan the last couple of days. Not super high, but you know, enough to be to be too much. So we're going in. We're gonna check it out. We're gonna have some fun, and yeah, we're gonna farm some achievements here in the Undermine. Have a good time with it. And maybe we'll even start a new file. Not sure. But we're just going to enjoy the podcasts and have a good time with it. Without further ado, I'm going to jump back right into the podcast I was on. So hopefully it's equalized correctly. You can hear me and the podcast. Let's go.
I'm going to continue to hold. And then every net new dollar that I'm going to deploy, maybe it used to be 100 cents on the dollar that went into my investment portfolio went to Bitcoin. Maybe now it'll be 80 cents. 20 cents I'm going to go put in cash or in fixed income or something that has some other purpose than let me buy the asset that's going to go up the most, but whatever. I just don't think there's a replacement for Bitcoin.
Yep. Okay, let's end on this. Bitcoin will now be included in retirement accounts, it looks like. That's going to access a lot of capital. The reason I bring it up is actually for a different reason. Treasuries are in people's accounts, retirement accounts, and that's a big portion of their retirement accounts. People say Bitcoin is risky. I know you have a little bit of a contrarian view that treasuries are just as risky as Bitcoin, more risky than Bitcoin. Explain your thinking there.
Well, math. If you look at the performance,
you mind elaborating a little bit?
The last 5 years, if you look at Treasury, I mean, go look at TLT. TLT is iShares 20+ year Treasury bond fund, right? ETF. It's down 50% in the last 5 years. Bitcoin is up like 12x in the same time period. So which one did you want to own, right? Now, why is that? Well, one has a structural tailwind, Bitcoin, and one has a structural headwind, Treasuries. And so if you go and you look right now on Treasuries, depending on which Treasury, the date, all this kind of stuff, 4.5%, right? Okay. Let's say pay no taxes on that 4.5%. Okay. Do you know what the depreciation of the US dollar has been annually since 1971?
I do not.
Over 4%. So this 2% Fed target inflation rate, lie. The dollar, over the last 50-something years, has depreciated more than 4% a year, every year, since 1971.
But that's got to be because of the recent depreciation over the last 5 years has accelerated so much.
Some of it, but still, it was depreciating at more than 2% before that. So if you look at your real rate of return on the yield of the Treasury, you're lucky if it's positive. It's probably break even, right? Okay. Then what happens to the actual asset itself? Well, that's down only because you're continuing to see people dump treasuries, right? Some of the biggest buyers. Now, there are some replacement stablecoins, etc., right? But there's a problem. And so if you are buying an asset that is essentially guaranteed to lose money on a real return basis standpoint, isn't that risky? We're not talking about an attractive return. The critics will literally, they're going to hear that and they will argue with me. It's not a negative real rate of return. It's flat to slightly positive. Okay, let's say that you're right. You're not, but let's say you're right. Do you hear what you're saying? You're arguing with me over whether it's actually a negative rate of return or if it's a 0.5% positive return. Like, take that whole argument, throw it in the trash, right? It's risky. And so it goes back to who is claiming something is safe. It's the people whose job is usually don't get fired. Again, they have a fiduciary responsibility, all this stuff, right? So like, I don't blame the people. It's a system that they operate within. Show me the incentive, I'll show you the outcome. I think that having the old 60-40 portfolio is highly more risk than people will explain. Because 40% of your portfolio are usually in assets that are guaranteed to lose value over time. So I think that there's a modern 60-40 portfolio. 60% stocks, 40% Bitcoin. Drop the bonds, buy the Bitcoin. And people, oh, this is crazy, this Luddite Bitcoin, or whatever. You ever heard of Rick Edelman?
Yeah.
Rick Edelman, Hall of Fame personal financial advisor. That is true. They have a Hall of Fame personal financial advisor. Rick Edelman's right in there. He says, now, the most aggressive people exposure to crypto, 40%. Okay, well, if you're a young person, you're supposed to be aggressive. If you're 70, don't be as aggressive, right? But his non-aggressive, I think his like most conservative is 10%. Take it from me, take it from the guy in the Hall of Fame, right? I don't know what you gotta do to get in the Hall of Fame, but he's built pretty good business, pretty smart guy, right? So if he, as somebody who is regularly recognized for seeing into the future, for understanding technology, for seeing around the corner, is saying 10 to 40% exposure to, he says crypto, I say Bitcoin, right? 10 to 40%. Why are people still saying 40% bonds, 60% stocks? So retirement accounts, you know, there's this great saying that I've seen people say online, which is Bitcoin is my retirement savings, or Bitcoin is my retirement plan. And one Bitcoin, I don't know. If people get to one Bitcoin, what do you think is going to be worth more in their future? Their 401k, their IRA, you know, with traditional assets, or the one Bitcoin? I don't know. I'll tell you what I would bet on, though. And so a lot of people are starting to say, well, guess what? Now I can buy Bitcoin in my 401k, right? Or I can buy the ETFs or whatever. Like, I think that's where you're seeing this is there's just a lot of people who say, the productivity of stocks may not be what we thought it was. Ooh, wait, what? Buffett, what? We want to talk about him? He just stepped down, L. Most underperformance of the S&P 500 since he stepped down in Berkshire's history. Why? Remember what I used to say? Berkshire Hathaway was the boomer meme stock, and it got exposed. Everyone was telling me how that was a crazy thing to say. People yelling and screaming at me. Warren Buffett stepped down, and the stock cratered. The assets are the same. What happened? They were trading at a premium because Buffett was overseeing them. When he stepped down, the stock went down. That is the Buffett mean. That is the market value of the Buffett mean.
The premium. The Buffett
Correct.
premium.
So you call it a premium, call it whatever. Now, if you go and you take a look at gold, for the last 25 years, gold has outperformed the S&P. For the last 10 years, gold has outperformed the S&P. It's about equal over 10 years. The whole thing of the stock market is buy productive assets, don't buy non-productive assets. How's gold beating you for 25 years? The world's changing, my friend. I think people are waking up. They're starting to see a lot of data. My guess is Bitcoin's going to keep winning.
Awesome. All right, thank you.
Thanks, guys. Talk next week.
Wow. Yeah, I'm gonna put the next one on. Yeah, the information is just great. Let's see what Kathy Wood has to say.
We're becoming very surprised at how quickly the uptake of stablecoins is. So if we had to modify anything in that $1.5 million forecast, you'd probably see and you can see on a table in Big Ideas 2025 how we build up the bull case. We'd probably take a little bit from the emerging market part of that stack. I think we can safely say that our bull case is well over $1 million in 5 years.
Kathy Wood, welcome to CoinDesk Spotlight.
Thank you, Jen. I'm so happy to be here.
Well, we are so happy to have you. And here's where I want to start the conversation. If you think and can jog your memory, what's your earliest memory of markets, financial systems, and innovation really mattering to you?
Oh, goodness. You know, in college, I didn't know what I wanted to do. So I tried everything. I tried engineering and education, geology, astronomy, physics. I just was...
You really touched everything.
Oh my gosh, I did. And one of the reasons I did not take an economics class, probably, truth be told, is my father really wanted me to take an economics class. And so I waited until it was the last semester or trimester at UCLA of my sophomore year. Took economics, fell in love with it, realized at UCLA that I wasn't going to be able to take more business classes because they just had a graduate business. Transferred to USC, met Art Laffer, maybe this is TMI, but whatever, met Art Laffer, who is a famous economist, Laffer curve, who introduced me to Capital Group because he saw how passionate I was about economics. And
All right, let's speed it
Capital
up.
Group was the largest and most, I would say, probably still is, most prestigious investment firm in Los Angeles. And I walked in, I knew nothing about, how the financial world worked. But there I got the sense of, yes, here's where economics fit. Here's where this exciting market activity is. And, I think I fell in love with the investment world almost as soon as I walked in because I said, wait a minute. I and we are paid to learn. The world is our oyster. This is amazing. We get to figure out how the world's going to work. And I didn't have a doubt in my mind. I was only 20 years old when I started at Capital. I didn't have a doubt in my mind that I would be in the business for the rest of my life.
What sparked that passion in economics? I mean, you tried everything. You were rebelling against your dad a little bit.
Was it real? We're so close, and we were so close. But it's just, kids do that. Teenagers do that kind of thing. What sparked it? I think Art Laffer has an unbelievable style of teaching. And when I transferred over to USC, he used to start the class off with a joke, kind of lure us all in, and then put whatever the topic of the day was going to be into context in the real world. Like, why are we doing this? And then, we got more into the theory, and by the end of the class, the board was full of equations. So he lured us in a very interesting way, and he also exposed us to the different ways of thinking about the world from an economic point of view. So Keynesian theory is associated with Harvard, and monetarism is associated with the University of Chicago. He was trying to plant a supply-side school and more of an Austrian school at USC. But he wanted us to understand the differences among the various theoretical frameworks, which I loved because when I got into the business, I saw everyone was a Keynesian. Everyone. There were a few monetarists. They were considered rebels at the time. Now, this is in the late 70s, right? But Keynes, monetarist, and then I was able to watch the world move towards a supply-side view under President Reagan. And thanks to my education, had a really good understanding that we were about to experience the most amazing stock market, really in history, I would say, in the 80s and 90s. So I think it was trying to understand why people in the business thought the way they did, and I did understand that. Of course, Art had a point of view about how incorrect some of those ways of thinking about the world were, and I was armed with that. I couldn't say very much about Art Laffer when I started in the business or when I moved to New York, which was in the early 80s, because supply side economics is one of the primary tenets, or the Laffer curve, is that if you cut taxes when tax rates are too high, you'll get more revenue. If you cut tax rates, you'll get more revenue. If you raise tax rates when tax rates are already too high and people are finding ways around taxes, you will lose revenue. And it didn't seem like it was working when we were in the recession in the early 80s, because the Fed had taken interest rates. You think interest rates are high now? We ended up with interest rates at 15% plus, mortgage rates at 20% plus in the early 80s. And of course, that drove the economy into a recession. So it wasn't until a few years after I got to New York that I really could show my Art Laffer stripes in a big way. Of course, Jennison Associates, where I was at the time and where I was for 18 years, they knew, because we would have Art Laffer in all the time to reinforce the point of view.
Midnight is introducing a novel approach to token distribution. The Midnight Glacier Drop is the first in a multi-phase distribution of the Night token, aimed at empowering a broad, diverse community to secure the future of the Midnight Network. Holders of ADA, BTC, ETH, SOL, XRP, BNB,
Well, I mean, just hearing about your experiences and the way you moved through them, I'd love to just get your thoughts on where we are today. I know that the day that this is being recorded, the Fed in the U.S. is deciding to keep rates steady. I want to hear your perspective on where you think we're heading with rates.
Well, I think it was interesting in the Fed vote today, there were 2 dissents, and we have not had 2 dissents since 1993. And I remember those because I was in the business back then as well. And I think that's very important symbolically, because Chairman Powell has wanted unanimity. And so now we've had a break. And part of it is because Chairman Powell's term is up in May of next year, and maybe the 2 governors dissenting want a shot at that position. You never know. But maybe it is because the 2 governors, and I haven't gone through all of the notes yet, the 2 governors are seeing evidence of housing relapsing here, and prices in many areas not responding to tariff increases, and seeing that, well, wait a minute, maybe the surprise here in the next 6 months is going to be much lower inflation. And we've had a few employment reports that they have something for everyone, some strength, some weakness. But I think what's beginning to concern a lot of people is that the unemployment rate for new college graduates is going up. And that's because entry-level positions are being subsumed in many cases by automation, especially AI. And so I think they're looking at this as a potential concern out there. We have been saying for quite some time that the economy has been in a rolling recession. When the Fed jacked rates up 22-fold in little more than a year's time, one sector after another began to give way, starting with housing. Housing, by many measures, is down 35% still from the peak, and we're seeing some metrics take another step function down. So I think that has some people concerned. I think the housing inflation numbers are going to come down. They're already the monthly numbers that we get from various sources are showing declines. Year over year, they're not declining, except for maybe median existing home sales. But we do think that one of the solutions to the affordability crisis, if sellers really want their homes to move, they're going to cut their prices. And because that is if interest rates don't come down. And if they do cut prices, then the big surprise in the latter part of this year is how low inflation is going to go. And there's a big lag between the time home prices fall and they get into the statistics and leave the statistics as well. So this is going to be with us for quite some time. So I think we've been saying we believe that thanks to certainty now, more certainty about tariffs, tax policy, government spending, and regulation or deregulation, that we're getting ready to move from this rolling recession into a much stronger than expected recovery in the next, I'll say 6 to 9 months. It will become obvious. With productivity, one of the biggest surprises, it's already strong given the slow growth rates in the economy. I think year over year it's still up above 2%, but we think it's going much higher thanks to all of the technologies around which we have centered our research. So robotics, energy storage, AI, very importantly, blockchain technology, obviously important here, and what we call multi-omic sequencing in the life science space. All of those innovations are incredibly deflationary. And the best example probably is AI. AI training costs are dropping 75% per year. AI inference costs, so the cost to get an answer as we're typing into ChatGPT or Grok, my preferred right now is Grok, those costs are dropping anywhere from 85 to, in China, we've gotten a statistic, 98% per year. So when you cut the cost of something, you get a lot more of it. So we think this is good deflation. This is not deflation like 08, 09. That was very bad deflation. This is good deflation for those companies that are on the forefront of these new technologies. It might be bad deflation for companies that are going to be disrupted. And if they're being disrupted, they'll be forced into cutting prices as well. So we think we're going into a much more deflationary world than I think many economists and strategists would suggest.
Talk to me about that 6 to 9 month outlook. Where does crypto fall into your vision for a stronger next 6 to 9 months?
the regulatory environment is very important here. We've gone from a hostile regulatory regime under Gensler at the SEC to a very, very friendly regime now, with legislation guiding regulators instead of regulation through enforcement, which was forcing innovation off U.S. shores to other countries. And now that's changing aggressively, especially appointing David Sachs, the czar for both crypto and AI, and this concept of agentic AI coming into view, where we will have our AI do all the walking and working and talking for us, up to a point, right? Because of agentic AI, and we need smart contracts because these agentic AI, our AI agents or assistants are going to be interacting with sites, maybe like CoinDesk, that where we'll need to pay some money for something, one thing or another, and these are going to be automated smart contracts. Well, agentic AI is going to make that happen. So this is the convergence of AI and blockchain technology. But before that, what we're also seeing is a revolution in financial services. Thanks to the green light from regulators, more financial services companies are moving into the blockchain world because they realize it's much lower cost. So as I explain to our clients what's going on here, I like to back up because I remember this time very well. In the early 90s, late 80s, early 90s, when developers were first working on the internet, there was no idea that financial services or commerce would take place on the internet. And therefore, there was no payments layer. Now, thanks to blockchain technology, we have the payments layer. Over the last 30, 40 years, because we didn't have the payments layer, we needed to, and because financial services and commerce did migrate onto the internet in a very big way, the traditional world had to mitigate the risk of putting credit cards online and trying to use traditional financial tools in this internet world. And all of the intermediaries involved have been taking anywhere from 2 to 3.5% out of each transaction paid for mitigating the risk. We can probably drop that, and that's a tax on the system, right? We can drop that tax from 3.5%. These are US numbers. In Nigeria, the numbers would be 20% or more, right? Drop that tax from 3.5% to maybe 1%. And the financial services world is huge. We think it's going to be a $250 trillion assets under management world in 5 years. So if you're talking about those kinds of numbers, taking 2 to 2.5% out of, or lowering the tax by 2 to 2.5% will lower the friction in the market and increase the efficiency. So that's the cost dynamic, and I gave you the productivity dynamic around agentic AI, smart contracts, API to API transactions, including very small transactions.
I know you've made, ARK has made a bet on Tom Lee's BitMine. Of course, I'm asking one of the largest ETH treasuries right now. I mean, unpack that a little bit more for me. Is that related to what you were just telling me about agentic AI and smart contracts? Do you see Ethereum as being the foundational layer to enabling a productive agentic AI world?
Yes, we have been watching carefully who is signing on to what protocol as they begin to develop their digital asset strategies. So, well, first we saw Coinbase, for its layer 2 base, chose Ethereum. More recently, we saw Robinhood, for the layer 2 that it is evolving, also building on top of Ethereum. We had a thesis that Ethereum was going to be the institutional protocol. I know that Solana was doing much better. Solana had a massive run relative to Ether. And so many people were challenging that notion, and yet we're seeing the votes being placed. And it makes sense. Ethereum, while it might be higher cost and a little slower, it's more decentralized and therefore more secure. Solana, we think, is probably going to be the winner in more consumer-facing applications. And it was very, very difficult for us to gain a position in our ETFs with good exposure to Ether. There are all kinds of problems when 40 Act funds buy another fund, another ETF to gain exposure. There are tax issues. There are fee issues, fees upon fee issues. There's something called, and this is a tax issue, bad income. If the profits associated with something generating bad income, bad doesn't mean evil at all. It just means it's a tax term. If those profits, gross profits, this is gross, there's no netting here. If those gross profits are more than 10% of the total profits generated in a year of a fund, the entire fund can be shut down. The tax benefit, you'll basically you'll lose a lot of tax benefits, and you'll be subjecting the fund to a great number of fines, if not actual shutting down. So we can't take those risks. And as you can tell, I'm not deep into tax law, and I'm not going to be able to explain exactly who, what, when, where, why, and how. I just listen to our trading team, our compliance team, our finance team, and I say, okay, I can't go there. It's just I can't do it. So this is the first time we've been able to gain a solid position in Ether. And sure, it comes at a premium, but what's different from Bitcoin treasuries, like MicroStrategy, now Strategy, is there's just more utility that these Ether treasuries can offer. Staking being one of the most important ones. The ETFs, at least not yet, do not. The Ether ETFs are not allowed to stake. So, and yes, I think as you know, we're the cornerstone investor in Circle. So we've been watching the stablecoin movement, which is exploding, and of course, again, most of that is happening on Ethereum.
has it changed your perspective on Bitcoin at all? I know that your outlook there is a $1.5 million Bitcoin by 2030. Has that changed at all?
So when people ask me what is the biggest surprise in the last 10 years, so we started ARC in 2014. We wrote our first Bitcoin blog back then. 2015, we wrote our first white paper on Bitcoin. And we thought that Bitcoin in emerging markets would serve the role that stablecoins now are serving. And Tether is just an unbelievable story that way. I just learned from one of the founders of Tether, Paolo, that they had no idea that Tether would become an important source of dollar exposure to emerging markets until COVID, when the children of in families in emerging markets would go to their parents and say, you don't have to go into the black market today to buy dollars. We can do this on the internet. And that's how it really spread, which is fascinating, isn't it? We thought Bitcoin would serve that role because we didn't know about stablecoins. And even very recently, I think we're becoming very surprised at how quickly the uptake of stablecoins is. So if we had to modify anything in that $1.5 million forecast, you'd probably see and you can see on a table in Big Ideas 2025, how we build up the bull case. We'd probably take a little bit from the emerging market part of that stack. But I think the much bigger force right now is it's the gateway into digital assets for institutional. It's a new asset class. That and the really substitute for gold as a store of value, another use case. Those are the two biggest, and those we have not changed at all our opinion on. So I think we can safely say that our bull case is well over $1 million in 5 years.
Talk to me a little bit about, I mean, obviously Bitcoin, it sounds like with all the innovation that's happening in the digital asset space, you're starting to look at things outside of Bitcoin, which may have gone to the over $1 million by 2030 instead of the $1.5 million by 2030. What are, let's say, the top protocols or projects you're watching in crypto right now?
Okay, well, again, because we're primarily in the public markets, and because I think one of our roles, just like CoinDesk's, one of CoinDesk's role, is to really educate. So we are watching our clients and guiding them carefully into the ecosystem. Bitcoin, Ether. We do have private funds, which had a very heavy weighting in Solana relative to ETH until recently. And we made a very good move at a good time as Ether started to outpace Solana. So those are the big three for us. And we're watching layer twos, of course, as well. And I think you'll see us, as we're trying to educate our primary client base, go more deeply into the big three, talking in terms that financial analysts and investors will understand. Looking at returns relative to risk, calculating the Sharpe ratio, the Sortino ratio, and so forth. So I think that's what we're really doing right now in terms of from an education point of view. That paper is in process. And the other thing we're going to do, like we have done with Bitcoin, so we put out something called Bitcoin Monthly. It's probably going to be Bitcoin bi-monthly, and we're going to layer into the alternative months, Ether, Solana, and then the longer tail. So and what this does is analyze on-chain or look at and evaluate on-chain analytics, as again, we educate our investor base about the kinds of signaling properties that these protocols have that we don't have in equities or bonds, because the transparency just isn't there the way it is in blockchain technology. So we'll do ETH, Solana, and others as time goes on, and as they begin to show themselves as interesting, especially to institutional investors.
You did your, I guess, top three crypto ecosystems there. When it comes to crypto equities, do you have a top three?
Well, you can see in our flagship, which is ARKK, in our fintech, ARKF, and I think this is also true in ARKW, which is next generation internet, includes both crypto and AI, so that agentic AI theme. The two in the top 10, there actually are three in the top 10 of certainly the F and K: Coinbase, Circle, and Robinhood. Robinhood is not a pure play, but as we've watched, and I'm going to say about 3 years ago, our questioning when we had our quarterly calls with Robinhood was all around crypto. Your client base wants it. Where are you? Where are you? Are you building out your infrastructure? And at a point, we pulled away because they pulled away. And of course, now they're at full throttle. If you saw their analyst day and the debut of some of their crypto offerings, I think they're playing to win big.
So no MicroStrategy in that top three?
Well, no, because as I said before, with MicroStrategy, yes, that is a bet on Bitcoin. That's obviously the biggest asset in the space. We feel certainly that Coinbase is is powered importantly by Bitcoin, because where Bitcoin goes, others follow. So we felt that we had a good broad-based holding there. And as I said, Bitmine Immersions is not in the top 10, but we do think it's important now that Ether is showing up as an institutional preference, that it's important for us to be there.
Kathy, I really want to get your perspective here, because you've really made a career on betting on the future and your ability to see into the future and make big bets on technologies like that we've discussed that many are just really trying to understand where they are going to sit in the world. And when it comes to Bitcoin, there's this narrative that quantum computing may threaten Bitcoin security. And now that I have you here in front of me, I'm really curious as to your perspective there. Do you think that quantum computing could be a threat to the Bitcoin ecosystem?
So of course we think about this a lot. And in fact, we have our former director of research, we bumped up to chief futurist, because these kind of existential questions are so important. And he's he and our team, especially our crypto team, David Puel, you may know him from a number of metrics in the Bitcoin on-chain analytics world are named after David. He created them. So he's very interested in this question as well. So Brett, our chief futurist, and David have been evaluating the breakthroughs that we're hearing about. And there are breakthroughs, but they are small steps to, something that could become explosive. When do we think that will happen? Brett truly believes it won't happen until the late 30s or 40s, if it's going to happen. And one of the reasons is because the progress in AI today is so rapid, so much more rapid than I think even we expected. And we've been watching this since we founded the firm and before, that some of what many people were looking at quantum to accomplish, AI is going to be able to accomplish. And I mentioned how quickly the costs are falling, but the speed at which AI is evolving technologically and not reaching sort of an asymptote in terms of performance, it just keeps going up the more compute power we throw at it. I think that's the more important theme right now and will forestall a lot of capital moving into the quantum world. We want to see how far we can take AI.
You mentioned these existential questions that you and your colleagues kind of ponder while you're putting together your theses. What are some of those existential questions that keep you up at night?
Well, I'll tell you what was keeping us up at night. It was just the horrible regulatory trajectory we were on in the last 4 years. It was, we were beginning seriously to look offshore for more and more, to source more ideas, because we thought, especially in the blockchain space, because the innovation in the US was being absolutely stifled. And when you think about what blockchain technology is, it truly is the next generation of the internet. You see how the internet led, or because of the internet, the US has led the technology revolution. We were going to be dealing ourselves out of the next generation of that revolution, which is going to be bigger. So that, from a US point of view, and from an investment point of view, the rest of the world is a lot more fragmented in many ways, certainly going to Europe. Sure, there's the European Union, and then you've got all of these pockets of other regulation, and you've got geopolitical risks elsewhere. So I think that was quite a concern, and we were very vocal. I remember saying, I think it might have been on a broadcast, but it may have been on a webinar like this. While he was in office, I remember saying that Chairman Gensler was a menace to innovation. And then I got off of whatever that was and said, whoops, we are regulated by the SEC. I wonder if they could come back at us because of that, because there was a lot of vindictive behavior as well. So we wanted to make a stand, and we needed to make a stand, because this was so vitally important to us and to, technology companies in the US, and yet there were risks associated with it. So when I say existential, I mean business risks.
Did you get any? Did the SEC say anything to you about that, or did you get any flack for that?
No, I didn't, and we didn't. I will say, like all investment firms, the SEC reviews us, does examine us, and I think because of what we do and how we do it, meaning we were the first to give away our research on social media, to post our trades every day, to be out there talking about our portfolios. And we can talk about our portfolios because we disclose them at the end of every day, whereas mutual funds don't. So all of this was considered very risky. Very few investment companies wanted to go there because they did not want the SEC examining them for those reasons, among others. And we knew we would be examined, and we knew we had to be airtight. And I think, our chief compliance officer, he spent 4 years at the SEC as an examiner, and we took it that seriously. I think the SEC, if I might say so, I don't know for sure, because they never tell you. You never know when an exam, if it's ended, if everything's okay. They don't give you a letter saying that. If you don't hear back from them, great. Well, I think that we've gone through enough of exams or mini exams that they know that we know we have to be holier than thou from a compliance point of view.
Talk to me about the importance of sharing as much as you do on social media and sharing your trades, making that information public and accessible in a way that many of your competing firms do not. Why is that so important to you and at the center of what you do?
After 0809, we were watching trends in the financial markets. And I remember at one of our brainstorms at my last firm, one of the trends we were observing was mutual funds losing share to ETFs. And I wanted to know what an ETF was, because they were only used in the passive world, not in the active management world. And we're active investors, we trade every day, whereas passive rebalances maybe once a quarter or twice a year. And when I learned what it was, I said, well, why can't we put an active fund inside an ETF wrapper? And I volunteered to do that at my last company because they got exemptive relief to do just that. And I realized two things. One, this was going to be disruptive to the mutual fund world because the fees in the ETF world are much lower when you count all of them up. There are a lot of hidden fees in mutual funds, whereas ETFs are just much more transparent in every which way. So I think the reason ETFs took off and the reason we have done very well is we were responding to the market's demand for transparency. They needed to be on the journey with the manager, because they had lost a lot of trust in the financial markets in 0809. And we understood that. And we also wanted to do something that other asset managers weren't doing. Many were becoming much more benchmark sensitive. If they weren't going passive, they were going benchmark sensitive, which means they all started looking alike. You look at all the large cap growth managers, no matter who they are, they're probably going to have a lot of the Mag 6 right at the top. We do not. We're a diversified exposure to disruptive innovation. But so what we wanted to do was say, we're not doing that. we're trying to give you exposure to the way the world is going to work. And some of these very successful companies, they helped build the world as we know it. If there's all this disruptive innovation taking place, technologically enabled, some of them are going to be disrupted. Some will be able to adapt, some will be, but we will go to the pure play disruptors for our largest positions. And so that's how we've blazed a trail. It was not a popular strategy, I would say for about 3 years, 21, 22, 23, and part of 24, because the market was a bull market, but it was concentrating towards just a few stocks, especially the Mag 6. And we were characterizing that as, you might call it a bull market, but it's not a healthy bull market. A healthy bull market broadens out and benefits many other companies. That's what's happening this year. So your original question is, why did we decide to do it this way? Demand for transparency. We wanted to bring our clients along with us for the journey. We had no idea during 2020 how that would blow up, because everyone was at home and they didn't have much to do other than maybe shop online and invest online, right? And here we were giving research away, we were posting our trades, and there were YouTube videos about our trades, about why we were trading stocks. We had no idea about these videos all around the world, especially in Asia. So we grew a global brand because we were willing to do something that helped people. And I think our openness, especially during COVID, I remember in March and early April of 20, we developed a point of view, and as I just described, my background is economics, and I feel it's really important to have a point of view. It may not always be right, but you have to have a point of view, and be open-minded. So during COVID, I was just doing, economic models in my mind and on paper saying, wait a minute, massive monetary stimulus, massive fiscal stimulus, everyone's at home, their savings rate is exploding. I think the saving rate got up to 27%. Now it's around 4 or 5%. And I said, it seems like this is a recipe for a boom. And supply chain problems, because we have this virus going. And that's exactly what happened. It caused a lot of problems, a lot of volatility, a lot of consternation. The Fed taking rates up the way it did really, really was very difficult for any companies with this innovation mindset, particularly if it didn't involve the Mag 6. It's not like the Mag 6 aren't going to participate. They're just not pure plays anymore.
We're running low on time, but I have 2 more questions I want to get to you. The one is back to those existential ones. We were talking a lot about AI. You think a lot about how AI is going to develop now and into the future. Do you ever think about how AI might outperform ARC or may outinvest ARC? Is that a future that you think about and that you plan for?
So I'll answer that question in a couple of ways. I think the low-hanging fruit for AI is in the passive/benchmark sensitive place. And that's where many investors moved as the Mag 6 seemed to be the only thing working, right? And so I would be more concerned about benchmark sensitive strategy or quant strategies. Quants using factor analysis, slicing and dicing. It's interesting and I don't know how quant oriented your user base is, but when quants look at our strategy, they're unable to define in terms of the various factors factors they have used as categories. So growth, quality, which typically means lots of cash and cash flow, volatility, profitability, different factors. When they get to our strategy, there's a huge percentage in what's called residual. We can't explain this. That the reason they can't is because the future is not going to look like the past, and we're invested in the future. And so quant is all about the past. So that's a good thing. So I think quant-based strategies will be overtaken by AI. They'll be completely commoditized. They're heading that way anyway. Our strategy demands original research, and we give our research away. We can feed it to OpenAI, Grok, the large language models, and there's a certain pattern recognition they will be able to discern. But that will help us and take us to the next level. We won't have to spend as much time on that anymore.
Nice.
And I'll just give you the centerpiece of that is Wright's law. So Wright's law is a relative of Moore's law. You've heard of Moore's law in the semiconductor space, so twice the power at the same cost every 18 months to 2 years. Moore's law is a function of time. Wright's law is a function of units, the number of units produced. The more the units are produced, the more costs fall. And so getting that cost decline right, which we use Wright's law to do, is really important. I think AI will really help us with that. This is painstaking work. And then we'll see how that leverages us. I would not discount human ingenuity, especially our research teams.
And I want to end the interview where we started, Kathy. If you were going to go back and talk to that 20-year-old you who was exploring every different program, what would you say to her?
Oh, I would say, good job in terms of being open-minded and not panicking. I did go through and just enjoy the process, really. So definitely, if you do get to college without an idea of where in the world you're going, then that's the time to sample as much as you can, anything that interests you. Because, I have found, with people who have joined our firm, with my own life, if you lean into what you love learning and, want to be a part of that ecosystem, your life is going to be very enjoyable. I'm not going to say it's stress-free, but on balance, I still love what I do. I love it. I love it so much. And, all the seeds for what is happening in innovation now, all of those seeds were planted in the first 20 years of my career. And so I've had the privilege, luxury, honor of watching them germinate and now seeing them flourish. And I'll just end on this, just to give you a sense of investor psychology. In the late 90s, a lot of these seeds were planted. Capital was just flowing, money was being thrown at anything .com, internet, biotech, anything like that. And, we knew it was too early. IPOs were coming out, the price would quadruple on day one. We said, that's crazy. These technologies aren't ready yet. to scale, and they're way too expensive, which is one of the reasons. DNA sequencing, first human genome, it cost $2.7 billion to sequence one person's genome. That was in 2003. It finally was done. Today it's $200. It's ready to scale. And so what's the worst performing sector of all in the innovation space? That sector. And it just gives you a sense of crowd behavior. When you see, the money is just so easy to make, you could throw darts and become very wealthy. That's usually a bubble, or it's heading for a big correction. When you see a time like you see now, where there's a wall of worry, people are worried about everything, and they are not throwing their money at one of the most important areas in AI, healthcare. It's the most profound application of healthcare. When they're not throwing their money, then we're moving up a wall of worry, which is a very healthy bull market. And what do you know? It is broadening out, which is very exciting. And we're really happy that blockchain technology is a part of this movement, this broadening out in the traditional financial world, getting exposure to this new asset class. Really important.
Blockchain really is broadening out and is becoming much more mature. I appreciate you taking the time to sit down with me. Thank you so much for joining and providing that insight, Kathy.
Thank you, Jen. This was fun. Memory lane.
There we go. Alright. Oh, I didn't even duplicate them. I was supposed to duplicate them with the kernels. What a joke. Alright, well. That's what happens sometimes. Let's see what else we got here. I'll find something in a moment here.
Hey guys, the plan today is to look for reasons to be bearish MSTR, which derives its price from Bitcoin. So we're going to be looking at a bunch of MSTR charts, a bunch of Bitcoin charts, and then even extend that into some ratio charts and really dig deep to find if there is a bearish context that we should be looking at price action through. Starting with my green chart on MSTR, also known as strategy. So this linear chart with the green channel goes back 5 years. You can see I connected the 2021 top to the 2024 most recent top, and also the bottoms connect at the exact same angle. So pretty solid channel here containing price action, and we're floating right around the 50% mark of this channel. You can see actually it looks like this weekly bar rejected right off of about the 50% mark. However, so we're below the 50% mark, which you could say, well, we're not above it, therefore that's a reason to be bearish, perhaps, but we're also trading above the 21 EMA, the 200-day, the 30-week, so a lot of reasons to be bullish as well, even though I don't think this chart tells us that much as is. If we do a quick like fib retrace on it, you could see that we are between the 0.5 and 0.618 Fibonacci. And if you saw my weekly forecast for MSTR price action this week, I projected this weekly bar to literally be basically what it's been. You know, it went a little bit lower than I expected, but that's okay. It was honestly, there was a precedent for it on this chart. So let's go to the next chart for MSTR. It's my red channel chart. The red channel, I go for the most aggressive expansion angle. So I did that by connecting the bottoms at the bottom of the chart here. Most recently, it looks like we bottomed in the first week of August and connect that to the April bottom. And that is essentially how we got this parallel channel. Is there a reason to be bearish on MSTR as it stands? Well, currently, if we go back in time to early 2024, you can see that we've got this big J structure. And worth noting that, well, down here,
Speed this
there
guy
was
up.
really no money made. But up here, well, at least for the long-term holders, all the money was made on that one big move. So if you think about it, on this move, the price ran 170% in 15 days, but if you got shaken out before that, you missed out on all the gains, okay? Worth noting for context. Now, the next big J structure was in the back half of 2024. Again, same structure. You know, we're killing time in here. We're chopping around. No long-term holders making money unless maybe you're selling calls against your position. All the money's made right here. Just worth noting, worth pointing out. It's an observation. And if you were holding for that run, you made as much as, basically, can we round up and call that 200% from the breakout in 30 days, 30 trading days? And look where we are now. For perspective, so I'm going to leave this other one in the frame. Down here, no money was made. Down here, really no money's being made. I mean, these moves that might feel significant recently, keep in mind, for perspective, we are in the base of the big J structure. All the money will be made up here. And we have that red channel, the red parallel channel, showing us within reason. You know, we're not saying, oh, we'll break out of this channel, the major resistance. No, we don't even need to go there to say, well, MSTR could be at, let's see, the first time it could be at 900. MSTR could be at 900 a share in the first trading week of October as supported by this structure. No need, if you ask me. I mean, again, by the way, not financial advice. I'm not a financial advisor, and I own Bitcoin and MicroStrategy. There's the disclosure. I'm just sharing observations, guys. And actually, I have this text here from before because I was saying, guys, the MNAV and how that factors in. Well, right here in the late move in 2024, the MNAV was up at like 4. Very temporarily, like I see the commentary and it's like, guys, the MNAV isn't just gonna like float around 2, 2.5, 3, 4 in this base. This is the base. This is when the whole point is the market maker algorithms are saying, hey, lose interest, go buy SBET, buy BMNR. You know what I mean? Oh, Ethereum's looking good today. They're gonna shake people out, make people lose interest, and then we're gonna get started on this move. And it's gonna be deja vu for back here and the previous move before that is my guess. And the MNAV will begin to expand over here when we get into that move. That's when we can look forward to it. Don't think of it. I mean, we literally got guidance from strategy just recently saying, yeah, no, like when the MNAV is expanded at or above 2.5, we're going to start diluting the common shares. Okay, so take that signal. Does that mean it'll never go above that though? Think about it. There's so many retail traders going to be piling in when we get to the euphoria zone, to the literal banana zone. This right here, you know what I mean? Call that the MSTR banana right there. Okay, when we go and we break out above about 456 is when it probably gets started. You can see why based on right there. And there's of course resistances that will factor in at that time, but it'll be pretty much clear skies up to like 900. It all depends on when the move tops essentially. And we could break out of this channel as well. It's just, there's no need to talk about it until it actually happens in my mind. All right, next chart. Talk too long about that one. This is my ladders chart. Okay, you've probably seen it before if you've been subscribed, but here in 2020, look at MSTR, okay? Look at this structure, 1, 2, 3. It moved in thirds on the daily chart. And overall, if you're able to hold through that move since it began, bottom to top, it ran 720% in 67 trading days. Now, if we zoom out, you're gonna notice a striking similarity between that move we just looked at in 2020 and this move that is unfolding before our eyes in 2024, okay? Now, this is, again, for reference, 4 years later, okay? You had all of this time where MSTR chopped and nothing really happened between the massive move in 2020 and then when this move got started here in thirds again, okay? Nothing new. Here in 2024 through 2025, through the end of 2025, maybe even into 2026. Okay, I mean, this is significant, and it's nothing new. That's what kills me when I see people declaring MSTR is dead and talking about narratives about the ATM, and it's like, you might be right, but I don't know why I feel like I'm defending MSTR. It's like, I really don't care. I mean, for my own personal gains, I want MSTR to do well, and I believe it will because it drives its value for Bitcoin, which looks incredibly bullish, and we're gonna look at that in just a second, but it's like, can we just sprinkle context on for a second here? Like, what we're looking at is especially obviously nothing new when you look at this chart and how similar these structures are, and I did a video just last week where I literally traced the moves in these bases and showed that we are currently correlating them perfectly to the previous move from 2024. It correlates just at a different scale, okay? And you can even see right here, it looks as though, you know, us being in this corner right here looks very similar to us being in this corner right here or in this corner right here. And look literally what happened next, okay? In the first move, price ran 350% in 8 weeks. On the next move, actually, no, that was the second move I just measured. Sorry, the first move is way down here. Price moved 311% in 7 weeks. The next one was essentially the 385% move in 10 weeks. It all depends on really how you define the breakout. I would personally define the breakout line when it started getting above this line right here that you see on my screen. So I would say the breakout really started here. If you got in all the way at the bottom down here, well, you front ran the breakout. Congrats, you gained an additional, I mean, your price essentially, you got in at 112 instead of at 177. Either way though, everybody got really nice, massive gains. So that's what I would, that's how essentially how I'd read into it. Now this is MSTR on the log chart. Is there anything bearish about this chart? Okay, these white lines on this chart have defined the breakouts. You can see going back here to 2020, and this breakout coincided with a breakout on the Bitcoin log chart, which we'll look at soon enough. But if you caught this full move, guys, 26 weeks, 900% gains on MSTR, bottom to top. This one right here, the next breakout, 450% gains in 22 weeks. This next breakout right here, it had a backtest. If you held through the backtest, 244% gains in 8 weeks. And now we are literally, I'm going to hide this line real quick. We are literally right here. We've already done a breakout and a fake out. Okay, so we essentially got rejected here, come back under, breakout, fake out, up above, backtest. Guys, there's a chart. I might have to just skip straight to the chart that I really want to show you right now, because this exact pattern, reject, breakout, fake out, up, backtest, and then go. We've seen it on another chart. You know what? I'll save it for later. But there is a very significant chart, dare I say more significant than even MSTR's chart, and debatably more important than Bitcoin's chart, with that exact pattern that I can't wait to show you, so stay tuned. All right, the next chart for MSTR, it's crazy that I've got these memorized, but as long as y'all are enjoying these videos, I'll keep doing them for you. So let me know in the comments, let the YouTube algorithm know by hitting that like button. Here's another way of looking at MSTR. Is there anything bearish? It's a cup and handle, a massive cup and handle. The measure move implies we're going to, above 600. And yeah, we're kind of sputtering out as we break out of the handle. That's not ideal. You could argue that's bearish, but I don't want to jump the gun and declare it dead. This is a daily chart. Just because it didn't, explode out with a bunch of like 5-10% gaining green channels, the whole reason it didn't, like, again, this one view doesn't tell the story. You know what view tells the story if you ask me? This one. I'm sure you're tired of hearing me come back to this chart, but sorry. This chart to me tells the story right here with these J structures. All the money is made, guys, on these euphoric moves when you break out of the J's. Have we broken out of the J? No, we have not. Will we? I don't know. I think we will. And again, like I told my private group before the market even opened on Monday, what I expected out of this week. And so far, we're pretty much right in that range. So they expected it, and they know why we expected it, and they also know what I think comes next. And actually, I'll give you guys a little hint too, even though I've completely butchered this chart and it looks insane. Essentially, where we were right here in this move, and remember after earnings, when MSTR recently tanked to 366, that's the equivalent of this bar, okay? Last week is the equivalent of this bar. This week is the equivalent of this bar. Now, there's more to it than just this, but I just want to tell you guys, this bar right here that you see me circling, it, in September of 2024, is basically just a really boring bar. Sorry if I'm like making it hard to see, but this bar was a very boring weekly bar that went down pretty low, ended up just bouncing back up. I think that's exactly what's gonna happen this week. This is not great technical analysis. What I really want to share is that was the monthly options expiration week where I wouldn't have expected a big move then. This week, as you're watching this video, assuming you're not watching it too far in the future, is the same thing, options expiration. Look what came next. If you were able to hold through the week, the next week, bottom to top, was a 24% gain for MSCR. That weekly candle will be the equivalent of next week after we go through the monthly options expiration for August. Yes, there are weekly options expirations, but the main ones are always on the Friday in the middle of the month, okay? So, do you believe in coincidences? I don't. I'm looking for signal here. All right, I'm gonna speed up. This is MSTR on the log chart. Again, the same exact decline lines that I said represented the breakouts on this chart, okay? Same exact angle, but I just essentially detected more of them, okay? They're both actually log charts as well, even though it's a completely different way of looking at MSTR. When you put it through this lens. But you can see that exact decline line has defined so many breakouts. I've done previous videos where we talked about them, but just for reference, here's a few. Okay, it defined this breakout here. You had 138% gain in 33 days. The next one right here, 73% gain in 20 days. Next one right here, 75% gain in 42 days. Next one right here. This one actually ran through two of them. 189% gain in 21 days. Next one, right here, you could say it went up 49% in 16 days. Then it came all the way back down. Now it's only a 12% gain in 25 days. But if you held through that, boom, it starts a major uptrend. 429% gain in 79 days. Now notice what I just said there. From this bottom, it went up. If you held through 17 trading days, you're up 47%. If you held through 25 trading days, you're only up 11%. And you're hating MSCR right there at that, not even bottom, because it wasn't really bottom. You could say it's a local bottom, I guess. But it's still above where you entered off that breakout line, which is pretty clearly defined here on the log chart. No coincidences. Okay, it's the same angle as all the other breakout lines. If you held through that, this is where I say, like, guys, if you can get your brain to work backwards, like if you know where MSCR is going, you can just say, well, we're going to get there a lot quicker if we are killing all of this time in the bottom part of the J, the base, because we know when we do break out, it's going to be rapid. And that's where the euphoria sets in. That's where the MNAV expands to illogical levels. People will be saying on Twitter, oh, why are people buying at 2.5 or above 2.5x MNAV? Don't they know better? It's like, guys, this is nothing new. This is how bubbles work. This is how euphoria works. This is when retail starts piling in. If you're watching this video right now, I don't think we are technically retail, but let's just say we're a little bit sharper than the average person that will be buying above a 2.5x MNAV. Does that at least make sense? But look at the, I want to say the F word here, the effery here, if you get my gist. Right before it runs, 435% in 78 days. The maximum amount of pissing people off that are holding long-term is right before the most significant moves. Not financial advice. I'm just sharing observations here, okay? And then you had another breakout. We're almost done. Right here, up 48%, 17 days. Oops, right back down. Very similar structure. Now we're only up 3% in 28 days, right before it runs ultimately 87% in 49 days. And we are right up against another breakout line. Who in the right mind bets against MSTR right above? Did I say below? No. Okay, if we were having this conversation last week, you could say, oh, we're below the line and be like, yeah, this sucks. Do you remember my video from last week, by the way, when I said big move imminent and then it happened? Am I like a psychic genius? No, I showed you how I arrived at that conclusion, guys. And again, if MSTR decides to fall outside of this, we instantly flip bearish. Or I can't say we, not financial advice. I will look at it through a very different lens. Currently, though, we're above the breakout line. We're above the support, the rising support that's contained, basically acted as support, dating back, as far as right here. What is that? October 2023. pretty significant. I'm still not detecting many bearish signals. Click here to watch my full 1 hour long Bitcoin and MicroStrategy thesis video. Let's do the same exercise for Bitcoin because MSTR is really a proxy for Bitcoin at this point, I would say. This channel contains 8 years of price action for Bitcoin. Now, is it bearish that we are currently trading not below the channel, but above the channel? And I haven't even counted how many times we essentially established the upper part of this channel, 1, 2, 3, 4, and you could actually get down into those daily wicks. And there's probably at least like 10 touch points before we got above this channel. Like the lens we need to be looking at this through is insanely bullish, if you ask me, just my personal opinion. 8 years of price action, we just recently broke above it. These are weekly bars, by the way, so actually we should be counting every single wick. It is insane that we're stacking weekly closes now above this channel, which, by the way, just so happens to coincide with the Bitcoin log chart breakout, which we'll talk about in a second, and the SPY, the general barometer for the whole stock market, is consolidating above a 100-year, yes, you heard that correctly, channel on the log scale. I mean, something's up, if you ask me. And again, don't ask my talking head on YouTube. Look at the charts. It's not about me. Okay, I'm just sharing this info with you. You can go validate on your own. In the context of this green chart, I see nothing bearish. Next chart, my Bitcoin red chart, red channel. Instead of going back 8 years, we're going back essentially connecting the 2021 tops. So it's going back about 4 years. And I make my red channels as aggressive as possible. So in this case, I'm connecting these bottoms here from August 2024 to April 2025. And this expansion angle supports Bitcoin. Let's just say we said that MSTR could hit 900 in October. Well, that would sync up theoretically with Bitcoin at 226,000. Now, if you ask me if Bitcoin's at 226,000 in October, which I think is a little bit too aggressive, who knows? Bitcoin humbles a lot of people. If it is theoretically, I think MSTR is above 900. I think that's a very safe bet. But just for theoretically saying, how do the charts match up against each other? I think that is in the realm of possibility. Like in terms of identifying potential tops for Bitcoin, if we stay in this parallel channel, 226,000, or if you actually extend it up and include the 2017 top, which is back here, if you can barely see it on the side of my screen, all of a sudden, let's just go to first week of October just for consistency purposes. Bitcoin could be at like 310,000. Okay, so this is all like, again, justified by previous price action. If you don't ever get into the charts, you might just be taking me at my word. Like, hey, trust me, I might know what I'm talking about, but it's like, yo, you can jump in the charts, go to something unrelated to MSTR, unrelated to Bitcoin, and just look at the linear and log charts and how when these things get into price discovery mode, they use Fibonacci retracements. Like it's so not random, basically. The algorithms that are responsible for setting the price of these, what I call financialized assets. In my mind, if it's financialized, that means that the algorithms are essentially saying, okay, you have legitimacy for as long as we say you do, and we're going to be responsible for price discovery. In my mind, that's how it works. Call me a conspiracy theorist, it's fine. Here's another way of looking at Bitcoin. All I did in this chart, and we can go all the way back here, way back if you want, just for fun. Let's go back here to 2013. Okay, all I did is I connect the previous top, I draw a horizontal line, and I show what happens when you break through it. Okay, boom, massive run up. If you want to measure it from when we broke through the previous high to the top, it ran 334% in 3 weeks. Okay, if we do it again here, now we're looking at 2017. So literally 4 years later, finally we get through the previous all-time high. You guys remember 2017? Wasn't that long ago, right? Actually, it was. But if I measure from the breakout to the top of that run that started in 32 weeks, okay, let that set in for a second. 32 weeks. It gained 1,452%. If we continue to do this exercise, you can see right here, it looks like it broke through again in November 2024, and I'm just measuring from the breakout, not even from the bottom, because it's really hard to hunt for bottoms. So let's just do it from the breakout, from when you break the previous all-time high. November 2024, in 6 weeks, Bitcoin ran 57.5%. And now if we extend that line again and call that the previous high, we just recently broke through it in that first major candle back in July. And by the way, there are signals of when we're going to get those massive green bars that I don't think a lot of people talk about. I'm just saying that I have a literal, I call it my breakout checklist, where I have as many of these signals as I personally define. By the way, there's other people like Colin Talks Crypto, I think his name is. He has a checklist and he has a whole dedicated Twitter account where every day it just sends out like 1 tweet a day and it just shows like a score 1 to 100 on essentially like Bitcoin top indicators. But that's not exactly what I'm aiming to do. I'm aiming to identify the breakout through quantifiable metrics. But I remember on this big bar here, one metric that has not been firing a lot recently, that has kind of woken up, I would say, in the last few days, but it was firing like crazy right here. And that's how it should be, essentially. It should coincide with that. I'm gonna keep it to myself for now, but it's in my group. But let's just look at the measurement. From where we broke out to the top, if you wicked it perfectly, in 1 week, you gain 13.5%. Now, does that sound significantly lower than every other breakout? Yeah, it does. If you ask me, we have a lot higher to go. The fact that we are consolidating on this chart, by the way, look at it right here. What does that look like right now? Looks like we're just consolidating in no man's land on these weekly bars. But that's why I like to look at these asset classes in so many different ways. When you look at it on the green chart, it's like, oh no, we just broke out of this 8-year linear channel and we're stacking closes above it. On the red channel, the way I have it set up, it's not really showing us too much. And I haven't even been messing around with like Fibonacci levels or anything like that. On this chart, it's not showing us too much other than that we broke out right here of that previous high and we're stacking up closes well above it. I mean, well above it. The previous high as measured in this one was 108,500. But is there anything bearish? I would say no. And also, just worth noticing, a massive parabola structure, you know what I mean, that we're in on that orange line here. Okay? Parabola structure is not an exact science. I don't do like measured moves off that or anything like that or targets based on it, but parabolas are, pretty bullish until they're not. And I think we're safe currently as it stands. Okay, now we have the Bitcoin log chart. Help me find anything bearish in this chart. Is there a reason to be bearish? Well, let's look at the breakout levels, which are defined by these not decline lines like there was in MSTR, but incline lines. A little bit different here. Bitcoin on the log scale, though, is my preferred way to look at it. Well, this breakout right here in 2013, in 12 weeks, price ran 1,600%. This next breakout right here, early 2013, in 3 weeks, price ran 311%. The next breakout, let's go right when it broke out, because there was a breakout, then there was a retrace, a fake out. You had to sit through a 30% decline. Like, they would have just wrecked people back then. But if you held, okay, so you had to sit through an extra 7 weeks. If you held first breakout here, I'm being fair about it too. I'm not saying, oh yeah, well, you know, the fake out, we'll just get that. No, I'm saying, no, the initial breakout, it retraced 30%. Life sucks. If you held, you gained 638% in 27 weeks, okay? Let's keep moving. Anything bearish so far? Not if you ask me, okay? Right here, the initial breakout to the top, it was 271% in 21 weeks. Okay, that was the most recent breakout, which was November of 2020. Then we spent 5 years almost, okay, just chopping and killing time. Now, a lot of money was made because these are big moves. This is a log chart. So we're literally, I just drew that big squiggle, but we broke through initially. Bitcoin was at 17,200 and it ran up to 65,000, okay, on that first initial move. What I'm trying to capture here, like the reason that I'm like so, I want to put emphasis on this is it's the initial break that is the most predictable. After that, will there be money to be made? Of course there will. But the easiest to predict one has always been the initial break. That's why I want to talk about basically where we are right now. Okay, we spent 5 years and had to test breaking through this most recent log scale level denoted in that thick white line 7 times. We broke through on the 7th try. That's significant if you ask me. And that's off weekly bars, by the way. That's not even off daily bars. If you go off daily bars, it was more than 7. Okay? Look at this. We are stacking weekly closes above it. And this most recent backtest today, this week, if you're watching and wondering why Bitcoin retraced all the way back to 18,100, well, one way of looking at it is it gave a backtest of the log scale breakout, which to me, of all the time, this is a long video. Of all the things I'm going to mention in this video, this is what gets me most excited and most confident about my stance on Bitcoin, where it's headed, MSTR as a proxy, etc. Okay, and even Ethereum, like I was knocking on SBET and BMNR, which are 2 Ethereum proxies earlier. Like I'm not trying to say I'm not like for that. We know, I think like Ethereum is essentially deriving a lot of its value too from Bitcoin, you know, being bullish. And there's obviously other things, you know what I mean? I'm broad stroking, but we are now 1, 2, 3, this close below, but then 4, and we're working on our 5th close above the breakout line. Nothing bearish at all. And upside, if you trust these inverted parabolas, upside to maybe 165,000, or the second one, as high as like 199,000 currently, all depending on when we get there. I'm looking at September right now. If we go out to October, October would support a close of like 204,000. Now again, I'm not using the parabolas as price targets, but they are good to give us a general gist if you ask me. All right, the video's getting long. I'm going to accelerate my pace here. This is Bitcoin on the log scale again. This kind of channel that's contained Bitcoin's price action supports, if we go out to October, first week of October again, just connecting tops and bottoms in a parallel channel, it looks like supports Bitcoin 323,000. Now there is another way of looking at this because I did kind of cheat out this bottom right here. If I extend and make a new parallel channel and connect it to this top right here and then change the color so you guys can actually see it, this would also support Bitcoin trading as high as, well, 1.1 million. This is why I don't like to do this type of TA on the log charts, by the way. Like, I don't need to do a whole TA tutorial right now, but like, I don't usually do parallel channels on log charts because you get kind of wacky numbers, but at the same time too, there is some validity to it clearly, as you can see right here. But I'm not doing my price projections at 1.1 million because I connected the bottoms and extended it to the top. Okay, that's just another way of looking at it. Here is Bitcoin log chart in a massive wedge structure. Some might say this would look bearish. However, if I go and I compare this to gold, same chart, weekly bars, log scale. Is this log scale? Let me double check and make sure. Yeah, it is log scale. Okay, log scale. Check that out. Very similar structure, broke to the upside and is currently consolidating at the 1.61, sorry, at the 2.618 Fibonacci level, okay, up here. 2.618 Fibonacci, gold is currently consolidating in what looks to be a pretty equilateral triangle that would imply it wants to go higher, maybe even to the 3.618 at about 4,200 an ounce. The reason I share that is because look at Bitcoin, okay, and just for context, if we wanted to do, it's not the exact same angle, but if we wanted to do just a top to bottom measure here, the 2.618 Fib level would be at about 156,500 as a price target, which to me feels very safe and very tame. I got a few more charts to show you. Bear with me. Some of them actually are bearish for MSTR, by the way, so you're gonna want to see this. But this is crypto total market cap. This is the chart I was alluding to earlier that I thought was a little bit reminiscent of MSTR's recent price action. Remember, MSTR had gotten rejected. Okay, now this one was not a clean rejection all the way off that previous high, but close enough. Okay, rejection, breakout, just kidding, fake out, break above, backtest. This is where MSTR currently is, literally right there in the backtest portion. And then look at crypto total market cap and how much room it has to run, you know, as high as this chart would say, depending on when you get there, if it runs into 2026, like above 10 trillion. I mean, literally insane. Imagine if that happens, guys. And there's narratives to support why that might be the case. You know, why, let's get into it another day maybe, but stablecoins, speaking of stablecoins, and a pro stablecoin president, you know, to help create demand for treasuries, et cetera, and creating a crypto bubble as a byproduct. This is the USDT tether dominance. And as it declines, you tend to see Bitcoin and cryptos run. Well, that red line is a pretty strong, I would call this almost like the main vein of this chart. And if we're below it, it has to be looked at in a bearish context. If I were to add Bitcoin up here, what you'll notice is that it trades inverse. Okay, so this pink line that I wish I could just make it orange by default every time I try to pull up Bitcoin here, but the orange line now, look how inverse it is, inversely correlated to tether dominance. So that's another bullish sign if you ask me. Now this is Bitcoin to SPY ratio, and I think this is very bullish for Bitcoin at a minimum. You'll notice that most of the time it is spent at these little angles here with the, I tried to denote it with the yellow lines, but every now and then it does a massive breakout. Okay, massive Bitcoin outperformance relative to SPY. And this is a log chart, so it's not really showing up. This looks like a very small move here, but that little move is indicative of a significant outperformance of Bitcoin relative to the S&P, which would be good news for MSTR. Here is Bitcoin to gold ratio. We're at about the 25-30% mark in this channel, so not a strong signal there. But I would say room to run. You know, if we're in the bottom half of that, then there's room to outperform to the upside. MSTR to gold ratio, currently right around parabola support. And if I flip this to the log scale, okay, and then I make this channel white so it's easier to see, you'll notice that we are, in terms of the MSTR to gold ratio, basically at like the 10% or less mark of this channel, indicating a lot of room to run for MSTR outperformance. So 2 ways to look at it there, one linear, one log. Here's MSTR to silver ratio. On the linear scale, you could make a strong case that, well, it's dropping out of the parabola, and I would have a tough time arguing, although with parabolas, guys, just so you know, you can adjust them pretty easily and say, no, it's in the parabola. And essentially what I just did that break anything? Like, not really. You just sacrificed maybe these touch points here to extend it out a little bit and account for this here, and that also brings down the height of the outperformance of MSTR relative to silver when you do that. If I flip it to log scale, we have dropped out of this channel, so that is noteworthy. If anything, I mean, it's a good sign for silver, you know, that silver is now, like, pretty significantly, because this channel goes back to 2022, silver has broken that support and is going to most likely, again, not financial advice, just looking at the charts here with you, outperform MSTR more so than in the last 3 years, okay? That's essentially what it's telling you there. MSTR to Bitcoin ratio, I would say this is a tough one to account for by adjusting a parabola. I mean, you could, right? You could do it like I just did, but I think this parabola right here had many more touch points. This is a weekly chart. You can see it is kind of a big J structure. We had the base, we broke above. The main break was this big run up right here in 2024. This is ugly though. Ever since it kind of broke out, it has, you know, in terms of the MSTR to Bitcoin ratio, got rejected here. Ninja edit here. This could be a massive cup and handle on the MSTR to Bitcoin ratio, which would imply it would resolve to the upside for massive MSTR outperformance. Although I do believe it most likely be short-lived during a massive euphoric rally. MSTR to SPY ratio right here has basically fallen out of that parabola. You know what I mean? It's holding up kind of strong, but it's just hanging out here kind of awkward. You know, it looks like a little tumor on the body of that parabola structure, right? It looks like a little tumor that needs to get chopped out and needs to jump back up in there. So not everything is bullish. Here's MSTR to VIX to close out the video, and not a real strong signal here, MSTR relative to VIX, but is kind of nested within the parabola structure. If you're irresponsibly long MSTR like I am, how much would it be worth to you to have somebody who's in the charts daily, looking for the perfect entry for shares and options, and eventually looking to see if we might have topped, and it's time to take profits? If this is something that interests you, I want to invite you to check out my MSTR Generational Wealth community linked below.
All right.
Bitcoin is racing up. It's almost at all-time highs. Ethereum's almost at all-time highs. Solana just went up 15% yesterday alone. I want to explain what's happening right now. Some re-ratings of cryptocurrencies. Some banks now saying that they're almost doubling their price targets. We'll also be going through some of the big flows from yesterday. And I also want to go through a recent announcement from Trump that Fox is saying is pushing up the cryptocurrency market right now, which I totally agree with. And also Tom Lee talking about what's happening right now in the market. He mentions Bitcoin a handful of times, talks about Ethereum. He puts out a very high price target on Ethereum as well. So I'll be playing all that for you. If you don't mind, please hit subscribe so you can see future videos just like this one. If you want to trade crypto, now's the time. Now is the time. Check out BY DeFi underneath the video. You can start trading in just a few minutes because they don't KYC. You don't need a VPN. Recently, we opened up a 60x position on Bitcoin when we flipped this into support. I did that a little bit more margin, so it was more like 25x. We closed it just a few days ago and put it into a 3x just to, you know, reduce the risk a little bit, but we also doubled how much we had in the trade because we made 100% on the 60x. So yeah, you can constantly roll trades like that to lower risk as well once you're up a significant amount. And we have this trading competition going on right now. It's not even really a competition because it's just free money. Every $1 million that anyone trades that's used one of my links increases the prize pool by $100, and that will go out to people at the end of this 25-day left period, 26 days left. We just gave away over $6,000 of XRP. We gave away thousands of dollars of Bitcoin before that. We constantly run these, and it's not just for new users. So check this out underneath the video. Now's a great time with so much volatility and so much momentum. I think you can make a significant amount, but you have to know what you're doing as well. So let's start here. The traditional markets are up again today. The NASDAQ up 0.25%. Not bad. It's even come down a little bit since the open, but still rallying most likely off of the CPI numbers yesterday. They came in lower than expected. We have PPI tomorrow, so don't be surprised if there's a bit of volatility around that. Obviously, everyone in crypto seems to be watching Ethereum. Ethereum very close to all-time highs. It just hit $4,750, or just short of that, maybe $4,740, which is just $100 away from all-time highs. It's looking really good, and you can see so much strength recently. Don't be surprised if we see a little bit of a pullback. I talked with Tyler Hill about this yesterday. Don't be surprised if we get rejected, fall down a little bit, reset the RSI, or even come down to 4,000, flip that into support. I would not be surprised if that happened. That's why actually yesterday I said one of my favorite trades, or one that I've been thinking about a lot recently, was Solana. This is before it went on its run of 15% yesterday. It was at 180, and I said, you know, I think it could run pretty hard with Ethereum being what everyone's looking at. Naturally, people will go to Solana next, and no one really seems to be that bullish on Solana right now. So yeah, what do you know? It went up 10% now. Ethereum is the bell of the ball right now. People aren't even really paying attention to Bitcoin or talking about it as much, and it's right at all-time highs too. Standard Chartered Bank raised its 2025 year-end ETH price target to $7,500. This was from 4,000. I think this makes people bullish, but I just hate it. Like when analysts or banks are below the current price of an asset that's going up significantly, they all of a sudden just raise the price target. And it's just annoying because it's like they don't do that ahead of time. They don't go out on a limb and say, hey, we think Ethereum could hit 7,500 when it's at like 2,500. It's like they raise it once they're already beneath the current price by 20%, which is just so stupid. But Moving on from that, we have $27 billion in dry powder waiting to buy more Ethereum across treasury companies. That's 5% of the total supply. So yeah, this could continue on for a while. Again, we'll see pullbacks. We see that in Bitcoin too. Don't think it's going to go up forever because there are pullbacks, but usually that's a healthy buying in price, or it's nice when it falls down a little bit because then you can buy in, or you can set up a long position or something like that. I'll give you kind of my thoughts on Ethereum versus Bitcoin versus Solana at this time later in the video. But Ethereum inflows continued yesterday, over $500 million, most of it coming from BlackRock. That's after $1 billion the day before when we hit record inflows, which had $640 million from BlackRock. Like, BlackRock continues to be the largest buyer of all crypto assets. So bullish for cryptocurrency. The Bitcoin ETFs also didn't have a terrible day. I mean, it wasn't the same inflow as the Ethereum ETFs. They're actually lagging behind a lot right now, but still, you know, I think it was around 70 million or so in inflows, which isn't too bad. Like that's not bad at all. That's better than most ETFs have in a week or a month, right? So yeah, don't be surprised if Bitcoin suddenly is the belle of the ball again and starts racing up to new all-time highs, and then it pulls some attention away from Ethereum or something like that, because Ethereum has not had its day in years. It's been a very long time since it's outperformed Bitcoin, so it's bound to happen at some point. I'll give you some more of my thoughts later, I suppose. But let's get into what Tom Lee just said. He talks about Bitcoin, he talks about ETH, he talks about the traditional stock market as well. Let me play it for you.
Why don't we start off with the markets hitting new record highs once again after that CPI report? That, in honesty, it was kind of mixed. Headline was better than expected.
This is just a few hours ago.
Hotter than expected. What's your take on it?
Well, I think it's just a reflection of the fact that the market was bracing for a hot CPI, knowing that not only was the Fed, but economists were warning that we'd start to see inflation coming through in the July CPI report. So I think it was actually elevated compared to where it was in June, but I think it was much better than expected. So it's one of those rip off the Band-Aid moments.
All right. We were showing the CME Fed Watch tool earlier, just under a 95% chance of a cut coming up in September, being priced in by bond traders. That rate cut, what area of the market does it benefit? Does it definitely just benefit the cyclical sectors? What does it mean for the tech trade, et cetera?
To me, there's a whole area of the market that gets sort of lit up when the Fed gives sort of all, dovish signal, or, Fed is resuming its cutting cycle. And I think that's things that benefit from liquidity. So that's financials, small caps, and also, believe it or not, Bitcoin.
Oh, Bitcoin. All right, that's interesting. By the way, potential rate cut. We've often thought we're going to get those rate cuts. They don't actually happen.
It's funny that they say that's interesting. Obviously, Bitcoin's one of the biggest winners of increased liquidity.
So they're being heavily priced in right now. With that,
yeah, that's right.
I want to get to your word of the day. What's your word of the day today, Tom, and why?
The word of the day to me is breakaway. And the reason I'm saying that word is that in early July, Bitcoin made a breakaway move, and I think Bitcoin has been leading the markets by a month. So believe it or not, I think that this is the month that the S&P makes new highs towards 6,500, 6,600.
Interesting. So you think we hit new highs this month? What's the catalyst? Because, we're pretty much through earnings season. So what pushes us higher other than a lot of optimism over...
So he says 6,500 or 6,600, I think he said there. It's not that big a jump from here. It's like, 3% jump, maybe 2% jump.
Rate cut coming up. Frank, I think part of it is positioning and sentiment, because I think investors were thinking this is the dog days of August, and that we'd be getting some hawkish inflation data. So I think some of that's just a relief that, in fact, CPI was better than expected. I think it's also just follow through because we've had a pretty decent earnings season.
Amazing.
And at the end of the day, the economy is holding up pretty well. And, I'd say that it has a lot to do with the fact that August will probably be a surprise and markets are going to be stronger.
All right. Tom, you didn't send us a pick, but I'm going to guess that Bitminer might be your pick today. It's a company that you're involved with. I want to talk to you about Ethereum and also Bitminer.
Yes. Well, Ethereum, has probably become the surprising sort of hit for cryptocurrencies this year because it's up 28% outperforming Bitcoin. But, in some of the work we've done, we believe it's the biggest macro trade over the next 10 to 15 years. And a lot of it has to do with the fact that stable coins have really become the ChatGPT moment for crypto. And
all right, that's a little bit unhinged, sneezing right into the microphone.
now we have the Genius Act and Project Crypto from the SEC, which is Wall Street essentially running onto the blockchain. But one of the best ways we believe to sort of have exposure is through Ethereum treasuries. And that's a company like Bitmine, which I've become chairman recently.
So when we're talking about Ethereum, it's one cryptocurrency. Stablecoins are obviously in the news, especially with the Circle IPO, and Circle is reporting its earnings and offering more shares. And then you mentioned this Bitcoin as well. Why are you so bullish on Ethereum? What are the opportunities you're seeing in Ethereum in particular?
Well, Ethereum is the second largest blockchain, and it's different than Bitcoin because with Bitcoin, you can't really do programmable contracts, so smart contracts. Wall Street needs to find a stable and legally compliant blockchain to work on. The majority of stablecoin creations are taking place on Ethereum. And when you look at where JP Morgan is building a lot of its layer 2s or Coinbase or Robinhood, they're choosing to do it on Ethereum. So it is the place where Wall Street is essentially financializing the system.
All right, so Bubba, you're not the only bullish person or bullish company when it comes to Ethereum. I'm just looking right now. Standard Charter raising its year-end target for Ethereum to 7,500 from 4,000. Right now, Ethereum's trading right around, I believe, 4,700. Are you this bullish, 7,500 by year-end?
I think that's within the realm of expectations. Ethereum, I think, first needs to clear its prior highs of around 4,800. It's within 6% of that now. Believe it or not, Bitcoin's obviously been making many new all-time highs this year, but Ethereum is still below its 2022 highs, 2021, 2022. So I think once it clears that level, I think Ethereum and small caps tend to be correlated. So to me, 7,500 actually might even be on the low end of what's possible. I think I've seen many targets of 10 to 15,000.
All right, one more time before we get out of here. You're known for your granny shots. Can you give us one of your granny shots right now with the fact that we have the markets trading at all-time highs, the S&P and the NASDAQ, again, closing at record highs yesterday?
Yeah, I think really one of the granniest of our granny shots is NVIDIA. It's still one of the most important companies. Well, it's probably the most important company in the world. And in terms of forward multiple at 30 times, it's actually still reasonably priced. I believe its PE multiple is still ranks number 38. There are 37 stocks in the S&P 500 with a higher PE than Nvidia.
Okay, so that's kind of interesting. That's kind of a bold take to say Nvidia is one of the granniest shots, means like one of the easiest money plays or one of the safest plays. It's kind of a bold take because most people don't think that. And we'll get to crypto here in a second, but this all ties in. I say it's a bold take because, like I said, it's the largest, quickest growing company out there. But a lot of people feel like, you know, it could be starting to decelerate, or it could decelerate here soon. Now, they announced probably in the next couple weeks, but they've been crushing it. Every metric is up and to the right. I see what he's saying, though. I mean, when you look at how quickly this company is growing, let's say you look at the quarterly here, they've grown revenue 70% over the last 12 months. Like, we've never seen a company this big do that. It's the largest company in the world. Name one time when the largest market cap company grew 70% on the top line in a year. Their bottom line has grown 75%. So if they even have a year left in their growth, or like 2 quarters left in their growth at this pace, this, I think, is undervalued. Honestly, even at a, trailing 12 months 60 PE, or next 12 months 33, 34. But, we'll see. Obviously, if it drops off a cliff in revenue at some point, then the whole market is going to feel it, and stocks aren't going to be the only thing. Obviously, if the stock market falls down 10, 20%, Bitcoin will probably fall a decent amount too. Let me play this, though, for you. This is Tom Lee talking about Ethereum, not just the next, end of year price target, but for the next, I don't know how long, maybe decade or so.
So our view of $60,000 E is really just a simple sliver of that, just saying that if Wall Street builds a lot of banking activities and just 20% of that share is on Ethereum, and then Ethereum captures a similar share of payment rails, that actually value the Ethereum network at around $60,000.
So that was kind of poor audio because it's someone holding a camera at a conference, but he's basically saying if Wall Street goes to the blockchain, payment rails go to the blockchain, and ETH gets 20% of the action. 20% will value ETH somewhere around $60,000. So it sounds crazy, but if he's talking a decade out, or 20 years out, that's a 15x from here, almost a 12x if you value ETH at $5,000 now. So it sounds crazy right now, but also if you think Bitcoin's going to $10 million, $15 million, it's not crazy to think that layer 2 could also do a 15x, because I mean, a $10 million Bitcoin is almost 100x. So yeah, it's not out of the question. I'm not saying that's going to happen, but if Bitcoin gets up to millions of dollars, you better believe some alts will probably see some pumps too. Now let's play this. This is what Trump just announced that Fox is saying is causing crypto to go up.
Bitcoin Foundation Chairman Brock Pierce joins us with Bitcoin hovering close to 120,000. Brock, let's begin there. How much higher do you see Bitcoin going?
Well, as I've always said, it's a binary outcome. It's going to a million plus or effectively zero. We're right on the edge of Bitcoin's all-time high at $123,000. Now that the public markets and the broader capital markets are open, you've got 15 companies in the process of going public right now. Retail investors, not just institutional, can now buy with their 401ks. So the supply and demand, fixed limits, Bitcoin likely going much higher to break its all-time high.
Well, you just mentioned my next question. I mean, that's a big move, isn't it? Allowing crypto investments into 401k retirement plans. I mean, that's got to be good for the value.
Yeah, there's no question what drove the market to where it is right now is the fact that capital markets have opened up. Institutional investors historically could not invest in Bitcoin because of their charters, but they can invest in public securities, public ETFs. So the institutional markets are what have driven us to where we are. The 401ks are going to broaden retail availability, and with that, likely higher prices.
Which crypto company do you think is next to go public?
Okay, so I totally agree with that. I've been saying for years that one of the biggest moments in crypto is when crypto can be put in 401ks, because it's just never-ending purchasing. And while this isn't today, this is still one of the biggest announcements for Bitcoin's price that we'll see for the next decade, I'd say. One of the biggest, probably top 3, top 4. And it's not something that will necessarily pump Bitcoin 100% today, but it's insane how important this is over time. It's one of those things that happens and it's kind of big news, but then people forget about it over a few days. But it's great for the price of Bitcoin, not for the next 2 days, but for the next 20 years, for the next 100 years. I told you at the beginning of the video, I'd give you my thoughts on investing in Bitcoin versus Ethereum versus Solana versus some of these other altcoins right now. I'm going to do an altcoin video here probably in the next week or so. Might be as early as today, but I still think Bitcoin is by far the safest thing to invest in, and it still will provide some of the best returns over the long term. If you invest in something outside of Bitcoin, I think about it as more of a trade. Like, there are very few people that want to hold on to, I don't know, SUI for the next decade, right? Like, it's more of a way to get your hands on more Bitcoin or more US dollars, try to outpace Bitcoin, but Bitcoin's still going to do well. If you're new to crypto, I actually just filmed in the Telegram, like what I would be looking at as a new investor, not trying to time this cycle, but think about like the next 4 or 5 years, and some other things too that are really important for newer investors. But there are some XRP investors, some Solana and Ethereum investors that stack over years, but I think it's very difficult to go through a bear market with altcoins. It's easier to go through a bear market with Bitcoin. So even right now, we're going to see different altcoins start pumping much more than Bitcoin at certain times. This is what always happens. One cryptocurrency underperforms, something like Solana right now that no one's really paying attention to. Everyone's watching XRP, Bitcoin, and Ethereum. Then all of a sudden, it will have like a 50% move over a week or two, and then everyone will be looking at that, and then the next one will pump, BNB will pump, and then SUI will pump, and then like it just is kind of exit liquidity for some of those investors, and the newer investors look at the shiny thing that's going up a lot and buy that, and by that time it's too late. So I figure out what you want to buy, figure out your plan, and try to stick to it. Try not to just get that shiny object syndrome. Also, if you want to trade, that's one way that's a little bit easier, I think, to take profits with a small portion of your portfolio. But right now, I'm still focused on the large caps. There are a couple small caps that I bought recently. I talked about Inspect recently. That's one that I bought a significant amount of. But I'm not just going after whatever pumping up the most. I think even right now, like after Ethereum's pumped 2x in the last 3 months, like I'm naturally more cautious about buying into that versus Bitcoin. Part of that is I'm not Bitcoin maxi, but I also have been through bear markets before, and again, it's much easier to hold Bitcoin, and 90% of my portfolio is in Bitcoin. So I do feel much stronger about Bitcoin than other cryptocurrencies, but when I want to take on more risk, I usually go and leverage trade. I'd rather leverage trade some of the largest cryptos in the world than try to get the next 50x on some 100th rated crypto or something like that. Again, there are certain exceptions to that when I see a really good opportunity, but that's just kind of how I would be thinking right now in this moment. I actually have a video where I break down the math, what this could mean. I'll put this on the end screen. Watch it if you haven't already, because it's insane how much this will increase Bitcoin's price over time, even with a small allocation towards Bitcoin. If you want to trade crypto, check out the link to BYDeFi underneath the video. Now is a great time to be trading crypto. People have been making life-changing amounts of money. We've been able to do it too, and it's not rocket science. If you want some explanations on how to do this, I talk about them down below in the Telegram. I've also talked about trading before on the channel. You can search up My Financial Friend Trading. I actually did a pretty long video talking about how to day trade and why you shouldn't day trade, why you should do what I do instead. I'll put that on the end screen as well. Again, there is a trading giveaway going on right now. Check it out. There's also links to BTC and Bitfinex and Weeks underneath the video. They have bonuses too. So try multiple platforms, see what you like. I'll see you in the next one. Bye.
There's more rooms to check, and I'm not gonna get through this one in time. Okay. Oh yeah, the gold's coming in now. Oh, little jerk. There you go. A nice little tax speed blessing. Oh yeah, where'd the podcast go? I guess we're done with that. Alright, let's check out the next one, I guess. Here we go.
This Sunday marks the 1,000-day anniversary of the Bitcoin cycle. We started way back in November of 2022, and of course here we are, August 2025. Now, it took around 400 days for retail to first start arriving. This was when Bitcoin ETFs were all the hype before they died off, became the hype again, along with the Bitcoin halving that happened last year in April. Then it all died off. Retail came back just for a day or two before we got smashed down again in August of 2024. So 12 months ago. From that point, we had the election, retail came screaming back towards the tops, and of course, the rest is history with the Trump inauguration, massive sell-off, tariffs, and here we are to today with the latest round of retail investors coming into the space. So Sunday is that big anniversary day, looking at 1,000 days since the cycle low for the Bitcoin cycle, and I thought it'd be a good place to talk about what I think is a conservative cycle top target for Bitcoin and Ethereum I'll give you my reasons why. I'll go through some analysis, looking at price targets, using specifically Gann analysis and Fibonacci extensions. Hit the like, subscribe to the channel if you're new here. My hope is that this could be your reasonable sounding board compared to what we see out there in the market. And this comes from billionaires and nine-figure millionaires. We have price targets, price predictions from billionaire Michael Saylor to hit $1 million. Now, this can come at any particular time, and they change all the time. It could be this cycle, it could be 2030. Some of the price targets that are put out there are $21 million for BTC, being a long-term forecast, looking out towards 2046, 21 million price in 21 years. You've also got price targets of 1 million by 2035. Price targets, again, 21 million across all of the news outlets. Kathy Wood, another big name, talking about $2.4 million in a bullish case scenario. So that's in the next 5 years. Bearish case scenario looking somewhere more around 200 to 300,000. But of course, these are the ones that are going to make the headlines, the millions of dollars for BTC. And there's plenty of reasons why we would get to $1 million. Logical reasons, as they would put it. Money printing, supplies running out, halvings coming up, hundreds and hundreds of US companies that are acting as Bitcoin treasury companies holding BTC, getting close to 1 million Bitcoin being held by all of the public companies in the world, as you can see with different flags here. You've also got the president of the United States paving the way for private equity to come out. So crypto in retirement accounts, and there is roughly $12 trillion, according to this article, of money ready to go in those retirement plans. Doesn't mean 12 trillion is going to go into the markets. There is 12 trillion sitting there. On other searches, you could find 30 or 40 trillion, just depending on where they gather that data from, where that money is actually sitting. And of course, Trump also putting up his own public offering for his own token, $1.5 billion, which is another publicly listed World Liberty financial company that he's looking to then raise to then go and buy Bitcoin and possibly other cryptos, like we've seen with his sons and Ethereum over the last few months as well. Speaking of Ethereum, we're talking about Ethereum price targets today as well. Other reasons why there's huge numbers that continue to get thrown out there. $20,000 is ETH preps all-time high in 1 to 2 weeks. Now, this article is the 10th of August. Seems extremely unlikely that we'll get to 20,000, but at this stage of the cycle, which is why I made such a big reference to it at the beginning of the video, we're 1,000 days into this cycle. Come Sunday, 1,000 days. And it took 400 days just for retail to even start to think about BTC, let alone 500-600 days later with the halving, and then of course another 800 or so days later with the Trump inauguration, of course, presidency and so on. So it is that time of the cycle, at least from what I've seen over the last 3 cycles that I've been involved in crypto, that we begin to see these sorts of targets get thrown out there, and the biggest ones usually make the headline. And now we have Tom Lee and all sorts of other guys who are becoming heads of Ethereum treasury companies. So companies that are essentially buying Ethereum. They think they've missed out on Bitcoin, or they have some sort of belief that Ethereum is better than BTC. Maybe it is. But now they're throwing out targets of the likes of $60,000, which is what BitMine has thrown out there. And Tom Lee is the one in charge of all of that. Of course, plenty of reasons why it could happen, other reasons why it couldn't. And to some degree, you could consider these old whales that have been in the game for 10, 15 years, as we know with BTC, maybe they're slightly smart money. I think it's possible, and I'll explain why. Dormant Bitcoin whale moves 350 million after a decade of silence, essentially 30 legacy addresses. They've moved 100 odd BTC from each of the addresses, put them together, and then it's basically been selling this off for 350 million. The other week, we saw 80,000 BTC get sold off through Galaxy Digital. That was the likes of the billions of dollars. And we saw this in the last cycle, not these old legacy addresses, but towards this peak here, this run up when BTC ran into January. There was extreme greed, extreme hype. All of the indicators were flashing around this first boom, in particular the run up in January and then that next top in February, which came in very close when you look at it from a price perspective as opposed to the time perspective. They were selling off. The smart money was selling off through there. There was a lot of volume, and all the indicators were suggesting that the cycle was running pretty quick and seemed to be ahead of schedule. And eventually price came back, and then the time had to catch up until we got to the end of the cycle. So last cycle we had something similar where the smart money was selling out. They're not trying to sell the top dollar. That's typically a game reserved for retail. You could call it dumb money if you want, but retail just tries to always buy the bottom if they can, and they always try to sell the top. And if you get in later, that's cool. It's no big deal. But they try to sell the top. And if you sell too early, they hate you. There's always a lot of comments about it. And they just keep referencing back to any of these sorts of headlines of, Bitcoin's got all these reasons why it has to go to these new, fresh, high prices. And you're an idiot. It's going to go to millions of dollars, so on and so forth. That's typically the game that happens every single cycle. So that's a big one that I wanted to reference and try to explain at the beginning of the video when it comes to market psychology, especially as we run up into these tops. We're going to, I think at least, and of course this is all my opinion when it comes to the video, we see a lot of those types of people that just say that it's impossible, that it's going to go down, and we start to get those narratives building on. So I think we understand that. The next thing to understand is the market caps. So market cap is this one here. 2 trillion is where Bitcoin's at, 2.3 trillion. Ethereum, $500 billion. So $500 billion. XRP, $185 billion. Now, the targets, when you multiply them out with how much supply is there and the target that they're looking at, did some quick numbers. Ethereum at $4,000, as it is right now, $500 billion. If Ethereum's going to be $20,000, it was about $2 trillion. Not impossible, Bitcoin's at $2 trillion. Then you get to $60,000. That is around $7 trillion. And then if you get to Bitcoin's targets of anything in the millions, you're looking at hundreds of trillions of dollars. So this is the multi-millions that we're looking at, like Saylor's targets of $21 million. That's nearly half of the world's supply of money. I have one of my charts here. This is what Saylor is talking about. Like Jack Mullers, I don't even know why people keep referencing him. It makes no sense. Yes, there is US dollar being continually printed, more money out there, but it's weird and silly. The world's total wealth, call it half a quadrillion. So $500 trillion, half a quadrillion. That would mean that a lot of this money would have to find its way just to Bitcoin, something that's only been around for about 16 years. Of course, anything is possible. And once you start piling in all of these narratives, coupled with the emotion that comes along with the narratives, it gets really strong, coupled with price increasing. And we should know that by now with Ethereum. Just over the last couple of months, with that price increasing from 2,500 to nearly 4,500, there's nothing better for a narrative than price going up. And price going up brings in more people, brings in the later to the party, and they need hope to expect higher and higher prices. So I know maybe you came to this video hoping a whole lot of hopium. That's okay. Remember, I'm titling something around a conservative, a realistic outlook for the price targets here for Bitcoin and Ethereum. And hopefully it can just be something a little bit more dull in your basket case of tools that you're using for your trading and investing, as opposed to the hype and the nonsense that is continuously thrown at us day in, day out by billionaires, our president, all that sort of stuff. And I say our because, of course, at the end of the day, US essentially does what they need to do, and the rest of the world somehow follows in those paths. As they say, if the US sneezes, the rest of the world catches a cold. As much as we don't want to believe it, I'm here in Australia, it's the same thing. It happens over and over again. So we have seen an uptick, a huge uptick in retail interest over the last at least few weeks. And then in these last few days, we definitely have seen it getting very close to a new 90-day high. So this is for the Google search volume, search trends. The word Bitcoin has picked up a lot. And now I'm not having a go at anyone if you haven't made it this far in the video, especially if you are new to the game, if you've just started to find Bitcoin, or you've heard about it many, many times before and you think, bloody hell, it's about time that I look into this thing and maybe I do start to buy something. There is a lot of people in that boat. So don't worry if that's you. Hopefully just use this to your advantage. This is getting close to where we were in the July lows, as the market was, the July tops there. And of course we had the August lows from that point. Now, crypto term has also started to pick up, but not as much as what Bitcoin has in the last 90 days. So this is just a check of the narratives and how much interest is driving into the space. 12-month outlook, breaking to new fresh highs again. Bitcoin at 54, breaking past that July top. Let me just check the July figures. There's May, June, a little low here in June, and then we hit that most recent all-time high around that July time. And if we look back over 5 years, we still haven't reached those crazy levels like we saw at some of those extreme peaks and extreme lows. Here's the peak there, November 2024. Of course, that's when Trump got elected. And then so these other extreme peaks, all-time high search volume from May 2021. That was when Bitcoin crashed, and altcoins just put in a all-time high and then also crashed. So you've got these big spikes here from January into that top of around 30,000, February to that top of around 58,000, and then April, which was the all-time high at the time, 65,000, and then the all-time high for that cycle was somewhere around October, November, which barely wasn't surged. So that's another interesting one that we're going to watch as this cycle continues on towards this all-time high price. The fear and greed, still looking greedy out there. Nothing too crazy, so I think there's still further to go here, even if the market does rest. If we're looking short-term, daily stuff, maybe tomorrow, the next day, Bitcoin does pull back, we hit some of those support levels. That's not what this video is about, and I'll update those shorter-term outlooks in a video coming up this week. So by now we have an understanding of how narratives can build up towards the end of the cycle, a bit of an understanding around timing of cycles. They don't have to perform exactly as previous cycles in order to the prices, but we've got an understanding of timing and how far things have gone and what to expect around this time, this stage of the cycle, as I talked about narratives, and we have an understanding of market caps that are absolutely wild targets out there. Gold being 23 trillion, Bitcoin at 2.3 trillion, so 10 times less, and silver down here at 2.1. We also had Ethereum now at half a trillion dollars, 500 billion. So an understanding of market caps and where these price targets can go. Looking at something a little more conservative, we can start to put all these pieces together here. So previous cycles, Bitcoin has never exceeded a cycle previous to it in terms of a percentage. So any of these sorts of targets, absolutely wild if they're to happen in this cycle. I think it's near impossible for that to occur. And as I've talked about, many of those reasons, stack those reasons on this one as well. We have 2,100% in the previous cycle for Bitcoin. So 2021 cycle, 2015 to 2017, we had 12,000%. And of course, the cycle before that, it was going from barely less than a cent, right? Up to $1,200. So it's crazy. 12 million%. I think almost 100% of people would agree that's impossible. 12,000%, I mean, if you talk to those sailors and so on, they think it's possible. I think that's impossible. If we did 12,000%, you're going to look at somewhere around a $1.9 million BTC. Seems relatively impossible this cycle when you start to factor in what market cap you would need for this as well. That's insane. It's in the trillions, and it is more than what gold would be. So I think that's impossible now. Sure, people always have some sort of reason. They've started watching some gold or silver bug, and they just feed themselves all of this gold nonsense, which has been going on for over 50 years, mind you. The gold bug stuff has been going on for a very long time. People catch hold of that narrative and they just can't let it go. They can't see other things that are going on in the world, and they think that's the only way. That's how those narratives continue to build, and Bitcoin might get one of those narratives in its future. Leaving that aside, it's near on impossible for it to get that high, even though gold is up there as well at this point. Yes, there is a shift, but it takes time. So if there is a shift happening, Bitcoin will eventually catch up to gold. Gold will start to slow down where it is, and then over the decades, we will potentially see that. But it's not going to happen in one cycle. The cycle before that, we've got 2,000%. So this is a little closer to where things could go. But even still, if we get to 2,100%, Bitcoin's got to get to $342,000, which is about 2.5 times where it currently is, and 2.5 times the price here, 2.5, 5. It's about nearly 7 trillion for round numbers. So 7 trillion on where gold sits is about a third of gold. So I've got that in a post right here. 6.7 trillion, 23 trillion on gold. Yes, there's going to be more money printed on top of that, but you're sort of hoping at this stage for something that hasn't happened before, and it seems relatively unlikely. That's not the way I like to invest. I don't invest on small chances. I like to invest on within assets that have a pretty strong case of outperforming other assets with a very low risk. And at this stage, as I pointed out, 1,000 days into a move isn't necessarily low risk anymore. We're getting into that high risk phase, and I don't want to be taking high risk trades towards the high risk end of the cycle. Still further upside to go. We haven't completely wiped out the upside, as you'll see with this chart. So you've been hanging in there, hit the like, subscribe to the channel. We've got a sale on TIA indicators as well, as I've looked at in this video. Links to that are in the video description. Okay, the price targets using multiple strategies here. Looking at the swing extensions first. And you've seen me use this before if you have followed the channel. However, I'm going to add in another couple of reasons to this and look to some slightly higher upside. So I want to give you some conservative targets, but also just give one slight hopium target. So broadly speaking, I guess, these are the levels that we're looking at. Look at this white line here, and they are different fib extensions that we've added to the chart using key turning points. Key turning points for the cycle. Pretty significant events happen at those tops and at those lows, and then we use that price range projected off the next turning point of the lows. We also do this to the downside as well to get price targets if we happen to be shorting the market. So that's the use here for the GameSwing Pro. So just to clear it up just for the moment, we're looking at the fib extensions, and we're looking for price clusters. You can see a lot of these lines start to form over the top of each other when we look at the extensions on the moves for this current cycle, plus the entire move, first move from the cycle low to the March top. So we're now adding in a couple more to give us I think, a slightly stronger case to where these price targets could go. So the first major target, there are plenty of targets along the way, all-time high, barring all these other numbers, 123 for the all-time high, 124 for a small 50% extension here. Let's get on with the price clusters. As you can see, one forming here, another forming here. We've got one a little further up, plus I've got one extra one to show. We're looking somewhere in the mid 130s when we average out these prices that are coming in using all of these extensions as you start to see price resistance forming overhead. So this is something that not everyone knows how to use because you're essentially into price discovery now. So we're looking at areas where we would expect mathematically where the markets might look to find some resistance. And so mid 130s is a good one. There's 132, 134, 135.8, so 136, 136.5, and then 136,700. So looking into that mid 130s. If you need a number, call it somewhere around $135,000, $136,000. So I like that as a reasonable area there. And the way I'm going to use this is if we start to get closer to the end of this cycle, looking at the timeframes that we're talking about, usually the cycle goes on for about 1,100 days. And in the cycle of 2011 to 2013, it did take an extra couple of months on top of that to get you out to that next time frame. So if we got to that point and you start to see the price getting rejected at these levels, then that's a good indication that two pieces of analysis are coming together. Price resistance, one that people mostly understand, time resistance, most people don't understand. So that's where we're getting to the end of those cycles. So mid 130s. Next up, I'm looking towards the mid 160s. So if we can slice through this, that's a good sign. If we get rejected, things start to slow down. But yeah, a nice move through that is great. Again, barring the psychological levels like 140K, 150K, let's look to the next price cluster up here around the 160s. We've got 161.5, 164, 165, 168. And many of these extensions are coming into that point there. So there's a lot of repeating or rhyming price ranges coming together in those 160s. And that's what I like to see because we know the market does this time and time again. It runs up in repeats. You just take a look at this as an example. There's plenty of them. Don't have time for it in this video. It's beyond the scope of this. But if you want to learn how this works and how you use it in your trading, TIA Premium, there's a link to that in the video description. Otherwise, you're going to have to trust me with this. So the extension here is this particular one. It runs up to 100%. So we've got an exact repeat of the first move out of the low. Low, high, off the low, ran up and hit the 100% move. Hit it twice actually, and then rejected from that. So that's why these things are super, super important. That's a brief recap of it. So we're looking here towards the mid 160s. Take an average of that, again, look around 165. So two quick, easy numbers, 135, 165. And I said I was going to give you one more. I'm looking towards 180 to 190. These are larger extensions here, looking around 300% extensions of some of the previous moves down here. And the reason for that is we've seen it in the past. I'll throw in another fib. It does start to get a little bit messy, so I'll take a few of these off. And you can see the 2017 cycle ran up to 300%, 58,000. That was those first moves. Like I showed earlier on, that was when the major excitement, we had big money starting to sell out on this first move out. There was far, far less volume. That's all been recorded in history. This move to the highs was way less volume, way less interest than what this one was. And so we saw smart money selling out here and smart money selling out here. 300% of the top of this range came in at around $58,000. So using the same analysis on the last cycle, which we're now projecting out for this cycle, you can see we had some clean hits at 161%. So a nice fib number there as well. You're looking at this entire range and then projecting this move above. If you got to 200%, that would take you to $135,000. So that's a number that we're definitely watching from this point forward. Above that, 261%, another interesting or important fib number, takes you out to around 176,000, very close to 180,000, which were the two numbers that I showed earlier. 180 is also a very important number if you follow Gann analysis, which is half of a cycle, half of a circle being 360 degrees. So 180 is also a super important number there. And then if we're able to just pinch the bags here and shoot up high with all of the hype and the interest that might be building, especially if we break out cleanly from the 7-year resistance level, we've got the next psychological level there of around 200,000, which is the 300% level of the previous cycle. So we've already had a couple of good hits this cycle on this price range, which is why I'm using it. We've got a couple of levels ahead, which are clustering with other price targets around the mid 130s, and like I showed with those in the around the 180s. And then just giving that extra bit of hopium slightly beyond the conservative nature of the video, looking somewhere around $200,000. I think many might not even consider that too conservative, but for the sake of the video, I think looking around that at this stage is potentially good conservative price targets. So what does that mean for Ethereum, sitting now at 4,300? So I've talked about the market caps, how 20,000, 60,000 just seems a little bit out of the realm for this stage of the cycle, considering where the market caps currently sit and how much money is in the entire world and how much money is in the entire crypto space. Can ETH get to the same price as Bitcoin right now in terms of market cap? It could. It's just a very, very big ask to do basically like a 4 or 5x. And if it was to do a 4 or 5x, that would take it to around that 16 to 20,000 US dollars for ETH, which is well beyond what Bitcoin has done in previous cycles. If it does get to the 16,000, it is equal to what Bitcoin did in its second cycle. So coming over to ETH here, 1,800% takes you to about the $16,500 level. So $16,500 ETH. I'm going to start out with a bit of the crazier targets here. So Bitcoin did 2,000 last cycle. That comes up to around the 16,000. I'm also looking at that number based on the multiple returns here. So cycle 1, it did $1,400. Cycle 2, 4,800, which is about a 3.4 times of that entire move. So basically looking at a market cap multiplying by 3.4 times. Of course, there's all the differences with the tokens that are produced and minted with the staking and then burnt as well. So that aside, just looking at something nice and simple, cycle 1, $1,400. There it is right there. Cycle 2, $4,800. And what if we did a 3.4 on your $4,800? That's going to take you to around about 16,300. So that's what we're looking at here. And that is roughly around the same target that Bitcoin did in the previous cycle. So ETH is into its third cycle. Bitcoin's into its, call it roughly around its fourth cycle. And it's possible that we do get to that stage, but it is a long shot. And we're looking at ETH going from around the 500 billion level, somewhere into the $2 trillion level. So as a hopium conservative target, something out to 16 trillion, which is why I don't think 20 trillion is on the cards, why I definitely don't think 20,000, or I definitely don't think 60,000 is on the cards here for ETH. So with those out of the way, what do I think is on the cards? I'm going to give you something to use here. So we'll keep it relatively conservative, starting from the $16,000 to the 16K down. Well, of course, barring the previous all-time high and the $5,000 psychological level, we have a couple of targets to work with, and I want to continue to update this as we get more data coming through for ETH, noting that we may only have a few months left. Maybe this thing goes out till early 2026, meaning the cycle, and we get some quarter one all-time high prices coming in for cryptos, Bitcoin, ETH, and so on. So one that I've shared in the past is around $5,100 to $5,200, which are the current shorter term extensions. These are the moves off this current move. Essentially, these are the price targets off the current moves that ETH has given us. We look at it on a weekly chart. You can see the extensions here. This price number and this price number here projected off that low and that low come in at that number there. So roughly around 5,100. Now, being completely honest, beyond that, there isn't too many price clusters that I can see apart from this significant high here, which is 200% of the previous cycle and a 500% of one of the legs we've just done here. So one of these moves here. That comes in at around 9,600. So just short of $10,000, which doesn't seem out of the question. And it's just, it's a little further than I'd like above the 300% of some of these moves. But these aren't as significant as major cycle moves because these are just shorter term moves, making up of about 1, 2, 3, 4, 5 weeks. So 5 weeks of price action. Same deal with the previous one, making up roughly sort of 6 to 8 weeks of price action. So they're not as longer term, they're not as large as what you see with the previous cycle. So 52, 5,100 is really the target that I'm looking at first up, seeing how the market responds there. I know it's not far away, but you have to understand, you have to appreciate ETH has come from 1,400 to where it is now. That's 200%. So can it do what Bitcoin has done this cycle? That's another big question that I ask myself. Looking at what Bitcoin has done, the low to the current all-time high, it's done 700%. So ETH, what if ETH was to do 700% from its current cycle low? That seems a little bit more realistic at around $7,000. So we've got 5,200, 7,000, and then the numbers here at around $9,500, just short of the psychological 5 figures, $10,000, which you probably start to get a lot of people pointing at, saying it's going to break 5 figures and never look back into the 4 figures, and those sort of narratives might try and build as we get closer to those targets. 5,200 as a round number. Yes, we're going to look at 5,000, 5,100, 52, but 5,200, 7,000, and that's only just because of where Bitcoin has come this cycle. And then looking towards around that $9,500 figure. Now, of course, there's a whole host of other macro factors, traditional finance, everything that's going on in the US at the moment with the bonds and the yields, and where the stock markets currently sit, getting close to all-time highs, the US dollar in its downtrend, and these are all going to have an effect on what happens with crypto. That goes beyond the scope of today's video, so hit the like, subscribe to the channel. Let's continue to follow where these price targets go. If you made it to the end of the video and you found it useful, obviously hit the like button, but share it with a friend, maybe a friend that you care for and you want to see do well in the markets, maybe hit those goals together in the long.
A vast majority of Bitcoin is still held by individuals and still have a majority influence on the potential price action in the upcoming days, weeks, and months. And when that happens, we'll be able to see by looking at the on-chain data that a huge amount of capital is coming in to actually purchase Bitcoin at these lower prices. But so far in this cycle, we haven't really seen this smart money acting very smart. So any week that it's beneath that, you can dollar cost average in like you usually do. Any week where it's above that, you're just saving that capital until we're once again beneath it, and you can again scale in a little bit more aggressively once the market's had a little bit of a pullback. This is very typical, very normal for a Bitcoin bull market. If we look back to 2017, we were having retracements of 30, 40, 50% fairly regularly, and they were coming back and touching this short-term holder realized price level, almost a moving average of support and resistance throughout Bitcoin bull and bear cycles. Based on the previous cycles, based on the diminishing returns we're seeing, my base case is probably somewhere around $170,000 to $180,000. It's something I'm going to hold indefinitely, and anything I do in between now and death is just going to be to accumulate more of it.
Hi, Matt. Thank you so much for being on again.
Robin, thank you very much for having me back. It was great to be on last time. I had a lot of great feedback and a big fan of your channel as well. And especially after catching up quite recently in Vegas and getting to know you in person a little bit, I was excited to come back on.
Awesome. Yeah, really cool. It's so fun to meet people in real life and having that connection there. Because I have a hard time sometimes recognizing people in person when I only saw them on screen. But it was really fun hanging out. I think we also saw each other then on the airport again, or only on the airport. I'm actually not sure. Like Vegas was like one clip for me.
Yeah, the thing is, when I saw you, you're maybe the easiest person I've ever known to spot, because I was walking through the airport and you see someone who's like 2 meters tall and it's like, oh, there's Robin, I'll go say hello.
Yeah, and I sometimes have even my name written on here. That makes it super easy. Yeah. But for the few people that haven't seen you or haven't seen your content, maybe give us some overview of who you are and especially why you're excited about Bitcoin.
Yeah, of course. My name's Matt, and I'm the lead analyst for Bitcoin Magazine Pro. So we're the data and analytics branch of Bitcoin Magazine, who do the publications, but also host all the conferences, do Bitcoin for corporations and that type of thing. So we're just trying to simplify a lot of the data surrounding Bitcoin, specifically in terms of the on-chain and now expanding into kind of macroeconomic data. I think a lot of people kind of get paralysis by analysis. They see that there's 1,000 different charts you can look at. And especially I was the same when I first got into Bitcoin, you're trying to learn everything. It can be pretty confusing. So we're just trying to provide the simplest charts that really you need to know, whether you're just a dollar cost averager, whether you're someone that's just interested in Bitcoin, or maybe you're a bit more of an active market participant. We're just trying to provide charts and data points that can help everyone.
Really, really cool. And I think last time we spoke was like earlier this year, if I had to guess, so like about half a year ago, or maybe a little bit longer than that. What has changed in the current environment, and how is like kind of the market doing, maybe also compared to like half a year ago, and how are things going?
The thing is, to be honest, I think everyone watching this and everyone who's in Bitcoin is seeing these new all-time highs. And it's pretty bizarre because they just feel like an inevitability now. I mean, in previous cycles, if you saw Bitcoin break into new all-time highs, there was just peak euphoria. Everyone was just over the moon. But now it's just like, right, we know that new all-time highs are coming. Everything's pointing in the right direction. So when we hit them, it just feels like an inevitability. I don't know, it doesn't quite have the same excitement. And I'm not sure if, again, that's maybe due to the price action we've seen this cycle. In previous cycles, if you look at the 2017 bull market, you have this big euphoric run up with big volatile swings. Whereas this cycle's been a little bit more, let's be honest, boring, where we've had this long period of choppy sideways consolidation, big explosive move to the upside or the downside, and then another few months of just sideways price action. So in terms of the on-chain data perspective, not a lot has massively changed. I think we're getting a little bit more clarity on how the remainder of this cycle may play out, especially considering correlations to previous cycles and patterns we're seeing in kind of investor behavior when looking at the data. But ultimately, things do look pretty good. It's one of these things where everyone wants to look at these charts every single day and look at what's changing, but a lot of these cycles take months or even years to play out. And so you're seeing the data sign kind of shifting into this more bullish latter stages of the market narrative. But ultimately, things are looking pretty good, and I'm definitely very bullish and positive on the outlook over the coming months.
Yeah, one thing that I've definitely noticed is in the past cycles, there was more of boom and bust, and now it seems to be more like stairways climbing. So it's like, yeah, like a little bit of sideways. Now we're like going up again and just like consolidating. And so I think because we don't have those huge uprises and huge down crashes, and also the market participants are just like very different. We have now the sailors and the BlackRocks of the world into Bitcoin versus the everyday guy that might be more inclined to FOMO in when the price goes up and to panic sell if the price goes down. So it's really interesting for me to compare like this cycle to even last cycle. And I don't know if you see the same thing, but I feel like the boom and bust gets like a little bit more just like climbing and climbing. We are kind of getting away from an exciting new startup tech stock to the S&P 500. I know we're not there yet, but it's like it seems like we move in that direction.
Yeah, 100%. We're seeing this diminishing volatility where institutional inflows, just maybe not as much retail participation either, is just, as you say, kind of dampening these big violent swings we've typically had in price action. And I think that's something that we can maybe talk into a little bit more on this on this podcast, in that a lot of people are saying, is this time different? Because of course we're seeing institutions coming in, Sailor coming in and buying hundreds of thousands of Bitcoin, Metaplanet, etc., all just trying to pile into Bitcoin. Now a lot of people are looking at this supply being accumulated and thinking this might never hit the spot market again, so maybe we're not going to have these big bear cycles like we typically do. Maybe we still see these 30-40% retracements, but maybe Bitcoin now is going to decouple and be this independent asset and go into this big super cycle of multi-years. But looking at the data, again, I don't like to be a bit of a party pooper, but we're not really seeing that just yet. Now, of course, I do think there is a growing influence of institutional participants, and that is changing the supply and demand economics of the network, and we're seeing that in the price section. So I do think that the cycles are going to change going forward. Maybe we're not going to have the same typical 4-year cycle like we historically have done. But if you look at kind of the ETF inflows, for example, I know these aren't specifically just institutions buying and selling when we look at the ETFs, but the correlation between their inflows and outflows and something like the Bitcoin funding rates is actually pretty high. So even though we're seeing more and more smart money, big capital coming into the markets, they're actually behaving kind of similarly to how they have done in previous cycles, because everyone's still susceptible to these big emotions, these periods of euphoria and greed. Everyone still likes to FOMO and everyone capitulates in the bottom, regardless of how big their wallets are. So we do have some data to back that up, which I think could be interesting, because that's probably one of the most talked about points of discussion we're seeing on our channels and social media. Is this time different? Are we going to have this big super cycle? Will I ever be able to buy back in lower?
Yeah, it's always, for me, an interesting question also is for all the people, is 2026 being a down year? Because that's, people always, I know, for example, I'm a lunatic and I just buy Bitcoin. I have 100% in Bitcoin. Like I don't do anything with my Bitcoin. But I know a lot of people, and even my mom asked me, oh, is now a good time to buy? Like, oh, should I wait like half a year? Because I can wait also, because I'm not all in like you. So I hear that from my direct environment, but also in the comments and from people in general. And they're wondering, oh, like how much higher are we going? And especially will 2026 be a down year? For those people that maybe also do lending and all those credit things, it's highly relevant. That's why I don't do it, because I don't want to be dependent on like where the price and the market is going. But I know a lot of people actually do that. This is I think why the super cycle talk is interesting, because if we now have different buyers and sellers in the market and they are more inclined to just buy over the long term or not really sell, does this mean that we are going slower up but more consistent up? So maybe we don't have a 2026 down year, because like I think 2026, if we follow the 4-year cycle like up, down, up, down, and so on, then 2026 would have been a down year. What can you see on that front, and maybe also like how the cycle changed?
Well, yeah, I'll just share a chart here so that we can maybe discuss a little bit. So this is just looking at the current Bitcoin cycle in comparison to the previous cycles. Now, this is one of these things where I like to be pretty boring and just stick entirely to the data. We all have our own personal interpretations and opinions on how things might play out. And if I'm kind of being honest of what I think will happen, but not based on the data, I do see this cycle slightly extending. We have seen diminishing returns in every cycle, and again, expected that trend continue. But if we weren't see lengthening cycles, then this cycle would peak at around October 19th of this year, which would only give us a few months left of this current Bitcoin cycle, just looking at the previous cycles as inspiration. But like I said, I feel like we may be seeing lengthening cycles. If you look at sort of the 2020 to 2021 cycle as the kind of most recent comparison we had this big double top of price action, which kind of caught a lot of investors off guard. I think a lot of people, after we had this first peak and started to run back up against new all-time highs, maybe expecting 100,000. And a lot of the on-chain data points kind of did top out in this first peak, so it did throw a lot of investors off in that regard. But this cycle has actually shown something slightly different to that still. So if I go to the value days destroyed chart here, so this might look a little bit more confusing, but it's actually a fairly simple chart in terms of its calculation. So what this is doing is looking at something called the coin days destroyed. So what this is doing is essentially weighting the velocity of Bitcoin transfers. If you see big whales transferring huge amounts of Bitcoin, this is when we have these huge spikes to the upside. Now, if I was to hold one Bitcoin for 100 days and then transfer it, it'd be 100 coin days destroyed. If I held 0.1 for 1,000 days, it'd be the same. So we're really weighting the profit taking by these long-term experienced Bitcoin holders. Now, what we can see is they typically have a fairly big influence on the Bitcoin price section. They're usually taking profit towards peaks, not necessarily big cycle peaks, but as Bitcoin is having these big euphoric moves to the upside. Now, what we can see in previous cycles, such as the 2020, 2021, like I said before, we almost had this double top as Bitcoin's price action peaked. We had this huge wave of investors taking profit on their positions. And then a little bit later, as we had the second peak, again, a little bit more profit taking. Value days destroyed might not show this as well as some other charts. I'll maybe show a few there, such as the long and short-term holders as well after this. But if we look at this cycle, it's actually been a little different in that we've had this big run up to the upside when we had this ETF announcement when we ran up to about $74,000. And then following that, we had about 6 months or so of just boring, choppy, sideways consolidation. Then we had this first break of 100K. And then again, we had multiple months of Bitcoin retracing, having a little period of drawdown and just a little bit of general capitulation as we retested the previous high. And then now we've again had this big run up to new all-time high. Again, a little bit of profit taking from long-term investors. And potentially now we're going to see this long, drawn-out cycle again. So like you said previously, we're having this almost stair action of price where we're having these big sideways moves, big run up, everyone takes profit. Investors are allowed to recompose themselves, new capital is allowed to flow in, a new foundation, a new baseline is set at whatever that price floor is, and then we have this big step up again. So we've actually seen something recently here. And again, I don't think this is necessarily indicating that we've had this cycle peak already. If we look at something like the 2017 peak, we had lots and lots of these very high spikes on the value days destroyed multiple. But it is indicating that the market cycle has changed and could potentially be stretched out to some extent because we're having these long periods of consolidation where investors can kind of allow themselves to feel like they're getting value for money again. Because if you look at 2017, if you see the Bitcoin price action at $10,000 in a few weeks ago, it's $5,000, you maybe don't think you're getting the best value for money. But especially now if we're seeing institutional investors scaling into the market, regardless of price action, if they're seeing Bitcoin as a portfolio asset where you don't need to hold 1 or 5 or 10 Bitcoin, but you need to hold 1% or 5% of your portfolio in Bitcoin, then suddenly you're going to be scaling in regardless of price action. So that's going to diminish the volatility. And then once we're seeing these big run-ups to the upside in price action, and then price has these very stagnant periods, again, it resets expectations. People aren't thinking, oh, wow, no, I'm not getting value for money anymore because Bitcoin's price action has been 60K for multiple months. They think, well, this probably isn't a bad area to scaling, or price has been 90k for multiple months, or this time it might be 110k for multiple months. And then at that point, people say, yeah, I feel like I'm getting value for money here. So I do see this cycle being different, but that is my personal opinion of what could play out. As I always like to say, just pay attention to the data. If we start seeing warning signals, the market is just purely based on supply and demand economics. If we're seeing lots of people taking profit, if we're seeing lots of people over leveraged, we're seeing retail FOMO into the market, these are the times where you need to be taking profit, or maybe just scaling back your accumulation of Bitcoin because you may not be getting the best risk to reward on that position. But as I said, it's just one of these where if we're at 130k, if we're at 230k, when the signals start flashing, that's when I'm going to be taking action.
Can you explain to me again what VDD is, or like value stays destroyed?
Yes. So as I said previously, it's based on the coin days destroyed. But what we're doing is taking a 30-day average and comparing that to a yearly average. So again, a lot of people look at metrics such as the MVRVZ score. I'll just very quickly pull that up so you can have a comparison. And we'll look to on-chain data and say, maybe it's not going to work so well going forward because we've had these diminishing peaks in the date. So the MVRVZ score, I know I've gone a little bit off topic here, but this is comparing the realized price or realized cap of Bitcoin, which is the average accumulation or cost basis for all investors on the network, to the underlying price of Bitcoin. So what we can see is in the previous cycle, we had a much lower peak than we had done in the previous cycle. So a lot of people may be looking at this metric and thinking, I don't know if on-chain data is going to work so well. So that's why I really like metrics like the value days destroyed, because this is based on a rolling yearly average. So even as the dynamics of the network change, even as we're seeing supply not moving, even as we're seeing institutional accumulation, this metric is going to account for these changes in dynamics. So what this is doing, as I said, is just looking at the coin days destroyed, but then changing that into US dollar terms, and then dividing that 30-day average by a yearly average. So you can almost see on the most recent monthly basis, are people taking considerably more profit than they had done in the previous year.
Well, and what is the coin days destroyed?
So the coin days destroyed, I can just go to the chart quickly here. This is weighting Bitcoin transactions by the amount of time it's been held and the amount of Bitcoin being transacted. So if I transferred one Bitcoin after holding it for 100 days, then that would add 100 coin days destroyed. Recently, we actually had this big whale transfer 80,000 Bitcoin after holding it for just over 14 years. So this obviously had a huge influence on a metric like the coin days destroyed, because we saw a huge amount of Bitcoin being transferred after an extended period of time. So I know I'm going slightly off topic again, but many people may look at the coin days destroyed or something and say this is a huge amount of profit taking by big long-term investors. But I actually have a chart here which is something slightly different. So again, I know I'm going on a bit of a tangent here. When we accumulate all of the coin days destroyed on any given day or any given average, it can be influenced quite strongly by one individual's transaction or one big movement by an exchange or something. So what this is looking at is, rather than the amount of Bitcoin being transferred by whales, it's actually the number of whales transferring Bitcoin. So again, it might be a little harder to see, but when we have these big spikes, it not only indicates that there's a huge amount of Bitcoin being transferred, but it's actually being transferred by a huge amount of Bitcoin whales, to kind of give us some indication that not only is price exceptionally high and we're seeing a lot of Bitcoin moving, but this is the general consensus by a lot of the market's most experienced players. Whereas right now we're actually at a value pretty close to 1. This is a 28-day average of this metric. So we're seeing a lot of Bitcoin being moved on-chain, but this was heavily influenced by certain individuals that maybe warped the data a little bit. So it does take a little bit of personal interpretation, but the value days destroyed, I think, does still give us a really good indication where we could be in a cycle.
Oh, so basically it shows if there's a lot of coins moved that also haven't moved for a long time, then it shows that people are kind of taking profits and kind of moving the things. So if the multiple is very low, so the green area is there, this just means people are holding on to the coins and waiting for like a higher price in the future.
Exactly, yeah. And I know a lot of people say, oh, but these are just coins being transferred on-chain. We don't necessarily know if they're being moved to sell. We don't know if they're being OTC moved or collated in different wallets. And that is true. We don't necessarily know for certain that when coins that haven't been moved in 14 plus years are being moved, that they are being moved to be sold. But generally speaking, we can look at network activity and see a huge increase in old coins being moved towards cycle peaks. And we see a huge diminishing in that value. We see very, very few old coins being moved when we're at bear cycle lows. So even if it's not an exact science, we can say with some degree of certainty that when whales are moving coins and are interested, it's usually as we're approaching a little bit of a local peak in price action.
Is it if coins are moving in general, or do they have to move to an exchange or something?
Just being moved in general. So this is the thing. This is why it's not a perfect science, because we can't say for certain that they're being moved to an exchange. Again, people may be moving coins to an exchange just to stake them and earn some percentage reward or take out loans against them or whatever they may want to do. But this could be Bitcoin being transferred from my wallet to your wallet or something. Just anytime we're seeing Bitcoin being moved on-chain, we're aggregating all of this data when we come up with a lot of these on-chain data points.
Yeah, because I was thinking like I'm in Bitcoin now since, 5 years. And in those 5 years, I've moved all of my coins multiple times as I upgraded my security. I didn't do anything with my coins, just like, first I just bought a ledger. I should have some multi-signature. Oh, this and that. Like, I don't know how many times I moved my entire stack or like part of my stack in different kinds of settings, just because like, I want to increase my stack. But I guess it's still a good indicator because it shows how much activity is there. And if there's a lot of activity and they move it a lot, it shows that, yeah. But it's also interesting how this will change, because as Bitcoin grows in value and it will be a bigger and bigger part of people's portfolios, people might also want to start just spending it and just using the Bitcoin. For example, I have now a spending wallet where like the coins move like every 5th day or something like that. And if this gets more and more popular, it's interesting how this will influence also those metrics. I mean, I guess right now most people just use it to store their wealth and are not, again, a lunatic like me.
Yeah. So, of course, we are seeing kind of, again, a shift in narrative of Bitcoin. But previously, I was just really quickly showing the value days destroyed having a spike at the tail end of the last bear market after the FTX collapse, because, again, a lot of people would have been moving their coins off of centralized exchanges onto ledgers. So, again, there are some instances where we need to kind of interpret the data a little bit more. But in terms of Bitcoin's narrative changing, again, I think this is a great topic to discuss. So I'm just going to, once again, try and share my screen. So when Bitcoin, when the white paper was first written by Satoshi, it was, I always get the exact ordering the wrong way. Was it an electronic peer-to-peer cash system or something like that? Either way, we're seeing less and less Bitcoin actually being used for that. I think the narrative has shifted into a more store of value asset, which makes sense. No one wants to be the next Bitcoin pizza guy who spends $100,000 on a couple of pizzas, or millions of dollars it is these days. So if we look at something like the miner revenue in fees, we can actually see, if I just zoom in here, that the amount of revenue that Bitcoin miners have actually earned in block reward fees, not block reward, in fees in the block from Bitcoin being transferred on chain, we can actually see that this revenue is the lowest it's been since about 2012. So over 13 years ago was how long you have to go back to actually see miners earning as much Bitcoin in revenue than they have today. So I just think, again, this really explains how Bitcoin is changing a little bit. And this is why we can't really just focus on just the on-chain data, because if we're seeing, like we discussed previously, institutions, Sailor, big high net worth individuals accumulating Bitcoin, maybe with no intention of ever taking profit on that, then we need to look at Bitcoin through a slightly different lens. And this is where I think the ETFs have actually been really good for Bitcoin data, because if we just look at the ETF cumulative flows, for example, again, this is the cumulative, if we looked on a day by day, it looks fairly similar to the Bitcoin funding rates. This gives us another lens that we can actually analyze the market through. So previously in 2016, 2017, and the last cycle, we of course had the on-chain data, but if more people are putting their coins on exchanges like Binance or wherever they're trading, then again, we don't necessarily see exactly what those coins are doing. Whereas now with the ETFs, we can look through Bitcoin through the institutional lens, where we can see what do big money players think is upcoming in the Bitcoin price action. If they're heavily accumulating, then there's probably anticipation of higher prices. And if they're starting to offload some of their positions, again, maybe they're anticipating further downside, being a little bit more defensive. So now that we can actually observe and analyze Bitcoin, not through just on-chain data, but looking through institutional or ETF accumulation, as well as that we have derivative data, like I said, funding rates previously have a fairly big correlation, fairly strong correlation with the ETF inflows and outflows. Again, we can look at Bitcoin through this derivative lens. We can look through a macroeconomic lens if we look through something like global liquidity, and along with that we have technical if people are actually just trading based on the price action chart. So there's multiple different lenses we can really analyze the market through, and I think that's when I personally make my best investment decisions, when I see confluence, when I see lots of indicators all pointing towards the same thing. If we're seeing Bitcoin funding rates incredibly high, everyone going very leveraged long, if we're seeing a huge amount of whales taking profit, we're seeing retail FOMOing in, all of these kind of point towards potentially a local peak in price action. And again, I often get a lot of slack because I'm quite open by saying I am going to take profit on my Bitcoin position at some point. I'm going to start selling, not 100%, but just a small portion of my portfolio. I'm going to try and sell so I can reaccumulate at lower prices. But you don't necessarily have to do that. You can just not scale in as aggressively when the market is maybe getting a little bit overheated. Just give yourself a little bit more value for money, a little bit more bang for your buck when the market is potentially a little bit of a discount.
And then right now you're seeing that you might have the chance to buy back lower from here.
Yeah, so we'll go on to kind of what we're currently seeing in the market. So, of course, we broke to new highs of $120,000, and I was kind of a little bit wary of how much higher we could immediately go. So we were seeing the Bitcoin funding rates at fairly elevated prices, the highest sustained funding rates that we'd seen in multiple months, pretty much all of this year, really. And now what these are looking at is the amount of interest, essentially, that perpetual derivatives futures traders are paying just to keep their position open. So on any of our charts, I know I'm just, of course, using Bitcoin Magazine Pro charts, but on any of them, if you want to understand a little bit more, you can just scroll down and get a little bit more insight into how these actually are calculating the logic behind these charts. But we were seeing incredibly elevated funding rates. Again, even though we weren't seeing a huge number of individual whales actually taking profit on their positions, we were seeing metrics like the coin days destroyed getting slightly overheated, and of course that resulted in the value days destroyed giving us slightly overheated levels as well. We looked at something like the short-term holder MVRV, so this is just the average accumulation price or cost basis for new market participants, and then we look at the market value to realized value of that, the realized price to the actual underlying price of Bitcoin. We could again see that this was getting it slightly higher than we had been for a few months. So when we put all of these together, it maybe gives us a little indication the market isn't necessarily due for a big retracement, but potentially a little bit of cool-off time, and we have seen that. We've now had a retracement to around 111,000, I think the local low was recently, and this is pretty typical, pretty normal. All we've done is gone back, retested the previous highs we'd set, and now we're kind of just already seeing a little bit of a strong bounce and reaction to the Bitcoin price action. This is very typical, very normal for a Bitcoin bull market. If we look back to 2017, we were having retracements of 30, 40, 50% fairly regularly, and they were coming back and touching this short-term holder realized price level, almost a moving average of support and resistance throughout Bitcoin bull and bear cycles. So now we're just coming back here, and we're getting pretty close to this realized price. It's obviously trending to the upside as people continue to accumulate above this average. But if this starts to reach about $110,000, if we start to see the funding rates again maybe turning negative or a lot more neutral, we see a decreased amount of profit taking from long-term Bitcoin holders. All of this would kind of point towards the market potentially getting to a point where it's looking much more favorable for some accumulation, much more favorable risk reward for trying to actually buy in once we've got confidence from multiple data points, all saying that maybe this time of consolidation is over and we can actually now continue to hopefully regain new all-time highs.
Interesting. And I guess the question everyone wants to know is like what will be the top this cycle?
I'd love to know.
Where are we ending up this year? It's crazy the speculation on that. I sometimes put out community polls of like, hey, where do you think the price is going to be topping out this year? And from I think like 500, 600K was the highest ones. I mean, they're like crazy ones, but like most of them are the highest ones on the 500K range, and the lowest are like 130. Like we are almost there with 130. I mean, there are of course bears that saying like, oh, it already reached the all-time high. How do you look at that?
So of course, the $1 million question. I'd love to be able to answer and say this is the price we're going to peak at, but honestly, no one truthfully knows this. Like I said previously, if we're starting to see a lot of the data points point towards a market cycle top, whether that price is at $130,000 or $500,000, at that point I will be taking action. But that's a pretty boring answer. A much more exciting answer is to actually give some ideas. So based on the previous cycles, based on the diminishing returns we're seeing, my base case is probably somewhere around $170,000 to $180,000. Now this changes based on the data that we're seeing. If we're seeing a huge amount of profit taking, that was maybe a little bit earlier than expected, then I'd maybe drop that to 150, 160. If we do see a huge amount of accumulation from potentially a Bitcoin strategic reserve, then again, all bets are off. Who knows how high we could go. So I like to think in terms of probabilities. 170, 180 would be my base case. I could see an ultra bull case, but to be honest, I'm seeing this being less and less likely as the cycle progresses, of somewhere around $220,000, $240,000. And again, a more bear case, I guess, of $130,000 to $140,000. You also have to acknowledge that Bitcoin is still very much correlated and influenced by traditional markets. We've seen a pullback in the S&P 500, again, coinciding with Bitcoin having this little bit of retracement. If we were to see a big global recession, a big drawn-out bear market in equities, then Bitcoin is going to struggle. We haven't seen any evidence of a prolonged decoupling where Bitcoin moves as an independent asset, can maybe fulfill its narrative of being a hedge against bad monetary policy, but ultimately, at the minute, it does still look like we are currently acting as a high beta or a high leverage play of US equity markets. So it is still very much a speculative and risk-on asset. If we can continue to see equity markets trend to the upside, then Bitcoin's likely going to do it incredibly well. But we are still, unfortunately, at the whim of what other markets are doing. So it's one of these. It's more just a gut feeling, a more personal interpretation, just looking at certain things on the charts, looking at certain patterns in the data to say around $170,000, $180,000. But yeah, ultimately, no one knows. And if we see the sell signals at 150 or 500, I'll be taking action.
Yeah, so it's more about like seeing all the signals of like, are we moving upwards or downwards? And also, as you pointed out, even if everything points to selling, if there is a big market participant coming in and saying like, I don't like, what happens if all the signals are saying sell and then Apple comes out and says like, oh, we are converting 10% of our cash balance to Bitcoin. I mean, at that point, all the signals all of a sudden change. So Bitcoin is always this it's small enough to be changed by a big player still, even though we came a long way. And if you look back at like 2017, we were like such a small asset. Now we are like trillions of dollars worth. So it's like, we've come a long way. It takes a lot more now to move Bitcoin than like just 5 years ago. 5 years ago, like if Apple would have moved into Bitcoin, I think like it's a straight up line. Now it's, I think, still a straight up line, but it takes now a really big player to actually move Bitcoin and to actually influence the price in the market in there. And it gets more and more unlikely, I would say, that something extraordinary is happening because we already have huge players with BlackRock and Strategy and big other companies in the game. I talked about that, I think, a week ago, something like that, where 2020, it was very big news when Square bought $50 million of Bitcoin. Now, if any company buys $50 million of Bitcoin, nobody cares. It's like it's a normal day. So I think it's interesting. Those tools might actually be like more and more predictable as individual small decision makers actually don't have that big of an influence on the market anymore. How do you look at that?
Yeah, and I totally agree. Of course, if Apple come in and say we're buying 1 million Bitcoin, that's going to change the dynamics to some extent. But like I said previously, the more things change, the more things do typically seem to stay the same. So there's a few different things we'll consider. But first, we'll just look at this chart, which is the realized cap hodl wave. So this is taking into account the realized cap or realized price, like we showed with the MVRVZ score, this price here, the average accumulation price of all Bitcoin on the network, which is around $50,000. The average investor paid around $50,000 for their Bitcoin. But if we go to the realized cap hodl waves, we can look at the percentage influence of different market participants on this price. So this is essentially retail FOMO in action. When we have these very red, warm colors indicating investors in the last 24 hours up to, say, 1 month, this gives an indication of new people coming in and paying considerably more for their Bitcoin than historically was the norm. And again, the market is just supply and demand economics. Even though it's great to see Strategy accumulating all of this Bitcoin, even though it's amazing to see these ETFs pouring billions and billions of dollars in, realistically, still around 80% of all Bitcoin in circulation and active Bitcoin in circulation, so we're accounting for kind of lost coins and stuff as well a little bit there, is still held by everyday participants like you and I. A vast majority of Bitcoin is still held by individuals and still have a majority influence on the potential price action of the upcoming days, weeks, and months. So when we see a huge amount of people rushing into the market, again, good indication that we're potentially getting a little bit overheated. If we are to see Apple or someone start piling into the market and we see this huge influx of retail FOMO, where are Apple buying that Bitcoin from? The only way that they can actually buy 1 million Bitcoin is if there's 1 million Bitcoin willing to be sold by long-term holders who've been holding for multiple years, who are realizing that, hey, maybe this is my exit liquidity. Now that kind of brings me on to the second talking point. If someone wanted to buy $1 million Bitcoin, say a Bitcoin strategic reserve came around as well, Bitcoin is still a relatively small asset. I know we like to say it's huge and it's grown exponentially, which it has from just a few $1 billion to a multi-trillion-dollar asset. But realistically, there is just not that much circulating supply of Bitcoin ready to go around. We are still a fairly illiquid asset. If we just look at the normal hodl waves rather than the realized cap hodl waves, so this is just not looking at the influence on the realized price or the average accumulation price of Bitcoin, but just the percentage of Bitcoin held by different age bands. What we can see is if we move all of them up to, say, the 6 months, so the short-term holders, we can see that there's still only around 20% of Bitcoin that's actually readily to move, that's actually moving on a biannually basis, which just shows us that even though we have seen a huge increase in the Bitcoin market cap and we have matured massively as an asset, there's still not that much liquidity to go around. If someone wanted to buy 1 million Bitcoin, they're going to have a real hard time doing so without causing a huge amount of slippage and seeing the market jump up probably hundreds of thousands of dollars. You can almost see this as well as a rough money multiplier effect. If we're seeing around 80% of Bitcoin not really available, only 20%, then every dollar that goes into the market likely is going to increase the market cap by about $5. So, of course, big investors are aware of this. Smart money aren't just piling in at whatever price, pressing the market buy button. If we are to see further accumulation, which I believe we will from potentially more treasury companies, other companies like Apple potentially putting on their balance sheets, then we are going to see a very positive influence on the Bitcoin price action. But it is likely going to be trickled in and cause, again, even more price action like we've already seen of this kind of long, choppy, sideways consolidation as this price action is scaling in before these big explosive moves to the upside. Again, just diminishing the volatility, taking advantage of these 20, 30, 40% dips. And when that happens, we'll be able to see by looking at the on-chain data that a huge amount of capital is coming in to actually purchase Bitcoin at these lower prices. But so far in this cycle, we haven't really seen this smart money acting very smart. They're still susceptible to the same feelings and emotions that we all are, because all this data is really showing us is the mass psychology of investors just quantified.
it's super interesting to think about that situation of someone in the market, no matter who this is, wants to buy 1 million Bitcoin and they're moving as aggressively as possible. Say, like, there are not a lot of players in general that can even do that at that point. I think Apple and the US are two players that absolutely can do that over time. But it still will be so hard. Because you just described it, and I've never thought about it in particular, because if you have a player that is big and public like Apple and US, like Apple cannot buy for long without someone noticing. Latest at the quarterly calls, like it has to be disclosed. I don't know how long what's the maximum duration they can buy without them having to report it and without them noticing something. That alone is a challenge. I think like the maximum is probably like 3 months, maybe shorter than that. I don't know how the SEC and the Apple things work in that regard, but they cannot do it for a long time. So if there's a big player that really wants to accumulate, they have to say it. They have to say why they're doing it. It will be extremely bullish from a news cycle. And then they're trying to buy a lot of coins. Like Apple does not want to have like 10,000 coins if there's strategy with like 500,000 or like 600,000. So they likely want to be the top dog in the game also with the coins. So that's a super interesting. Like the supply and the demand, like I think if Apple does it, I think I have to have it daily on. It will be super interesting how the supply and demand equation changes and how hard it will be for them to even do that.
Yeah, I mean, like I said previously, these big institutional players aren't looking to buy 10,000 Bitcoin, because what's 10,000 Bitcoin to Apple? If they have trillions of dollars potentially of spare cash, they want to put X percentage of that into Bitcoin. And unfortunately, if that's going to move the market 50%, if they just put 1% of their spare capital into Bitcoin, then it's not really worth it for them. So Bitcoin supply and demand economics actually grow more favorable as price increases. People would think the cheaper it is, the more it's kind of enticing for people to accumulate at a discount. But especially, like we said, for players like Apple, we really need to see Bitcoin at hundreds of thousands of dollars and a multi-trillion dollar asset before they can even really consciously do it without having this huge influence on the market. So it's one of these really bullish things where the more we see the price go up, the more bullish I get, which is kind of counterintuitive. But over a long time scale, over the next kind of 5, 10, 15, 20 years, it's exciting and kind of unimaginable to believe where we could be in a market where every single index fund, every single investor is having 1, 2, 5% of their portfolio into Bitcoin. And suddenly that opens the door to tens of trillions of dollars of inflows. And then again, like when we look at something like the money multiplier effect, this has this massive increase in the market cap far beyond the capital inflows that we've seen.
And it unlocks new capital, which is an interesting equation. We know with players coming in like Saylor, he builds those tools to unlock locked capital, and with a higher price at the same time, you're not only getting more interesting people in from the traditional financial space that build those products to get more money from all the other markets to Bitcoin, but also it gets to be a big liquid market where then all of a sudden the pension funds, the Apples of the world can join and say like, hey, we can buy and sell things in this market without crashing and booming in the market, because Apple doesn't want to be in a situation if they decide to buy 1 million Bitcoin and then sell like 200,000, that they buy, the price shoots up and then they sell. They like you have to so carefully sell to not dunk the market. And we've seen that in 2021, where at that time I think the richest man alive, Elon Musk, bought and then like dunked on Bitcoin, and we literally just like went up and then back to the same point again. And I think now we are way more stable, but maybe we are not stable enough for an Apple player, Apple-like player. I mean, people keep saying like Tesla's already in the game, but I don't know. Like it's a different player. I know Tesla's a huge company. They are fast growing. Like they have really good potential to be an Apple or Facebook or Google of the world. But they're very different from the structure of the management team and from the overall financial structure, because Elon Musk can just decide things at Tesla. Like Apple, Tim Cook is not in control alone of where Apple is going. Even if he wants to buy Bitcoin, and we know that he has Bitcoin in his private portfolio, he said that on interview. But if he wants to do the same thing for Apple, it's not that easy to just like, oh yeah, let's buy it tomorrow. Like that's not happening.
Yeah, I do think, of course, I'll just share some more charts here. We have actually, again, seen kind of this steady shift already. This is looking at the amount of addresses on the Bitcoin network that are holding at least 100 Bitcoin. And we can see that this is continuing to climb to new all-time highs. So clearly we are getting there. We are progressing to this asset, which anyone, regardless of their wealth, is able to scale into without having this huge influence on the underlying price of Bitcoin, which is very promising to see. But one other thing, like we said, maybe Apple isn't quite ready yet, but looking at treasury companies, other treasury companies, we can see that we've already opened the door to hundreds of billions, well, $105 billion worth of capital inflows from public companies already. And this, again, is just continuing to grow. Of course, Strategy is leading the way with nearly 630,000 Bitcoin. But we can see nearly 1 million Bitcoin has been accumulated by these treasury companies in just the past couple of years. And it wouldn't surprise me if in a few years' time, this number is 2, 3, 4+ million Bitcoin accumulated, because again, people are starting to wake up to the Saylor playbook. People are seeing their purchasing power by holding the US dollar or other fiat currencies continuing to diminish. And especially if you're a company that maybe, I don't want to be mean, but maybe isn't succeeding. Realistically, Strategy, of course, they have their underlying software business, but they're a Bitcoin company now. The revenue from their underlying business model is minimal compared to the tens of billions of dollars worth of Bitcoin that they have. And for other treasury companies coming in, this is a really good way to potentially open the door to more liquidity coming in, to higher share prices. People, get excited about a Bitcoin accumulation strategy. And again, we're seeing this through Metaplanet, we're seeing this through the blockchain group, we're seeing this through lots and lots of companies who are now seeing the potential of doing this, again, not just to see their share price massively increase, but especially just to prevent diminishing capital on their balance sheets being held in fiat currencies. So it is interesting to see, and I think Sailor really is opening the door, especially with the new derivative products like the Stretch and Strike and Stride, etc., all coming out and just, really opening the door to the bonds market, and the new SDRC opening the door just to the liquidity market, potentially acting as almost a stable coin for new capital to flow in to accumulate Bitcoin. So it's really exciting to see, and all these new products coming out is just unknown territory. I mean, this is just something we've never seen before, something that hasn't really existed before, and it's great to see all coming out. I will put a little asterisk next to that and say, when we have the inevitable bear market, which is going to come, every market class throughout history has had boom and bust cycles. When we do see this 30, 40, 50, 60% bear market, who knows how all the other treasury companies will survive. I think that's going to be the true test of how committed they are to the Bitcoin playbook, and how much they can actually withstand in terms of drawdown before shareholders start asking questions. But it is interesting to see, and it is interesting to imagine how the supply and dynamics are going to continue to play and evolve throughout the coming years.
The first time I ever made any money, I got myself from that money a watch. And ever since then, I collect timepieces to remember times where I achieved some milestone. That's why I got the Bitcoin 2025 edition when I went to my first ever American Bitcoin conference. So for me, the Bitcoin watches from Coin Vigilante represents the time that we are living in. For every person that wears a Bitcoin watch, I know they are representing sound money to the outside world. Make sure to check out those amazing Coin Vigilante timepieces down in the descriptions. I love those watches so much. I know how big of a hurdle it can be to have self-custody, but it's so freaking important to make that first step. We have to make sure it's as easy and simple as possible. And that's exactly what Bitbox did. Bitbox created the simplest and the easiest hardware wallet to use to get into self-custody. So get yourself a Bitbox down from the link in the description. And when you use code Robin, you even get a 5% discount. The most important thing for your Bitcoin journey is not buying Bitcoin, but it's how to keep them. And yes, you have maybe the right tools, but how do you actually go ahead and stick it all together so it's the most secure for you personally? Self-custody is a deeply personalized journey, and the Bitcoin way is helping you exactly finding that correct setup for you personally. They're also helping you with securing your own cybersecurity. And if you want to go one step above all that, you can even get a consultation for a Plan B residency. Go to thebitcoinway.com/Robin and you will get a 30-minute free consultation. I want to tell you about something very special to me. It's called micro seed. If you hold your Bitcoin in self-custody, and you should, you know how critical it is to secure your seed phrase. You should not have them on paper. You should not have them on anything else than titanium. With micro seed, you can engrave your 12 or 24 word seed phrase, the entire seed phrase, onto a 1-inch small washer. Yes, just one washer. All 24 words on that one washer. You can have a IO and maybe even.
So, I mean, we're seeing, if we look at something like the address is holding 100 BTC increasing, that's obviously something we can track in real time. But realistically, all of these treasury companies are accumulating and holding through centralized custodians like Coinbase. So it's not like we can see every single transaction happening and the underlying ledger of how much Bitcoin is actually being held by Strategy and what their addresses are. That data just isn't publicly available yet. But we are seeing the spot markets being shifted by this continued accumulation. We are seeing the circulating supply, not the actual circulating supply, the circulating supply that is available for people to accumulate when looking at something like the hodl waves continuing to diminish. So we are seeing the effects of this happening. And like I said, this is actually great because everyone points towards on-chain data potentially breaking and becoming less useful going forward because of this accumulation. But if you look back to 2016, 2017, when 70% of all volume was happening on centralized exchanges like Binance, it's not like we could really see what was happening there, but you look towards the on-chain data and it still worked incredibly well. It's almost like a census. If you're trying to gain some insights into how many people watch a certain TV show, how many people listen to a certain radio channel, you don't have to ask every single person in the country. You only have to ask a select few thousand, and suddenly that gives you enough kind of insight into what's happening. So we don't have to know exactly what every single investor is doing, but if we can see a general trend that majority of the network's active users are beginning to take profit or beginning to accumulate, then we can really start to take action on that. So I think it's very promising that we're seeing this kind of shift in dynamics. Like I said, it gives us another point of confluence that we can see. But realistically, all of these coins being put onto Coinbase potentially opens the argument of paper Bitcoin being transferred and all of the Bitcoin being accumulated by these ETFs. Are they ever really hitting the open market again, or are they just keeping their own centralized ledger internally? Again, who knows? We can speculate and we can talk controversies, but ultimately, I think, regardless of all of that, the data is still being very clear and obvious, and it is still showing us exactly how the market is actually evolving.
That's all super interesting. It's one thing that came to my mind. Maybe it's like a little bit off topic, but I know people are super interested in that too. When you saw how many addresses have like 100 Bitcoin or more, what does it actually take to be in the top % of Bitcoiners? Have you looked into that, of like seeing like, okay, if you wanna because the stacking goals are really popular and people are like, oh, I want to get to X amount of sats. Do you have something to show of like how many Satoshis, how many Bitcoin, whatever the thing is, to get in the top 1, top 5, top 10, whatever percentage of Bitcoin hodlers? I mean, of course, this changes over time as Bitcoin gets more mainstream, but do you have something like that?
Good question. No, we actually don't. So I'm actually just cheating and looking this up now. So to be in the top 1%, you'd need to be somewhere around, it's a pretty wide range of 1 to 10 Bitcoin. But if you're holding at least 1 Bitcoin, you're in the top, 2%, let's say. So again, I think this is a thing that a lot of people historically have really focused on, is I need to accumulate 1 Bitcoin. And I think for everyday retail investors, that is great. I do think that is a good goal to have, because eventually 1 Bitcoin potentially could be your entire retirement plan. But a lot of the new market participants are coming in and having this narrative shift into a portfolio asset saying, I don't need to have 10,000 Bitcoin, I need to have 10% in Bitcoin. So again, if you have someone who gets paid in fiat currencies, it can make sense to just dollar cost average in and just hold X% of your position in Bitcoin. As much as I hold 100% in Bitcoin, I wouldn't suggest it for the everyday investor. I think that there's certain people that have a risk tolerance that's a little bit tamer than ours, we'll say. And again, especially if you're a little bit later in life and you wanting to maybe have a little bit more of a steady retirement plan without big 50, 60% drawdowns, then maybe you don't want to go 100%. But we can see by the data that holding X percentage of Bitcoin massively increases your performance. And it doesn't have to be a huge amount. Even if you're just dipping your toes into the water, 1% of Bitcoin can massively outperform a 60-40 portfolio of equities and bonds if the rest was just in cash historically. So it's unbelievable the outperformance you can get from holding Bitcoin as an asset. And especially if you want to take that step further, there are assets like strategy and their derivative products as well, which can offer slightly different exposure to the market. So there's lots and lots of different avenues you can take. I don't necessarily think that just focusing on X Bitcoin is the right approach, but of course, you do you. I just think it's great that people are trying to actively learn more about how to preserve their wealth and try and accumulate more wealth through Bitcoin, through these products, rather than just historically, being taught, put everything in the S&P, let it do its thing, or, don't really acknowledge the detrimental impacts of the inflation rate increasing and the decreasing purchasing power we're seeing, year on year. So in general, I think it's a good thing. But yeah, back to the original question in terms of the percentage to actually reach certain thresholds, I can't see. And the reason we actually don't have that is it's a slightly warped metric, we'll say, because someone could have 100 Bitcoin but keep them in 0.5 BTC wallets and have just a couple hundred of them. So it's impossible to really aggregate all of that and understand exactly how much Bitcoin every investor has, because anyone can create a wallet and just add, a few Satoshis to it. But ultimately, just do what you can do within your risk tolerance. Understand that we are going to have these boom and bust cycles.
Yeah, I think it's a good way to look at it. And it's also those, like, if you look in the history of, like, let's go back 10 years and someone would have said, oh, you need to reach like 50 Bitcoin or like 20 Bitcoin. And that would have been probably great advice like 10 years ago and probably achievable 10 years ago. But the even better advice is like study Bitcoin as hard as possible. And then once you understand it and you're convicted about it, go balls deep. I think that is probably even the better thing, because maybe then 10 years ago you wouldn't have bought 20 Bitcoin, which is an amazing amount, which is like probably more than most people will ever have. But if you would have actually studied Bitcoin deeply, actually made your conviction and actually pointed to like what else would I hold outside of Bitcoin, maybe you would have bought 100, 200, maybe 1,000 Bitcoin. I have no clue what the price was in 2015, but I guess even like 1,000 Bitcoin was back then kind of reachable. So it is interesting to think about those strategies of like, oh, get to X amount of Bitcoin. I'm like, yeah, get there. And then don't stop. Keep going. You keep going. I always regretted not buying more early on. And I think almost everyone does.
Yeah, I was going to say, who doesn't?
who doesn't? So yeah, but yeah, I think one Bitcoin is an interesting goal nowadays because it's still achievable. I would guess for most of my audience, they either have that or it might be achievable. It's always like hard to say, but like I think it's like one Bitcoin is still for the Western civilization, and I know like most audiences from America, UK, Canada, Australia, Europe. For most, it is achievable, and I know that because if you look at the average wealth a person has in those countries, it's over 100K. So if you really are convicted of Bitcoin and you have a house, you have this and that, like you could go balls deep into Bitcoin, sell everything, and you could reach that one Bitcoin. That's why I'm saying, like, if you go balls deep and if you really think, you could actually go ahead and do that. But I think most people are not prepared to sacrifice so much just to get to one Bitcoin.
Yeah, I mean, we actually have the data of how many wallets there are holding one Bitcoin. And again, I said it's not a perfect data point because you could hold 0.5 Bitcoin in your own wallet, 0.5 on a centralized exchange or in ETF or other products. So it's not an exact science, but we can see it's actually been diminishing over the past few months, potentially due to the ETFs and other avenues for people to gain exposure to the market. But it's somewhere around 1 million different wallets holding one Bitcoin. So it's, definitely achievable, but I don't think it's going to be achievable for too much longer for a vast majority of people. But one other data point I think has been really interesting because a lot of people say to me, if we do see the super cycle, we're never going to see this big drawdowns, we're never going to have the opportunity to buy back in lower. I think a lot of people are worried that if they do take profit on even a small portion of their Bitcoin, that might be Bitcoin that they can never reasonably regain, that they can never accumulate again because the price is going to continue to accelerate away from them. So as I said, if you don't want to sell your Bitcoin, you don't have to sell your Bitcoin. That's great. You do you. However, I've done some analysis in this. So what this is showing us is, on this chart, it is the percentage probability of being able to buy Bitcoin back at a lower price. So to actually just take this into account, I did this analysis at the tail end of the previous bear market, and I looked at any day we were above the 1 year moving average of Bitcoin. So this is the red line here. So literally just the 365 day. If you sold on any day throughout Bitcoin's entire history above the 1 year moving average, you had a 50-50 chance of being able to buy back in 39.5% lower. So of course, that might not happen this cycle. We can see in the screenshot here, in the last cycle, we had nearly a 78% drawdown. If we are seeing diminishing volatility, that might only be 40, 50, 60% in the next cycle. But there is always going to be boom and bust cycles. And the fact that it was basically a coin flip chance of being able to buy back in 40% lower. And again, this is just any day above the 365 day moving average. You could have sold, it's a bit off the chart here, but down here, kind of $10,000. And of course, you wouldn't have had the opportunity. But it's taking into account every single day of Bitcoin's history, you had a 50-50 chance if you sold above the 1 year moving average. Now, if you take into account the other data points we have to really see when the market's getting overheated, to see when retail are FOMOing in, to see when long-term whales with huge amounts of Bitcoin are beginning to take some profit, to see when the institutions are maybe getting a bit ahead of themselves, see when people are over leveraged and you can start taking profit to these upper regions towards
a bull market, again, you don't have to be perfect. And everyone likes to think, oh, I'm just going to sell 100% right at the peak. That's pretty much impossible to do. Everyone advises dollar cost averaging in or scaling into your positions. Just do the same for getting out of your positions. Dollar cost average out. Start to scale out, take some profit gradually as Bitcoin's price is moving higher to lock in as high a price as you can. And there's a decent chance, if you can time the market even semi-well, that you're going to have a really good opportunity to buy back in, potentially at significantly lower prices. Now, this is just on Bitcoin. I actually did the analysis as well on the altcoin market, excluding stablecoins. This is the ticker on TradingView Total 2 ES. And this isn't even selling above the 1 year moving average. This is any day, throughout any day of altcoins history, you had a 50-50 chance of selling and being able to buy back 48.4% lower. So if you can time the market with any reasonable degree of accuracy, you have a very, very decent opportunity to, again, scale back in and accumulate more Bitcoin. Because to me, the only thing better than Bitcoin is more Bitcoin. So I'm going to do everything in my power to just scale out a few percentage of my total portfolio, my total position, to accumulate back in at low prices. And the data point towards that being, a realistic opportunity and a realistic probability. Now, I don't think we're always going to have this opportunity. As Bitcoin grows as an asset class, as we surpass gold's market cap and we're at tens of trillions of dollars in market cap, maybe we don't have these big, massive, volatile swings of 80% to the downside. Maybe we only see these 20% drawdowns like we see in traditional markets or indexes like the S&P 500. And at that point, it's going to be incredibly difficult to try and time the market to any extent. So I think now is really the opportunity. We probably only have a cycle or two left where we can really rely on these metrics to massively actually outperform just blind dollar cost averaging or blind holding. And again, if you want to do that, that's absolutely fine. But for me and a lot of the investors and people that use our charts and use our data points to try and actually understand the market a little bit better, the data actually points towards it being genuinely probable that you can actually outperform people by just focusing on the data and excluding your own personal emotion and biases when it comes to buying and selling Bitcoin.
Makes a lot of sense. Super interesting because it's the chances of buying back low and my dad, for example, does that actually. He tries it always, like he holds, I think, like around 90% of his Bitcoin, and then like with 10% he kind of tries to like buy back low and like buy back in and stuff like that. And I always argue with him because like I'm just like he has maybe like more time, but like I'm just really focused on the podcast, and every other time just goes into like family and friends. So I don't want to kind of like really use my time to see all those metrics, but maybe it's not even looking at a lot of metrics, because you're looking maybe at like, I don't know, 4 or 5 charts and seeing like, oh yeah, like all of them say like, oh, now it's like really overheated and I might should take off a little bit. Oh, maybe no, it's like a little bit up. So maybe now I can go a little bit heavy on things. I don't know. I still feel like if I look back of my 5 years, I probably would have with your strategy more Bitcoin now. Like, especially because at some point the waiting period of in Austria was like, if you hold it longer than a year, you can take advantage of like doing it tax free, because like taxes also with selling a discussion. And people always get very weary with like spending Bitcoin, because then you're like, oh shit, I have to pay taxes. And I think one thing that Bitcoiners hate more than anything is paying taxes. I got to know.
Yep.
So that's a big thing also. And I just, I don't know. I know that's probably a good strategy, and still like, I'll just stick with my buying Bitcoin at any time.
As I said, there's no right or wrong answer. In a year or two's time, I might have completely mistimed everything, and failed, and I'm not going to be able to reaccumulate as much Bitcoin as I previously had. But this is risk and reward, it's investing. No one knows exactly what's going to happen. We're working on probabilities. But just to quickly give one last point potentially, is I mentioned this before, was potentially strategically dollar cost averaging in. So I'll explain the strategy a little bit afterwards on how this is actually based. But this is looking at a baseline comparison of just dollar cost averaging in 4 years ago into Bitcoin. So the starting price being just under $44,000. So a decent amount. And if you dollar cost averaging this was $10 a week, that would have turned into about $5,860 4 years later. So definitely not bad returns. If you just lump sum bought, it would have actually been a little bit lower than that. You've actually underperformed dollar cost averaging in, because you're not scaling in as the market actually goes in a downtrend and into a bear market. But if you were able to strategically dollar cost average into the market, you'd have actually invested less. The total invested returns, I think we're here, $2,090. It's refreshed, so it's not showing exactly. So you'd have actually invested a little bit less because you haven't invested fully, because there were times when you were potentially waiting for a dip or a discount of Bitcoin. And by doing this strategic dollar cost averaging, you'd have actually returned about $8,000. And this strategy was incredibly simple. All it was looking at was the short-term holder MVRV, again, a chart we've already looked at. And it was just not buying when the short-term holder MVRV was above 1.2. So any week that it's beneath that, you can dollar cost average in like you usually do. Any week where it's above that, you're just saving that capital until we're once again beneath it, and you can again scale in a little bit more aggressively once the market's had a little bit of a pullback. So literally just looking at when the market is at its most overheated moments, and just not dollar cost averaging at those points, doing the strategic dollar cost averaging, you've actually outperformed, again, blind dollar cost averaging in, or lump sum investing into the market. So whatever you want to do as an investor, there's no right or wrong answer. It doesn't matter if you're wanting to buy and sell actively, or you're an intraday trader. I know, like you said before, there's 1,000,001 different charts. Realistically, I'm only going to be focusing on about 5 or 6 throughout my remainder of this cycle when it comes to trying to time out my distribution and profit taking into the cycle. But there's charts for people who are looking on a multi-cycle basis, charts for people looking on an intraday basis for more frequent trading. Whatever it is you're trying to do, I think you can just look at the data and leverage it to your advantage, just to suit however your Bitcoin thesis is, and to really accommodate for your accumulation or profit taking strategy.
Is the chart that you just showed us the most important for you? Is like that's like, if you only look at one, is that the one you would have looked?
Again, I try to keep everything simple when I do these types of analysis. If you would have looked for confluence and looked at not just the short-term hold or MVRV, but alongside that something like the funding rates or something like the realized cap order waves, I'm sure you could have outperformed even further. But I don't like to do any overfitting when it comes to these type of analysis. I don't want to say, oh, well, if you'd have done these exact 4 charts historically, because realistically, half of them might not work indefinitely going forward. So I'm sure you could do this analysis with 1 or 5 different charts combined or individually and potentially come up with similar results. This was just one very simple explanation. But again, I think one that's probably a decent one as a starting point, because it is really obvious to see when new market participants have had X% profit of unrealized gains, that maybe the market is getting a little bit overheated because it's just investor emotion, investor psychology. When everyone starts taking screenshots on their crypto exchange account or choosing what Lamborghini they should have bought or messaging their friends and saying, oh, I told you should have bought, usually that happens when short-term holders are reaching 20, 30, 40% profit. At that point, historically, we can see the market's a little bit overheated when that happens. So just don't accumulate during those times. Accumulate when everyone's, damn, I really should have taken profit there, or yeah, maybe I shouldn't have been so cocky and egotistical when I was telling everyone that before. Just wait until we've got a little bit of discount again, and again, you get a little bit more bang for your buck.
And I see it all the time. I've seen it, and I'm so frustrated about that actually with friends and families where they got into Bitcoin, they made some profits, and they sold. And you're like, oh wow, like thank you for the Bitcoin thing. And I'm like, yeah, like you still hold it. I'm like, no, I sold it. It was like 40% profits. That's amazing. I'm like, yeah, like, that's amazing. But what if you just held through it, or like just DC hit all the way? And otherwise, they put the money in and then sold and bought some shit for that. And I'm like, is that all retail does? is that the average retail mind? I'm glad the institutions are here now. That's like, if that's the average pleb out there, like we are screwed. And I'm trying my best to like really promote like long-term viewing, like DCA, like be strategic about it, be good with it. And even if you do a strategic DCA, or like you do a DCA, or you do lump sum buying, like the main point I was always trying to do, be as long as possible in the market. Like that's the main thing. Like in any of those charts that you just showed, no matter what strategy, if you hold Bitcoin, that's the game. make sure you hold on to your Bitcoin and don't mess it up with like losing losing access to it, or like getting hacked, or selling it to buy some shit. Like if you're selling it, make it for an investment case, or like for you to like get back into Bitcoin at lower prices, but not like to sell Bitcoin to just buy some leather jacket.
Yeah, exactly. Yeah, I'm the same. And as I said, there's if I'm proven wrong, if I start taking profit on Bitcoin and we rally 2, 3, 4 times higher than when I started taking profit, so be it. But as I said, I'm not selling everything. This is a small portion of my portfolio that I'm willing to have a little bit of risk for higher reward on. But again, back to your point, holding Bitcoin till today, throughout any point of history, has been 99.6% profitable, which is very difficult to outperform. So of course, this is the best way to actually be in Bitcoin, just to hold Bitcoin. It doesn't matter if you're dollar cost averaging or lump sum in. I know when I first got in, it was down here, and then I ended up buying the top and selling the bottom like most people typically do. But after that, when you kind of realize what Bitcoin is and the potential that it provides for monetary preservation going forward, and individual freedom when it comes to censorship resistant money, it's amazing to just have this opportunity. And I think everyone, again, regardless of what your thoughts are, should always have at least some exposure to the market, because really there's nothing else quite like Bitcoin. There's imitations, there's other altcoins which always promise to be something better but never are. But realistically, there's one, there only ever has been, and there only ever will be one Bitcoin. And yeah, it's something I'm going to hold indefinitely. And anything I do in between now and death is just going to be to accumulate more of it.
I love that. And one more thing I wanted to talk with you. You brought it up beforehand, and I actually wasn't aware of that. The Elon comments on X, and I found it, and I just want to show it to people quickly. So now it's the time for me to finally share my screen. Let's do that. And he basically asked, I think here it shows it nicely. He basically asked Grok, estimate the probability of quantum computing cracking SHA-256. And Grok basically said it's a near 0% chance in the next 5 years, and under 10% chance in the next 10 years till 2035. So, and he explains like why and all those things. But the main thing is like, it's highly unlikely that it is a problem anytime soon, but it might be a problem down the road. So as Bitcoiners are, they're very careful with like what to do with the Bitcoin, and like how to make sure Bitcoin is an asset not just for the next 10 years, but for the next 100, potentially for the next 1,000 years. How do you look at quantum computers, and what challenges comes with that?
At some point, we are going to have to move to a new encryption method. We're going to have to move away from SHA-256 and go to something quantum resistant. At some point, we are going to see Satoshi's million coins move, and at that point, we're potentially going to have to say people need to migrate to the new quantum resistant Bitcoin and have a 2-year grace period. This is the thing, it's crazy to imagine what the future may hold, because quantum computing is of course just one element of this. We're seeing the halving reduce the block reward of Bitcoin by 50% every 4 years, and we're seeing alongside that the miner revenue from fees continue to diminish as layer 2 solutions like Lightning Network continue to grow. So at some point, is there growing incentive for miners to continue to secure the blockchain if there isn't the monetary reward for doing so? And alongside the quantum issue, there's many other things that Bitcoiners need to be aware of that, again, this isn't something that is going to be a real issue for multiple decades probably, but I think Bitcoin, we really should look at it as you said, a 100-year asset or a 1,000-year asset, rather than people currently looking, oh yeah, but it's great to see ETF accumulating these smart monies, these big capital buys going and pumping out bags. Yeah, this is great, but ultimately is this beneficial for the long-term probability of Bitcoin's success? It's arguable. I think quantum computing, it's one of those difficult ones where there's not an ideal solution yet. But again, I'm not the first one to say this. Once quantum computing has actually reached that level of computational power. Bitcoin isn't going to be the first thing these nefarious actors are going to be cracking. They're going to be cracking banks, traditional banking systems, nuclear launch codes. Pretty much every other encrypted data in the world is probably more favorable for people to, actually try and crack than Bitcoin is. Because ultimately, if you broke Bitcoin, then you're probably going to see the Bitcoin price tumble catastrophically, which doesn't really give any financial incentive. If you look from a game theory perspective, it'd be much more favorable to accumulate Bitcoin as much as you could and then start breaking the traditional banking system and require everyone to flood into Bitcoin. So there's a few things to consider. It's a really interesting thing. Like I said, it's nothing that we really need to worry about for a few years or decades even. But there's a few little things in Bitcoin that we really need to start thinking about. And another one just being the unit of BTC. At some point, one Bitcoin is probably just going to be unobtainable for a vast majority of the world. Do we start talking in sats, or do we start talking in bits, or do we come up with a smaller denomination that's just the new standard? There's a few different psychological, technical, monetary factors that still need to be considered, but Bitcoin is a software. It's a growing organism. It's not something that was made, 15 years ago and is now just existing. Every single day, Bitcoin gets better. People are developing Bitcoin. It is a piece of software that's going to adapt and evolve and become whatever we need Bitcoin to be. If there's a new mechanism or a new privacy solution on a different cryptocurrency, great, that can act as a testnet. Bitcoin can adopt that in a few years. We have an even better Bitcoin. Every single day that Bitcoin exists, its probability of surviving indefinitely increases exponentially. And I truly believe that. So as much as there are things that we need to start thinking about, hopefully there's people a lot smarter than me out there that are coming up with better solutions than I have. And we are going to see Bitcoin far outlive all of us.
Interesting, yeah. If you look at and this is something that I'm really a little bit concerned about. I think, first of all, before we start, I think Bitcoin will outgrow all of us, and I think Bitcoin will be the future money for the next hundreds of the next thousands, maybe potentially next tens of thousands of years, even though it's very hard to look that far ahead. And I'm just really looking forward to the discussions in the community of how to implement that, because I think there's nobody saying we should stay on SHA-256 if there is technology to break that. I think nobody will argue for that. It will be a stupid argument to make, but there will become a lot of different arguments of oh, okay, we are doing an upgrade, so how should we implement that? What is the best solution for that? And I know there are already proposals out there, and there's a few potentials that we could already do, but the closer and closer we come to that reality, there will come hundreds of proposals out there. And my only concern right now is that the community is completely split upon maybe 2 or 3 favorites that we can go towards, maybe even only 2 that we're oh, do we do this or that? And this is the only thing where I see a little bit of a potential challenge, that the community is so split apart. 2 different things. I don't know, Michael Saylor wants that, Cypherdine wants that, Robert Breedlove wants that, and Natalie Brunel wants that. We have basically 2 big camps with popular exchanges. River wants that, Swan does that. Mining companies are split. This is where it could be interesting, but again, the Bitcoin users decide, and at the end of the day, there will be one solution that will win out. It will just be one very, very interesting time to observe the Bitcoin network. I think that's where I want to get to.
100%. And I mean, it's not something new. We had this with the block size wars with Bitcoin Cash and Bitcoin Satoshi Vision. And this is why Bitcoin's great, because you can spin up a node and you can vote and you can support the blockchain that you believe to be the real Bitcoin. And then whatever the general consensus is, that's the real Bitcoin. This is a true democracy of software and monetary evolution, in that it doesn't matter if one person thinks one thing and one person thinks another thing. Realistically, we all supposedly have, well, I say supposedly, other people can, I guess, spin up lots of nodes and potentially sway things, but realistically, we all have an equal amount of voting power to decide what we want Bitcoin to be. And I think a lot of people are looking at Bitcoin through a 2-dimensional lens of how much wealth can I accumulate through Bitcoin, what can it buy me? But again, this is missing the greater good and the bigger point of Bitcoin, in that this is a technological and fiscal revolution that we can actually decide on. That we don't have to rely on the higher ups, the bankers and the politicians to actually decide what the future of the asset will be. This is something we can all collectively agree on to be the best solution and implement that with our own free will.
I 100% agree. It will be really fun to see. I'm already looking forward to the discussions. I'll probably host debates at that point. It will be a really fun time, at least for me as a podcaster and commentary. Thank you so much, Matt. Before we get to the end routine, we have one question that I asked each and every one of my returning guests, and you have been on before. And so the question is, what have you learned outside of Bitcoin since your last appearance?
Wow, that's a good question. I remember last time you asked me for a question for the next podcast guest.
That's still on. But that's a new. This is just a question for all the returning guests.
Okay, that is a good question. One thing I've learned outside of Bitcoin since my last appearance. I kind of wish you'd have asked me this before. It seems like such a simple question when you sat here after having talked for an hour straight.
I'm telling you, 80% or 90% of my guests are pausing for the first time ever in the podcast for that one question, and it's super fun to see, because all the questions that I'm asking are kind of tailored or influenced by my guest, of course. Why should I ask something that my guest doesn't even want to talk about, or doesn't have any experience or skills in that field? So obviously the whole podcast, and I see that because it's I edit the podcast, and there's the line, and Riverside automatically cuts out the pieces where people take a long break. And there's always, like in 95% of my podcast, it's always a long break right before, right after I ask the question. So if I just see the podcast, I know exactly where I ask the question, because almost everyone is like, oh wait, outside of Bitcoin, like my life, and I'm the same. And it's super fun because I asked the question so many times, and I recently was asked the question on another podcast, and he asked me, and I'm like, yeah, shit, like I don't even know where to begin, because everything evolves around Bitcoin. I mean, I could talk about the podcast, and you probably can also talk about creating content and creating charts in general, and creating all those things and life, and people also talk about like the family and all those things, but like all of my life revolves around Bitcoin, and there's a little bit of family, a little bit of girlfriend, there's a little bit of friends, there's a little bit of trying new things, like learning new languages. I'm trying to learn Hindi for my girlfriend, obviously. But yeah, it's just like a super hard question, and I love that I started that because it makes my guests think so, and I like to.
I think we actually very briefly had a discussion about it in Vegas, where I said that I felt unconsciously competent talking about Bitcoin, in that if you ask me something, I mean, I've been traveling a lot the past few days. I've not looked at any of these charts or the price action or anything, but I feel like I can just kind of, off the top of my head, kind of generally know what I'm talking about. But then you ask something like that. So I would say since the last time I was on, I have actually gotten engaged to my now fiance. So I've learned how bloody expensive and difficult it is to plan a wedding.
Yeah, I can imagine it's pretty expensive. Like I was at a wedding recently from a friend of mine. It was a super small wedding, like just like 20, 25 people. And he told me what it cost. And I'm like, wait, okay, it costs that much for like 25 people. How freaking expensive is it if you have like 100 people, 200 people, 500 people there? So yeah, it's something I'm not looking forward to spending on, but maybe something that you remember the rest of your life, and it has something deep and meaningful. Yeah, but yeah, really cool. Thank you so much for sharing that with us. As you know, we have the end routine now, where the previous guest is asking a question for the next guest without knowing who the next guest actually is. And the question is, what is the biggest change that Bitcoin will bring outside of money? So what are kind of the secondary effects to Bitcoin that people might not think about?
I think we're already kind of seeing a certain level of censorship on the internet. I mean, I'm from the UK, so we're already seeing I have to upload pictures of my ID and everything just to watch certain YouTube videos or listen to music on Spotify. So I think at some point people are going to not just look at Bitcoin as a speculative asset, but when they actually understand the freedom and potential of censorship-resistant money, that's going to be truly explosive in terms of the understanding and appreciation from the general public. When people start having transactions blocked, when people have a social credit score and suddenly now they can't go on holiday or buy a certain thing because their credit was too low or they weren't a good citizen, suddenly then Bitcoin's popularity is going to go absolutely exponential when people realize that there is this censorship resistant money that's been around for potentially decades at this point, that anyone can buy and use, and there's no discrimination. You can send anywhere in the world practically instantly and free. At that point, Bitcoin really does win.
I love that. And it is something, if it's so second nature that everyone just uses it, then we really have won. And I said that on my podcast. That's the reason why my podcast is not called, I don't know, the Bitcoin podcast or anything like that with Bitcoin, because I know Bitcoin will be boring, and I know I want to do podcasting all my life. I'm 26 years now. If I get to live to 90 years old, I will still podcast with 90 years old. And I know probably it will be super boring to talk about Bitcoin when I'm 90 years old. I'm probably talking about something different in those days. But maybe I'm the Peter Schiff of Bitcoin, and I'm just keep talking about it. But yeah, thank you so much, Matt, for being on, and thank you so much. Before I let you go, where can people find you and ask you questions and reach out to you, and also find Bitcoin Magazine Pro?
Yeah, so if you just search Bitcoin Magazine Pro, you'll obviously get to our website. And then on social media, on Twitter, we're just Bitcoin Mag Pro, at Bitcoin Mag Pro, or the YouTube channel, again, Bitcoin Magazine Pro. But if you just go to Bitcoin Magazine, BTC Inc., Bitcoin conferences, Bitcoin corporations, anything like that, hopefully you'll eventually trickle down some Val stuff.
Really cool. Thank you so much, Matt, for being on. Oh, gosh. And also thank you so much for everyone that is watching and listening, for joining us today. As always, I'll be back tomorrow with another episode. Bye-bye.
I'll be back, he says. He always ends it like that because it sounds like
this content is
Arnold.
for educational and entertainment purposes only and does not constitute financial advice.
Alright, let's see what else we got.
Everything is aligning for a late 2025 peak. The power law model captures the 16-year trend of Bitcoin. But that model only gives us average and doesn't explain anything about the deviations from that average. Quantile model, what it does is it uses a rigorous statistical approach to figure out bands around that average. For example, when someone says by the end of the year we're at 1 million, it's not impossible, but it would break everything we know about history. The core of Bitcoin's value is self-custody. If everybody's money is tied up with institutions, then okay, so one day you wake up and there's no socialist administration is there, and they decide, oh, there's too much unfairness in the economy, so let's put a 50% tax on Bitcoin. But if you do have a portion of the network outside of centralized custody, the country that does it will actually be punished.
Hello, everyone, and welcome back to the show. I'm your host, Rob Wallace, and today I'm very grateful to be joined by Sina, co-founder of 21st Capital. Sina, how are you doing today?
I'm doing great, Rob. Thanks a lot. Pleasure to be speaking with you today.
Yes, you are one of my favorite analysts in all of Bitcoin. I first came upon your stuff back in the winter of 24 when you started posting graphs for the Bitcoin ETFs. And since then, I've seen your research just grow quite to the amount over the last year and a half. And it's been really awesome to see both your online presence and just your great Bitcoin mind on display on a daily basis. So thank you for joining us today.
Thank you very much. Very kind of you.
Yes, so let's hop right in. And my first question for you is the 4-year Bitcoin cycle dead?
The hardest. Yeah, so, you know, so far, at least timing-wise, not quantity or magnitude-wise, but timing-wise, we are following the same timing. So After the last halving, we had a period of a slow progress. ETFs came along, and we shot back up. Then we went ahead of what this 4-year cycle would suggest. Then we spent many, many months consolidating. We caught up, and we've been just on track as far as timing. But the quantity and percentage return has been way less than last cycle. And that's something you would expect as the asset class gets mature. The upside, it gets a little bit more sluggish, takes more money to move it higher. So we do have that diminishing volatility. But it also helps on the downside. So we are seeing very shallow dips. These are like child play. Before you know it, a crash, I suppose that crash is already ended. Last cycle, we had like frequent 30% or more crashes. One tweet from Elon Musk would take us back down by $10,000, $15,000. And so we do have that difference, but at least so far the timing is similar. And if we continue towards the end of the year appreciating, which all the signs appear to suggest, we are still more or less following, we are at least rhyming with prior cycle. But moving forward, I'm not so confident. I think that the cycle after that could pan out completely differently, because still this time we did have some effect from halving. Halving was still not unimportant totally. And then there was also all of the psychological effect of market expectations that creates its own self-fulfilling prophecy. But 4 years from now, halving would really be unimportant, like totally a non-event mechanically, but maybe the psychological effect will also be completely forgotten as we are getting a totally different environment with institutions and corporate accumulators and all that. So maybe the game will change, but with all that, I don't expect this concept of cycles will go away. So we'll have different timing, but we still have cycles of euphoria, over allocation, and then milder crashes, shorter bear markets. We will still have that.
And if you look at the power law, it shows us that really we should be going into this euphoric peak within the next couple of months, right? They're calling for an October, November, December euphoria. Does that feel right to you if you don't look at the models per se, but just from your gut instincts when it comes to reading the headlines and seeing the price action on a daily basis?
One quick point is power law itself doesn't really have a cycle timing aspect. So that cycle timing is an extra layer you have to bring in from elsewhere. But it does seem to me that everything is aligning for a late 2025 peak. It could be a very substantial peak, or it could be a little bit more subdued. But the way things are happening, the way gold is behaving, the way stocks are behaving, and with everything with the fiscal and monetary paths of the United States and the rest of the world, it all seems like we are expanding liquidity. And this will at least go on for another 12 months. So during this time span, I do expect Bitcoin to do well and keep growing despite some volatility, some ups and downs. Maybe we'll have some pauses to liquidity because of TGA refill and other things. But overall, seems like towards the end of the year, Bitcoin should be doing much better and should keep growing. And if that happens, we are again exactly where prior cycles would suggest. If you map what happened in cycle 1, 2, 3, 4, and see how many days it took to reach the peak, and then work it from this recent halving, you pretty much get to the same timing, like November, October, December, because some cycles had double tops, but the second top falls in November period. And if we keep going up, we're exactly rhyming with that pattern. And that said, another interesting aspect would be if we actually do, say, go from 116 to, for example, 200K by the end of the year, that would be too fast for real money to catch up in my book. So, and we know when Bitcoin price kind of runs much faster than the longer trend, you're beginning to enter a bubble, right? So if that happens actually in that November, December, if price actually goes up that much, the conditions for a bubble deflation also appear. So then we will also potentially, at least my base case is, once we get there, we will also have a pretty substantial correction, less than last cycle, but substantial. So if in that scenario, we'll get another traditional Bitcoin cycle, just more subdued and more, less violent for the new, for the taste of the new investors. That we had to tolerate 90-95% crashes, but today's institutional investors, they don't have a stomach for that. And Bitcoin, I guess, is adjusting to them.
And one of the tools we have now to determine whether the market is running too fast or too hot is the quantile model. It's something that you have contributed to the space, and I think is of great assistance to anybody who's trying to judge where we are in the cycle and just how hot things are. So please tell us about the quantile model and what went into making it.
Yeah, so we start from an understanding that a power law model captures the 16-year trend of Bitcoin pretty well. But that model only gives us average and doesn't explain anything about the deviations from that average. So you don't know how much, you always go above or below that average, but you don't know how much is too much, or there's no way to quantify that. Quantile model, what it does is it uses a rigorous statistical approach to figure out bands around that average or median, right? So on those bands, you can adjust them. At the extreme, you can ask this model to give you one lower band and one upper band that capture the lowest 1% or the highest 1% of the data, knowing that there's always a little bit of chance that, at least even historically, the price moves out of those bounds, but they are pretty extreme at the low and the high. So that can give you a beautiful channel, and then you can also adjust that to lower levels, or to get more narrower bands. And at each band, you can measure the probability of reversal. So essentially, it gives you a risk quantification method. I can show you on a graph if we can switch there.
Yeah, that'd be great.
So here you can see that, ignore all the colors for now. That white line is our price, right? And this whole log linear pattern is capturing its long-term growth. This is what, in my opinion, this is the natural adoption of Bitcoin. You and I wake up every day, we promote Bitcoin, we talk about it, more people learn about it, and people allocate. 1% becomes 2, 2 becomes 4, and so on. So Bitcoin has its own long-term growth trajectory, right? And in the short run, price can, so let's say last cycle, right? If you follow the center line, the boundary between yellow and green, you get sort of a trend, a slope, right? But price, because of COVID, we went way below that, and then after stimulus, we went way above that, and then we corrected back down to that level. Then the bear market, all the bankruptcies, and then ETFs brought us to that level again. So quantile model allows us to quantify how high are we. So if you're above that average line or something like that, what is the risk score? That's how we call it. So if price is at the lower bound, risk is 1%, or could even lower than that. And if price is at the highest, at this top line, the risk will be 99%. Okay. And the reason we call that risk is that kind of you can imagine a distribution of potential prices. And if you're at the 99th percentile of that distribution, you've already covered 99% of probability. There's only a 1% chance that anything else above that will happen. So you can sufficiently cut that and say that that's like a potential top. And so the beautiful thing about this is, like, at any point in time, so we don't really predict where price will go, but wherever price goes, we can quantify how how risky it is. For example, if I get closer, you could clearly see that in the bottom of the bear market, this is probably $2,000 range to 16,000. The quantile scores were very low, below 33%. So this purple region is where Bitcoin spends a third of its life. So 30% of probability or observations fall in the purple line. And that captures typically the bottom of the bear market. It's interesting that Bitcoin spends a third of its time in the terrible, depressing bear market that's crushing investor souls. Then what it does is it typically moves out of that purple into a green region. That is a transition. So in many of the cycles, that transition has been an explosion out of purple into the higher levels. And in the crashes, in the bear markets, it's also a rapid transition back down. Same here. We got a similar thing when ETFs were approved in this part in 2024. A rapid move, I think this was 30K. We were kind of consolidating around there, and the ETFs pushed us to the all-time high. And then we were in the transition zone. This is traditionally the separation between bear market and bull market, and this captured another 33%. So that goes from quantile 33 to quantile 66. So another 30% of Bitcoin's time is spent in this. So these observations, if you add them all up, that covered a third of Bitcoin's time. Right, so we spent a third of our time there. Once the market is ready and we are there for those explosive candles, there's enough capital, there's enough, bear market is forgotten, there's enough fundamental support. Then Bitcoin, as you can see, for example, in the prior cycle, after all the COVID depression was passed, we got a stimulus, slowly the market recovered, and then over time Bitcoin recovered, and then we moved, we had a like almost non-stop move to the all-time high, and that was close to the top of that cycle. And that's where we move out of the green region and up to the higher levels. Yellow, orange, red. I've just broken, and you can see that's another 30% of probability. So Bitcoin only spent a third of its time in this euphoric zone where everybody loves, right? That's what makes Bitcoin famous. All those volatility, people love those, massive candles and all that. But that's only 1/3 of the time, and there's a lesson in that too, right? That makes market timing very difficult. Most of your time is in the more depressing, and then you suddenly get massive boosts. We are seeing the same pattern actually in this cycle. You see, we were playing in the bear bottom of the bear market, then big jump, long consolidation, big jump, consolidation, and correction. Another jump, small consolidation, another jump, another. So it's kind of like Bitcoin is playing this game of lots of gains in short period of time and then a long consolidation. But what is the model used for moving forward? If we keep growing in price, matching to the long-term trend, price will increase, of course, but the quantile score or the risk score does not increase. What do I mean by that? So imagine go back to the ETF time. We were at, what was that high? I think 72.
Yeah.
72. So we got to 72,000. But 72,000 is equivalent to next year 100K, and then today's 116K. Risk-wise, they are the same because time has passed, so there is a natural progression of price you expect. If you only grow in price by that much, you have more wealth, but the risk has not gone up because you've given it time for the network to grow. But if you grow faster than that, instead of going this way, your price will go to these regions. Will enter orange or red region. So that's how you can see price is growing faster than the long-term trend. And if that's the case, you keep accumulating risk, right? And there's always a chance that Bitcoin decides to completely behave differently and leave its 16-year trend and do something else. There's always a chance we have that, but unless we have a strong evidence for that, we're staying with something that has worked for 16 years, right? Now, keeping that assumption, if we suddenly go to, so by the end of the year, if we get to 134 or say 130 to 140 region, that's no additional risk region. That's kind of natural, totally natural network adoption. Anything above that makes the market hotter and hotter, which is not a bad thing. If you go to the last cycle, the market getting hotter was not a sign of top. You actually have to give it some time to completely pan out, right? So the heat and leverage is bad in the late state, not in the early state. So if you get into something like 150 or 200 or 300, these are different risk levels by the end of the year. And if you want to get like a medium place, quantile 90th is at $200,000. So anything above that gets you to the more than 90% risk by the end of the year. So in my book, that would be considered a danger zone. Of course, again, you can enter danger zone and stay there for a while for wild price appreciation. That's okay, but if the long-term adoption holds, you're going to come back down to trend at some point.
I wanted to briefly interrupt today's interview to give a big shout out to our lead sponsor, Rhino Bitcoin. Rhino is the all-in-one Bitcoin super app built by Bitcoiners for Bitcoiners. Buy or sell instantly. Send sats anywhere on the Lightning Network. Withdraw straight to cold storage. Even turn sats into gift cards or link to a Casa multisig, all within one sleek interface. And Rhino is just warming up. Soon, you'll pay bills, borrow against your Bitcoin, and save for retirement, all without leaving the app. Download Rhino at rhinobitcoin.com or tap the link in the description below. Use promo code Bitcoin News and Rhino will drop you $10 of free Bitcoin into your account today. Secure your stack with Rhino Bitcoin and enjoy the rest of the video.
This is a good way to gauge your expectations and then measure at any point in time is the market overheated or underheated. And this has been tremendously helpful for me, for myself, and I hope this also helps people gauge expectations. And like, for example, when someone says by the end of the year we're at 1 million, you have to extend this chart. There's no room to show that 1 million, right? So you can see how natural or how unexpected that would be. It's not impossible, but it would break everything we know about history.
And you just brought up an important word, natural. So when you compare the growth of Bitcoin and its adoption to natural phenomenon that you would find in nature, what similarities do you see, and has that come up in your research?
Yeah, basically this pattern is not a random pattern that we just tried and worked. This is something that comes from network theory and the growth of the networks. Generally, the networks whose power is proportional to their size, which is like very similar to human social networks. Like you have a social network of 2 people, that's fine, but 3 people are more powerful, right? And 3 people can attract another person faster or easier than 2 people. So 3 becomes quickly 4, and 4 now becomes more powerful, becomes 5 fast. And you can imagine how that process moves. It quickly gets into 10 and 100 and 1,000. And the larger the network, the faster it can bring in new members. Turns out Bitcoin operates the same way. And if you just work out the math and kind of simulate a network that behaves like that, it gets more powerful as it grows. You get to log or a power law model. And then when you apply that to the price data, you see how beautifully it captures Bitcoin's long-term growth. So it matches what theory would suggest, because Bitcoin exactly should behave like that, because when it's a small asset, some early adopters like it, but a lot of people are kind of skeptical. Like, as it gets bigger, just because it has more people behind it, new people will join, and it would be easier to turn or convert to skeptics. As those skeptics join the network, like super conservative skeptics now begin to rethink, right? So that kind of that becomes easier and easier to grow the network. I remember like 5 years ago, questions we were answering in live calls and all was this is too good to be true. Government is going to ban it, but that's completely changed. Today, those days feel like ancient history, and people who would have not invested in this because of the fear of government and things like that, they now have the complete green light to join and join the network. Now we have the administration of the perhaps biggest economy in the world supporting Bitcoin. And that will begin to actually convert higher levels of capital, higher levels of institutions, more conservative 401ks, and retirement-related insurance, and ultimately sovereigns. They will be step-by-step converted, and this is a function of how big Bitcoin is. Actually, Bitcoin is now a little bit too small to be able to handle cross-country trade, just because liquidity is not there. But as we get there, we will begin to see pretty interesting phenomena where countries will begin settling transactions in Bitcoin. It's the dumbest thing to try to do that in gold, very expensive, but you can't do that in Bitcoin because it's still too volatile, and you can move the price if you make a huge transaction, right? So as it gets bigger, it's going to bring in a lot of those economic activity inside, and with it, sovereign treasuries and all that. So again, social networks move like this. Typically, a log chart would capture price growth very well, but it's not. But just as a last point, you also see that in physical systems, like any system that behaves in this way, where as it gets bigger, it attracts more. You can think of even some bacteria grow like that. So it's kind of a very robust pattern that nature shows.
And when you talk about this online, it ruffles some feathers because this is the slow, methodical grind upwards, right? And I think we're seeing that more in this cycle than we have in any time in the past. A lot of time in that green transition zone where we're building that base and then go up $10,000, $15,000, build another base and repeat. But other people would come back and say, at some point, we're going to hit S-curve adoption, where we then rocket up and Bitcoin goes to infinity as fiat goes to 0. Do you think that could play out, or is that a fantasy?
I guess in a very, very long time, towards the end of fiat's life, that can certainly happen. But that also implies if fiat goes to 0, so if the base money goes to 0, that means you're having a pretty bad economic turmoil, and society's fabric is breaking, and a lot of people that have not yet adopted to Bitcoin are now in deep trouble. You have security issues, right? You have crime, you have riots, you have families breaking. It's a very weird situation, right? And at the end of it, a new monetary system will emerge and things will settle down. But during that time, you're probably very worried about other things. You're trying to get bygones and other things like that. And you probably won't really enjoy that period much. Plus, the appreciation in Bitcoin's price that comes because of collapse of fiat is probably not like much different than the appreciation in purchasing power, right? So fiat is collapsing, but that doesn't mean your Bitcoin is necessarily doing 100x. Your purchasing power is growing much more modestly. So I don't really focus on that final step where fiat collapses, because I care about purchasing power of Bitcoin, and that's how your real wealth grows. And before that time, unless we see different evidence, Bitcoin actually likes to show diminishing volatility. The weaker explosive price action to the upside, but also much more subdued corrections. In this cycle, if anything, we are seeing a bigger step in that direction. Let's go back to the cycle 4, last cycle, right? When we got to maybe 20 or 30K, people were predicting like famous predictions where, what was it, like 150 was one of the common predictions, and then another one came with 280, and then people, as price reached 50K, people were like, oh my god, it seems to be correct. Who thought? I mean, at 10K, did you think we can get to 50K? So why not? 180, 150 is within reach. And then, like I said, new models came promising 280. From there, I remember very closely, 280 was still bearish. Like, if you had a 280 price target, it was bearish, and people would make fun of you. It was fun times, And 500K, and some people were predicting 1 million. Okay, so we topped that 178. What was that? No, I think
69.
68, 69, yes. So that was the problem that happened, is that people were trying to extrapolate what happened in the cycle before that and just expect the same level of return. Lots of people learned a hard lesson that as assets mature, they move less. And then we got correction, and we had to pay back for all the leverage and all the GBTC effect and all those hedge funds and so on. Then once we moved out of the last bear market to the all-time high after ETFs, we began again. I clearly remember, I think sometime last year, very popular predictions emerged at 500K, and just this year apparently 1 million is in fashion. In all of those cases, I was looking at a chart like this, and I was thinking, this would be very, very unusual. And just on the chart, you have to extend the top of this chart. So something super weird has to happen. Just a natural process of regular investors, individual investors being replaced by institutions. That's kind of what's baked in, right? That's not a like totally unexpected massive event that will break the prior trend. Actually, what takes us from here to 200 to 500 to 1 million is this gradual joining of sovereigns and so on. So it's still part of the long-term path, right? It's not something that's totally out of ordinary, unless maybe aliens come in and say, hey, we like your Bitcoin and we want to put money in it. It would be very unlikely to get those super high prices. And again, another thing that this model really helps us is it allows us to see how bizarre some predictions would be, and kind of give us a more reasonable expectation of what's coming. This cycle has been pretty interesting. We are kind of stuck at the same risk score. Like, since it's been 1.5 years that we are at around 65% risk score. You could see that in the chart again very easily, because after ETF approval, we hit this line. We went back down to the lower level. And these are not optimized for this price. Like, these, you get the same levels, even if you run this model on the last cycle data. So for some reason, these 30%, 60% quantiles appear to be significant. But price goes up, corrects back down, goes up, corrects back down, goes up. And you're still not adding to risk, which is actually a good thing if you think about it. So you have almost doubled, increased price 50% from last year. But your risk has not. So everything we've got is not the bubble, is not the excitement, it's natural adoption. So that also means your correction, your downside will be a lot more unlikely. But as the risk score goes up, I expect more violent corrections.
And last cycle, did you have this lens? Did you have a feeling when we were in the 60,000s that we were in that upper 90% plus quantile?
We didn't have this model back then, but I used other things. First thing I used it was my own feeling. Like, when you went on social media, you would see everyone is in pain and panic and damage. And we also had some live calls with some of our audience, because we were running an education platform back then, and you would just see everybody's in terrible shape. And generally, that told me basically that we are either close to the bottom or already there. So that was one sign. Second sign, I was watching funding rate. Funding rate, if you go back and look at the average funding rate of the futures market, you would see that it goes to a terrible, like kind of a low extreme, sometime at around 17,000, and that was pretty unexpected. I was watching that, and like I said, it's very likely that it's a bottom here. The third sign was that I myself was beginning to worry. So up until 20K, I was feeling nothing. And below 20K, I was like, okay, this thing actually broke history, because we had never went back down to a number lower than prior cycle top. So we did it, and I was like, okay, maybe things have broken. Maybe we will go back down to much lower numbers. But then I told myself, okay, if you are, I typically I'm more on the stoic side, so I went into this knowing that, expecting huge volatility and all that. But then I thought, okay, even if I'm worried, the chances are everybody else's, right? So for all these reasons, I just kept buying with very high confidence, right? Overall, I had a really good feeling in that period, just accumulating, and I'm proud of my bank account being always at zero. I would just shovel everything, all the fiat back to Bitcoin, and then once the price rose, somewhere above 30K, was very clear that the bear market is over. And BlackRock news, gave us 1 full year to accumulate, and most of the gains came late. So from that point on, the game changed. ETFs came along, and then I decided to be more active on social media and put out more analyses. And because I realized a lot of people actually don't realize how much of a huge difference this is, right? This whole ETF thing was completely changing the game, and then that ended up leading to the institutions coming in, and then administration coming out in support, and then from there we were just getting good news after good news.
Yeah, it's been a wild ride these last 4 years or so. I mean, one clear memory that I have is looking at my block clock at the bottom of that bear market and seeing around 6,000 sats per dollar, and now it's 850 sats per dollar. So boy, have times changed, absolutely. But Bitcoin is just one part of a larger global economy, and you have been taking a contrarian stance. You have many people online, especially those who are fans of Trump and his presidency, that say this is the golden era, right? The tariffs are working. We are in this golden age of American growth and reshoring, bringing manufacturing back. But you have thrown up some red flags. You say tariffs are not that good. This 3% GDP number from Q2 is pretty illusionary, and the jobs numbers have been just outright scary. So where is the American economy right now, and can Bitcoin take that run up to 200K in the face of a recession in the second half of this year?
Yeah, I'm glad you brought that up, because it's kind of forgotten how the environment was in January. February, when Trump debuted the tariff plan, there was two big ideas. One was the traditional economics thinking that tariffs are not helpful. And then people would use that to then say that, okay, a recession is beginning imminently, and Trump is going to crash everything, and the market is dead, and so on. Then there was another newer, smaller group, perhaps outsized or overrepresented on social media, that were saying these are actually going to be fantastic. So Bitcoin is going to run from here, and market's going to run from here, and everything's great. I had a third view, which was kind of a combination of both. So I was expecting tariffs to crash the economy and the markets with it, but not to the extent that it leads to recession. Why? Because mechanically tariffs do slow down trade, and when that happens, everybody earns less money, and you begin charging somebody for economic activity, they're going to do less of that. So less economic activity means less purchasing, so your suppliers are going to be hurting. Also less selling, there would be smaller availability of products, and at the same time, maybe you also don't have enough that much need for hiring, so lower employment, and all the negative things you expect economic slowdown would come from throwing tariffs in the mix. However, I also recognize the strategic issues there, right? So there are markets where you just can't allow foreign adversaries to come and capture and corner the market because they are stimulating hard, and sometimes you have to intervene, right? So that I understand for certain products and certain markets, pretty strategic ones, military items, maybe some portions of the healthcare supply chain, which actually we're not doing much to improve. During COVID, we realized most of our pharmaceuticals come from China. That's a huge strategic risk. We're buying a lot of rare earth from China, even though we could actually dig them out of the ground. We have there are many minerals that we do have mines for, we do have resources, but just for cost reasons, we rely on China, and they do a very efficient job at that. And over time, we grow so dependent that it becomes a risk, right? So that's an issue. I think that should be addressed, but we can discuss whether tariffs are really good, or instead you should actually directly support some, for example, in that case, mining operations, like give them direct stimulus as opposed to stopping the inflow. So that's a different question. But the short effect is a loss of economic activity. So even if you have a strategic, legitimate reason to put on tariffs, the cost is it's going to slow down your economy. Now, so that was my thinking. But then at the same time, I added this layer of understanding of Trump administration. Like, he wants to appear very powerful and the strong man that restructures the world, but he's also a market and businessman, right? So my expectation was the moment he realizes that all these tariffs are cracking the markets, he will back off. And that pretty much exactly happened when the bond market started crying hard. He added all those pauses and suddenly went from, okay, I'm not going to yield at all, to, okay, we're going to be lenient, we're going to make deals at 30 days of pause and then 90 days of pause. The pause allowed the markets and lots of companies to accumulate lots of inventories and deal with it in the proper manner, right? Previously, it was very sudden and much more troublesome. So it was very clear that it's going to throw a huge wrench in the economy. And so the first prediction that it's going to be great really didn't pan out. But also the second prediction, which some people maybe even with like political views brought, that also didn't pan out. We had a massive V-shaped recovery because Trump clearly showed that he has also an eye on the economy and doesn't really want all this to end in a recession. So he wants to get some concessions, but at the end of the day, they will try to do other things to support the economy, or at least if tariffs, which as I suspect, will get us to the brink, he will go all the way to the brink, but not further. Now, so that combination of thinking is a long explanation, but all that came into this V-shaped view that we put out, and pretty much panned out. And like if you use that opportunity to accumulate, I think you were able to buy Bitcoin at 75, and it's a really big appreciation so far. But then once we got that rapid recovery, we flipped a little bit less bullish because in our playbook we needed Fed to also support the economy, and we needed some further support from Treasury. We recovered without all those, so that told me that we were maybe running a little bit ahead of our plan. And that's a few months back. So, and since then, we've had a kind of a consolidation period, and we're waiting for the next leg up, pretty much as we expected. But the next leg up is getting harder to make sense of, right? Because we will be getting cuts pretty shortly in the next meeting, unless we get a completely different data. But it is also possible that before that happens, we get so much bad data that the markets begin thinking about a recession. So, but the path moving forward is very clear. We're going to have this 15% baseline tariff everywhere, and it would be little deals here and there, but overall you make everything more expensive by 15%. Again, that's another misunderstanding. A lot of people are going to say, oh, this is going to lead to massive inflation. No, actually, for everything that I explained, it's not going to be, very likely not going to be a persistent inflation. It's going to give a shock to prices, but that shock is going to cause consumer to pull back, right? When they pay more for something, they're going to pay less for something else. So overall, when you look at the overall data, you're going to get subdued inflation. Maybe a few months of higher ratings, but then that's going to quickly replace with economic slowdown and the trouble in the labor market and all that, which is the stuff we've been saying, earlier this year. And pretty much right now, I think the data reflects that sentiment. Now, moving forward, if we get another really bad employment report confirming that there is a downward trend in the health of the labor market, I think a 25 basis cut is for sure, and maybe a 50 basis point is on the table. Plus, there's all sorts of these crazy things happening at the Fed, right? Governor Kugler resigned, leaving an opening for a new Trump nominee, which long awaited direct Trump influence in the group. And then Powell is going away. Powell is facing more dissent from two governors, Bowman and Waller. So the third one is going to be added by Trump. So it's kind of like this battle between the Powell and company, their team, they are hawks. Arguably, they're going against the data. And then there's this little growing dissenting minority that's being acting as a shadow resistance.
If you were in Powell's shoes, would you have cut already? Do you think he has been political and been stubborn because he doesn't want to give this to Trump? Or is he looking at the markets and seeing that we're just a few percentage points off of all-time highs in the S&P, in the NASDAQ, Bitcoin, gold, everything's at all-time highs? Why would you cut in that situation?
Yeah, this is I feel like they're playing a game with the public. And I'll tell you why. So they typically say we have this double mandate, maximum employment, whatever that is, right? Maximum employment and stable prices, right? So they have to worry about inflation and labor market. But when we were in COVID times, there was political appetite for stimulus. And even though inflation was high, they didn't care. They kept stimulating. And then later they admit that this was too much. And God knows, 5 years later, we're still paying for that. Lots of people, young people now can't afford houses just because the Fed did that. And their reaction function was too dovish and too much focused on the labor market. Now what they say is, we anticipate a potential and theoretical effect to inflation, and even though the labor market is not particularly strong, we're not cutting anything and we keep rates at a very high level. So this doesn't match what they did in the last time. If you didn't know their history, you could have said, oh, these guys are probably, they have a point. There's a chance that inflation is going to be higher for a couple of readings at least because of tariffs, and so let's wait for that and then keep cutting. But two things, we are at historically very high restrictive levels. They only cut last year, which also matches the election cycle. They're not cutting now when even data is showing weakness. Inflation is not happening. Inflation, you should have actually, if some of the worries were right, you should have seen much stronger inflation by now. We do see a slight elevation, but we're still stuck at the stable 2+ something percent, like 2.5%, which has been there for a while, for at least a year and a half. And it's really not rising meaningfully. Instead, employment is not so good. There's ample evidence showing that housing market is in pain, automobile market is beginning to have trouble, and no one can economically borrow money. Given all this, they are resisting cuts, and that sounds a little bit out of their, deviating from their historical pattern. They traditionally have been a lot more willing to cut rates and bring them back down to normal levels when your economy is growing only at 1.4% in the first half, and your federal funds rate are at 4.5% or around that. That really doesn't make sense. Your rate should be much lower than that. But they're not. So then we have to think, okay, could it be because of political reasons? I don't know, but everything I see kind of sounds like it. Powell could have this idea that I want to be Volcker and I want to break the back of inflation and all that. Maybe that's the reason. Maybe he's like, he knows he has no place in the next round, so he's out already. It's very clear. So maybe he wants to at least cement some character and some legacy as somebody who resisted political pressure, which is kind of another lie of independence. I don't know. And it could also even be a direct attempt to hurt the administration. But certainly what they're doing right now doesn't make sense. And the recent dissent from at least two governors, which was historic, like I think we haven't had two people rejecting the overall consensus for many, many decades. And that also reflects this internal division.
So now taking off our econ hats and putting back on our Bitcoiner hats, you've been here for over half a decade now. You've seen the culture in its different phases, and you at 21st Capital, you guys are focusing on self-custody, making sure that you take care of your Bitcoin as a tool for sovereignty. Have we lost that mission right now? Do you still see that flame being carried in certain places? How would you describe the general zeitgeist of Bitcoin and Bitcoiners right now?
Yeah, so basically we focused a lot of our energy on promoting self-custody because we thought Bitcoin's, the core of Bitcoin's value is self-custody. Like if that's gone, how are we different than just a better performing gold, right? If everything is in centralized custody, probably we're not getting, we're squandering the potential. If people actually do self-custody, then that's where you can expect a free transaction, free parts of the economy to thrive. But if everybody's money is tied up with institutions, then okay, so one day you wake up and there's a new socialist administration is there, and they decide, oh, there's too much unfairness in the economy, so let's look at the parts of the market that are purely speculation in their view, and okay, Bitcoin is a good candidate, boiling the ocean, so let's put a 50% tax on Bitcoin, so you can't pull your money out of ETFs without losing a substantial part of it. Very reasonable, very expected. But if you do have a portion of the network outside of centralized custody, this action will actually strengthen the value, or motivate people to pull their money out as much as they can, or when the news or fear begins, they will pull all the money out, and the country that does it will actually be punished. But this only works if there is a kind of reasonable amount of Bitcoin held in self-custody, right? Otherwise, Otherwise, you're going to have significant trouble. Now, the problem we see in the space right now is that is, at least on the surface, is being replaced by excitement over institutional investments. Institutions are great. They make everyone else rich. They raise the price, and we love that. But they also come with risk, right? And I think the ideal case I would have wanted to see is Bitcoiners, especially older, the ones that are really stay true to the core mission, they would be cheering for institutions exactly at the same time that they promote self-custody, and they always keep that caveat, hey, this is fantastic that BlackRock is coming, but we have to make sure we give enough attention and energy to self-custody. Kind of like Bitwise is doing, right? They had their own ETF, but at the same time, they were supporting development as well. But what I'm seeing that, which is a little bit disappointing, is a lot of the OGs and people who have been very critical of the Fed and the fiat money and printing and all that, they are now completely switching to becoming the corporate treasury promoters. That's a little bit odd. And then I wonder, if we keep doing this for another 5-10 years, how would Bitcoin look like at that point? Do we have still enough energy and motivation among free open source developers to carry that mission and get us to a place where we have really user-friendly, popular money outside of governments? Or this trend would actually wash the brain of the community to say that, okay, all we want is a store of value and price appreciation for now, and let's worry about other things later. And by the time, when most of the coins are stuck in some sort of TradFi wrapper, it will already be too late to think about a medium of exchange properties, right? I don't see enough excitement in people promoting P2P transactions. Much more excitement is seen in TradFi. I'd like to think that's a phase, like once potential leverage accumulation and maybe less than prudent actions show some of the risk, maybe people will come back to realizing the value of self-custody. But I do worry about that a little bit. It's not an imminent issue, but if we keep doing the wrong things for 5-10 years, maybe it would be much harder to fix and get back to our core mission. But as far as what we see in self-custody, we do see, even with all the ETF ease, we do see, and this gives us a lot of joy to see there's a base of investors that realize still they can easily buy the ETF, but they also choose to do self-custody, at least what we see with our clients. That's pretty good, but still we do see most of the marginal money is now going to TradFi vehicles. So that's a concern, and I think it's not late for Bitcoiners to try to promote self-custody more, and you can be someone that likes an ETF investment. It has its own advantages. It's government protected, so a lot of people need that. But at the same time, that's kind of like, it has to be promoted as a temporary solution, right? Not as a replacement for self-custody. I think we should do that. We should move in that direction. And the moment you see a problem happens, again, a socialist government, it's very easy to imagine the next government would be an antithesis to Trump, and they would take a completely different view of Bitcoin. At that moment, you realize you shouldn't have trusted the centralized custody much, right? So it's kind of like one of those things where it's not a problem, and then suddenly it is a problem. It's better for the community to be prepared for that.
Yeah, I 100% agree with where you're at. A lot of Bitcoiners came in during 2020. I mean, it was during COVID, right? It was during this massive printing, this government overreach, and there was an ethos of let's protect ourselves, let's figure out a way to get outside of this system that seems to be clamping down on us. Whereas now, the class of 2025, people come in, I mean, I'm seeing posts of people saying, I don't need sovereignty, I need performance. That's why I'm 100% in MSTR, 0% Bitcoin. And I mean, that just blows my mind as a 2020 Bitcoiner, when you're like, not your keys, not your coins, have fun staying poor, and become part of the revolution, right?
Yeah, and you know what it brings to my mind is when people said, like, the Shiba Inu, I don't want Bitcoin, I want all Shiba Inu because it gives me 10x return. Okay, generally the pattern, this really feels like the way this will end is you will do that too much. So the thing that was really outperforming stops outperforming, and it has to correct back down. And if you FOMO at the highs, it's going to burn you a lot, and then you go back to the core. That's why I'm thinking, like, over time, it's very difficult to outperform Bitcoin, because even if you want, you can expand the supply. But if in any of these things, for example, as stock, MSTR, or other ones, they have huge incentives to dilute, right? So they can outperform, certainly, and they have. But just this year, we've seen, after this tremendous outperformance, they decided to dilute the hell out of the stock, and it hasn't gone anywhere since then. Like, it corrected back down from 600 to 400, and at around 550 or 600, that was maximum promotion. And I was just watching lots of these options, speculation courses or classes or information or discussions were there, and I can imagining at the top you put on leverage. Now we are like 50% lower, and you have pretty much lost 80-70% of that bit. So that's kind of the same pattern. We've seen it over and over again. In every cycle, you see something pops up that is promoted as the better Bitcoin, and it always has a story. Sometimes it's a replacement for Bitcoin, sometimes it's like stacks, it's a new coin on top of Bitcoin, and sometimes it is an adjacent vehicle that accumulates Bitcoin. Remember last cycle, people were cheering for Luna, right? Luna UST, and some people were, half of the community were very correctly saying this is still a unstable business model, but the other half was like, who cares? They're buying Bitcoin, right? So there was a reason to be happy about it. But whenever there are there is games like this and fiat games being played around Bitcoin, you have to keep that healthy skepticism to be safe. That's certainly what kept me from FOMOing into MSTR earlier last year or so.
Yeah, and that's the beauty of capitalism and markets, right? That the froth will burn off, and you'll be left once again with the diehard community who is about sovereignty, self-custody, and carrying on that original mission of Bitcoin, which is being able to be your own bank, be in control of your sovereignty, your future, and your wealth. So, Sina, thank you so much for joining us today. If people want to find out more about 21st Capital, where should they go?
So you can visit 20verscapital.com. We offer primarily two services. One is self-custody, which is a multi-layer multi-sig with natural and embedded inheritance that would be protected by on-chain security of Bitcoin. So that's one product. And then second, we also offer research, market research. You can, there's subscriptions available. We analyze market every week in the form of writing and videos and all sorts of things. You can check that out as well. And you can also find me on Twitter at Cena_21st. Happy to connect, happy to chat, and thanks a lot for having me today.
Absolutely. I do think that you are one of the beacons of truth and a humble approach towards Bitcoin and its path into the future. So thanks again, and be in touch.
All right, that was pretty good. Felt like very conservative. Almost done with this run here. Long run. Tons of gold coming out of this one. Alright, let's cue the next one up, I guess.
Bitcoin was tiny back then, and he kind of pointed that as it gets bigger, it's inevitable that we'll see some pools of capital find ways wherever they can to short fiat currency and be long Bitcoin. I think the thing about treasury companies is they can do it with better types of leverage than most other pools of capital have access to, which is interesting. It gives them an edge. I'm bullish on Bitcoin. I like the fact that they're holding Bitcoin. I'm not going to say let them manage Bitcoin for me. I'm also going to hold Bitcoin. But if I'm looking at the universe of stocks I can own, that's an interesting strategy because they can employ, in some cases, a little bit of leverage or not. They have cash flows or not, and they're doing something with their Bitcoin that can allow that company to, thrive through multiple cycles.
Bitcoin is trading near $120,000, hovering close to its all-time high of about $123,000. After breaking key resistance levels earlier this month, the cryptocurrency has shown steady momentum, with technical indicators signaling the potential for higher prices. On some charts, Bitcoin is staying within a rising channel that began in April, suggesting the bullish trend could continue toward levels around $125,000. However, recent minor pullbacks indicate cautious profit-taking amid this upward move. Trading volume remains strong, showing sustained market interest despite volatility. The recent surge was also supported by policy changes allowing retirement funds to invest in alternative assets, including cryptocurrencies, which could open new pools of capital into the market. Many analysts are optimistic about Bitcoin's potential to push even higher by year-end, with some predictions targeting $130,000 or more. With Bitcoin growing increasingly liquid, different market players are finding innovative ways to gain exposure. One interesting approach is by treasury companies using leverage more efficiently than many others, giving them an edge in holding and growing their Bitcoin positions. While many investors hold Bitcoin directly, some see value in these companies because they combine Bitcoin exposure with cash flow and strategic management, helping them weather market ups and downs. In a recent interview, Lynn Alden highlighted that these treasury companies can thrive through multiple cycles by carefully managing their Bitcoin holdings alongside their operational businesses. She mentioned that this strategy offers an alternative for investors who want Bitcoin exposure but also want the benefits of a corporate structure, access to capital markets, and sometimes leverage, which might not be available to individual holders. Watch clips from the interview for further insights into Lynn Alden's conversation. Please like this video, subscribe to the channel, and turn on post notifications for more content. Before we get into the rest of the video, I have to talk about something I'm seeing more and more serious traders using right now, and it's changing the way people approach the markets. It's called Cortex Trade, an AI-powered, fully automated crypto. This isn't some team of professional quant traders. You can pull your profit, see how Cortex works. Serious crypto investors.
Then
for watching.
And I think broadly, treasury companies make some degree of sense because if you have an appreciating asset, and Pierre Richard wrote about this back in 2014, the idea of a speculative attack. And Bitcoin was tiny back then, and he kind of pointed that as it gets bigger, it's inevitable that we'll see some pools of capital find ways wherever they can to short fiat currency and be long Bitcoin. I think the thing about treasury companies is they can do it with better types of leverage than most other pools of capital have access to, which is interesting. It gives them an edge. And I think that by the end of the cycle, we probably will see some treasury companies fail. I think there will be low-quality ones that get over their skis. So anytime you link leverage with something, you're increasing the risk. I do think the highest quality ones are valid. And this particular discussion happened. So I went on Strategy's earnings call as one of their analysts. And I actually asked the bearish question of the group, which is basically asking about stress testing during the next bear market. Like what kind of bear market are they kind of modeling or thinking about as they design their capital structure? And they provided their answers. And then also I generally agreed that their new preferred, which they're pretty excited about, is I think it's hitting a sweet spot that the market wants. So I expect it to be successful. And in one of my two threads, Andy and I went back a little bit and forth a little bit because I'm generally in the cautiously optimistic camp around these treasury strategies. Depends on the specific company in question and the quality of the management team and everything else. Well, I would say that unlike an ETF, MicroStrategy and other treasury companies that are operated well tend to increase their Bitcoin per share through these strategies, through this kind of debt and equity issuance strategy. And so you're paying a premium over the Bitcoin they have, but then you're also expecting this per share Bitcoin to increase. Now, there's different ratios that analysts have come to use, basically trying to figure out how much of an MNAV to apply based on forward, how much they expect Bitcoin increase per share. I've actually raised the concern that the problem with that is it's recursive, because the higher their MNAV is, the faster they can increase their Bitcoin per share. And so that flywheel is really good on the way up, but can also just unravel very quickly when sentiment changes. It's different than, say, evaluating a company based on cash flows from operating a pipeline business or something. And so while there's merit in that analysis, it's a new form of analysis, and it's inherently just challenging. My general view has been that I don't know what the right MNAV is. It certainly depends on the company. For example, Metaplanet is smaller, is in a jurisdiction where there's a really big tax arbitrage, which is different than the United States. So that they're actually tax advantaged there, and they started from a smaller base, so they've had very high MNAV and have grown very quickly. It's come down more recently. So I think that MNAV is somewhat context dependent, partially based on how much you expect them to be able to kind of arbitrage this. Generally speaking, as they get bigger, we should expect the MNAV to gradually compress because trees don't grow to the sky. Now they can continue growing. It's just that after a while, that MNAV generally starts to compress. That's so far what we've seen in the market. But I do think that an MNAV above 1 makes sense when you can attach this longer duration debt to Bitcoin and therefore get through periods of cyclicality, at least if managed well and conservatively, compared to the way that hedge funds lever, the way that retail investors might lever. And so I think it's worthy of a premium. I would like to see eventually more cash flow generating businesses have Bitcoin on the balance sheet. The kind of history of the space. So MicroStrategy did the approach. They actually then ran a number of conferences called Bitcoin for Corporations, trying to get other corporations to do it. We saw Tesla dabble in it. Block got in to some extent. We didn't really see a lot of other companies with existing operations decide to add Bitcoin. Instead, in this cycle, we've seen a number of companies that kind of spun up to do the strategy, as well as increasingly around the margin, some existing companies do it. So I think there is a bigger market for companies that just use Bitcoin as a treasury asset while also having separate cash flows. But then clearly there has been demand for 5 years now, and I think ongoing, for a levered kind of pure play Bitcoin entity. And then I think the main question to ask are how do you value that? I generally err toward conservative. And two, how do you manage the risk so you don't have a very large blow up, especially among the larger ones in the market?
So Lynn, you started this by saying that you're not necessarily bullish on all treasury companies and you think that some will fall by the wayside. Do you think the companies that are essentially zombie companies that are doing a Bitcoin treasury play are going to be unsustainable going forward, and what we need is real companies with real business models adopting Bitcoin?
So there are somewhat different types of zombie companies. In some ways, the perfect candidate to do this is one that's like a value stock that's cash flow positive, but doesn't really have any growth prospects to add Bitcoin. That's really interesting. And we haven't really seen a lot of that. Truly zombie companies that have like no cash flows, that's a much harder sell. Generally speaking, so far we've seen that the market certainly does not like unprofitable companies, companies that are losing money, to adopt a strategy because they view that as a distraction and a risk versus their kind of Bitcoin approach. So I certainly think it makes sense for companies to at least have your profitability like neutral. And I think there is a market for ones with cash flows. They don't have to necessarily have growing cash flows. And really at that point, Bitcoin competes with other uses of capital like buying back shares, paying dividends, paying down debt. They can employ that as one of their potential strategies for what to do with their excess earnings over what they require for reinvestment. I mean, there's a number of points there. One of the earliest ones was why Bitcoin? Why buy Bitcoin with cash? Historically, the answer is because it's the best performing thing you could buy with your cash, pretty much. And then the thesis going forward is that it's going to continue to be either the best or one of the best things you can do with your cash, especially that it's not a security. So there's with U.S. stocks, there's kind of a limit on how much securities you can have in your asset mix. It doesn't apply to Bitcoin, which is a digital commodity. And so the combination of high expected returns based on those who, generally speaking, those at strategy and those who invest in strategy are bullish on Bitcoin. So I certainly wouldn't recommend a Bitcoin treasury strategy holding for those who just aren't particularly high conviction long-term bulls in the asset.
Some treasury companies holding Bitcoin make sense because they manage an appreciating asset, but leverage adds risk, and not all will survive. The best ones, with strong teams, raise capital through debt and equity to increase Bitcoin per share, which differs from ETFs. This creates a cycle. The higher their valuation, the more Bitcoin they can acquire, but it can reverse quickly if market sentiment drops. Valuing these companies involves new, complex analysis, often tied to expected Bitcoin growth per share, which varies by company size and tax environment. Generally, as companies grow, valuation premiums tend to compress. There's growing interest in companies with real cash flows adding Bitcoin to their balance sheets, but unprofitable firms adopting Bitcoin strategies are often seen as risky. Overall, Bitcoin is viewed as a top cash investment for those confident in its long-term growth. Let's go back to the interview and watch more clips to gain insights from Lynn Alden.
There's a valid reason to have high expected returns on Bitcoin based on historical returns?
Not just on historical returns. I employ a number of analysis methods to determine what I expect Bitcoin to do. I still think that the total addressable market of what Bitcoin can address is much larger than the current size. In my expectation over the next 5-10 years, I do expect Bitcoin to still have high returns. Now, not the returns that when you go from $1 billion asset to $1 trillion asset, but I certainly think it can 5x and 10x from here, and we'll see how the numbers shake out in the years ahead. And it's also the risk situation is different than before. So when Bitcoin was tiny, it didn't even have the liquidity for like a corporation to buy it. It didn't have the regulatory clarity in many cases either. And so now that the tax treatment of it has improved, regulatory clarity has improved, and it's a big and liquid enough asset, the expected forward returns are not as explosively high by most analysis methods than they used to be.
Yeah, I get why you are buying Bitcoin versus anybody else, or for that matter, I can do it on my own. So why are you doing it for me? Like, where's the edge?
I think the main thing is that Bitcoin's the first asset that can actually compete with equities long-term in returns. And so prior to this, when corporations had excess capital, they generally decapitalized themselves. They would give it back to shareholders. They would pay it in dividends. They would pay it in buybacks. They would sometimes make acquisitions for the sake of acquisitions because they don't know what else to do with the money. That's often a criticism that especially some tech companies tend to do. One of the downsides is that makes the company more vulnerable in the future if they don't have something good to save with. Kind of like how households want to save for unplanned things in the future. Generally speaking, corporations want to save for unplanned things in the future. And there's just not been a great vehicle for that. Even gold, because gold over the long arc of time underperforms high quality equities, it's hard to justify holding a lot of it on your balance sheet longer term if you're a company that's trying to be in the top third of the S&P 500 returns or something like that.
But I think you're saying the same thing. I think you're saying that you think Bitcoin is going up. I'm saying a different thing, which is why should I trust a company that manufactures, creates software, does whatever it does as a business, to have the expertise that you do?
Well, I think in many cases you shouldn't. And when companies adopt the strategy, many of them don't get very high MNAVs because the market says, well, who are you? Right? So they look at strategy and they say, well, these people have been doing it for years now. They look at, say, Metaplanet, and they know the people running that. I mean, I know the people running that, and they think that, okay, I'll trust those people to manage as well. And so it's certainly a company-by-company basis. And some of these companies have hired Bitcoin analysts, Bitcoin experts in various capacities to help them do the strategy, and then the market assesses, do they think they have the right people on board to help that company with the strategy? But basically, the answer is, one, in the near term, there's an arbitrage. The market likes it. But two, longer term, as Bitcoin kind of grows and becomes less volatile, but still has the absolute scarcity aspect to it, which is desirable, it's one of the few assets that I think there's a reasonable case that can be made that it is able to keep up with equities over a pretty long span of time, if not outperform equities. And therefore, if a company doesn't want to fully decapitalize itself, it doesn't want to say, okay, we're going to take all of our excess capital above what we need for working capital and give it back to shareholders. We want to plan, for a pandemic lockdown or a big new competitor comes to our market. We need to make major capex to change or pivot our business. They want to have something that they can hold for 5-10 years as part of their asset mix. And I think Bitcoin brings that in a way that other assets haven't.
The reason they can potentially outperform you just buying Bitcoin, I assume, is just the access to capital markets. Is that right then?
Partially it's the access to capital markets, yeah. That they can do certain types of leverage that others can't, especially those that don't want to make 1 year or 18-month bets on the price, but just want to say, okay, this company plans on doing this for the foreseeable future, and they want to maintain conservative leverage ratios in debt that's not really callable during a bear market, as long as they don't get liquidated in some capacity, they're unable to make coupon payments or something. And so I'm going to let them do it. Is how many pools of capital do. Now, I'm with you that I don't think anyone should say, okay, sell your Bitcoin and go buy a Bitcoin treasury company. I think that there's larger pools of capital that just for a variety of reasons can't own Bitcoin. Sometimes they can't even own the Bitcoin ETFs, and so they can go out and buy companies or either their equity or their bonds that give them some degree of Bitcoin price exposure. If say a fund manager happens to be bullish on Bitcoin, there's now a capacity to do that. And then two, if you're that company themselves, and you're not, you do any other business that's not Bitcoin, could be software, could be a gasoline pipeline business, whatever the case may be, and you say, well, we're decapitalizing ourselves. We're giving back cash to shareholders, which makes sense. But if we want to have something that we want to hold, say 20% of our retained earnings in something longer term for unexpected events or to grow over time, that's certainly one of the things that they can do. In MicroStrategy's case, and they've actually talked about this, when they were a software company, they had, flattish income. They were no longer a growth company. It's a very competitive market. A lot of their competitors had gone out of business. They were up against, really, really big conglomerates at that point. And they generally found that nothing they did was enticing to the market. So buying back shares didn't excite the market. Holding a lot of cash didn't excite the market. And they've even talked about how they would eventually start losing executives that go want to work at things where that there's bigger and more scale. And so by becoming a larger company, partially through their treasury strategy, they were able to keep and retain really good executives. So sometimes decapitalizing yourself is the answer. Because it's kind of a decision that the investor will make better use of that cash than the company will. And that's certainly better than a company holding it and then misusing the cash. But there's also an argument to be made for putting some of it into something that can appreciate long-term and give the company survivability through problematic events, as well as to become larger over time, which then potentially down the road could result in larger acquisitions than they could do without having done the strategy. And then investors might say, well, I like the underlying business, and I like the fact that I'm bullish on Bitcoin. I like the fact that they're holding Bitcoin. I'm not going to say let them manage Bitcoin for me. I'm also going to hold Bitcoin. But if I'm looking at the universe of stocks I can own, that's an interesting strategy because they can employ, in some cases, a little bit of leverage or not. They have cash flows or not, and they're doing something with their Bitcoin that can allow that company to, thrive through multiple cycles.
Lynn Alden explained that high expected returns on Bitcoin aren't based just on its past performance. She uses several analysis methods and believes Bitcoin's total addressable market is still much bigger than it is now. Over the next 5 to 10 years, she expects Bitcoin to continue delivering strong returns, maybe 5 to 10 times growth, but not as dramatic as in its early days when it went from $1 billion to $1 trillion asset. She noted that the risk profile has changed since Bitcoin became more liquid, gained regulatory clarity, and now benefits from better tax treatment, so future returns are less explosive, but still attractive. She also argued that Bitcoin is the first asset able to compete with stocks for long-term returns. Traditionally, companies with extra cash return it to shareholders through dividends or buybacks, which might leave them vulnerable in tough times. She pointed out that corporations want to save for unexpected events, but haven't had a good long-term option until Bitcoin, since gold and other assets usually underperform stocks. She added that many companies adopting Bitcoin strategies don't earn high market trust unless they have proven experts managing it. Those with the right teams, like Metaplanet, tend to get better investor confidence. Lynn Alden said companies can hold Bitcoin as part of their reserves for 5 to 10 years to prepare for crises or growth, which other assets don't offer in the same way. Regarding how treasury companies might outperform buying Bitcoin directly, she said access to capital markets and the ability to use conservative leverage help them. Some investors can't hold Bitcoin themselves, or Bitcoin ETFs, so they invest in these companies to gain exposure. For companies, holding Bitcoin can be a strategic choice to preserve capital for future needs beyond just giving cash back to shareholders. This approach can also help companies retain executives and grow over time. What do you think? Will Bitcoin treasury companies keep outperforming traditional stocks, or is direct ownership still the best bet? Please drop your thoughts in the comments below, share this video, and hit your thumbs on the like button. Thanks for watching. Don't forget to subscribe.
Wasted. Alright, better put another one on. There's still quite a bit of gold left. Yeah, I'm just looking for a decent one here. Find something out. Here
Hey
we go.
everyone, and thanks for jumping back into the cryptoverse. Today, we're going to talk about Bitcoin, the pattern that has historically ended the bull market. If you guys like the content, make sure you subscribe to the channel, give the video a thumbs up, and also check out the sale on Into the Cryptoverse Premium at intothecryptoverse.com. Link is in the description below. We have access to tons of different charts for crypto, stocks, and macro as well, so make sure you check it out. Now, we're going to just methodically go through the pattern that Bitcoin has carried out every post-halving year. And we also want to try to identify where we are within that pattern. One of the things you may notice is that Bitcoin, historically, and again, as always, historical patterns, historical moves, right? The past cannot necessarily predict the future. You must recognize that. So at the end of the day, there's a reality of no one really knows what's going to happen. But there's also a reality where Bitcoin tops near the end of post-halving years. So you will see Q4 of 2013, Q4 of 2017, and Q4 of 2021. Now, the path that took Bitcoin to each of those market cycle tops was remarkably the same. If you look closely, one of the things you'll notice with Bitcoin monthly returns is that in every post-halving year, in July and August, Bitcoin is green. You'll see in 2013, July and August were green. And in 2017, July and August were green. And in 2021, July and August were green. And so far in 2025, July and August are green. You'll also notice that in 2013, 2017, and 2021, September was red. And then, in every one of those post-election years, post-halving years, October was green after the pullback in September. So the way this historically works and we'll go through it cycle by cycle, is Bitcoin goes up in July and August, gets a pullback, generally speaking, to the bull market support band in September, and then goes into the market cycle top in Q4 of the post-halving year, which sets up the midterm year bear market. Okay, so what you have here is up in July through August, right? You can see that pretty clearly right here, up in July and August, and then a pullback in September. You can see that right there, and that pullback bottoms around the bull market support band. And then after you get that September pullback, what has historically happened? You then get the final rally into the market cycle top, okay? And what you'll notice is that this pattern actually repeats itself, right? So again, you have up in July and August, the pullback in September to the bull market support band, the final rally into the market cycle top, and then you put in your final market cycle top in Q4 of the post-halving year, which then sets up the midterm year bear market, all right? So that is the 2013 cycle peak. And you can see how this pattern will repeat itself in the next cycle. So let's just go through it. So first of all, we have up in July and August, right? Here's July and August, right? Up in July and August. And then you get your pullback, where to? Glad you asked, the bull market support band. So you get your pullback in September, so that 20-week SMA, just like in 2013. And then what happens after that? You got your final rally.
Here we go, here we go.
Right, so you got your final rally right here after that September pullback. You see that? And then what happened in Q4 of 2017? Just like in 2013, you got your market cycle, which then set up the midterm year.
That's it.
Bear market, right? So to draw the same thing out, it was
wasted
up in July and August, a pullback in September, a rally into the market cycle top in Q4, followed by the midterm year bear market. So what happened in 2013 and in 2014 in terms of the pattern was the same thing that happened in 2017 and 2018, right? The pattern was the same. Now, let's go see. All right, once it happened, great. 2 times, fine. 3 times? Let's go take a look. Did Bitcoin go up in July and August? Over here, absolutely, right? We already showed it on the monthly returns. Up right here, July and August. So up in July and August, right? Same old thing, same as it always does in post-election years. And then you got a pullback in September. And guess where the pullback was to? I'm glad you asked again, right? It was the bull market support band, that 20-week SMA. And then after that, we got the final rally into the market cycle top. And the market cycle top occurred in Q4 of 2021. So to draw it out, like we did the others, up in July and August, pull back to the 20-week SMA in September, market cycle top Q4 of the post-election year, post-halving year, which then set up the midterm year bear market, right? So now we have this pattern playing out 3 times, right? It's now played out 3 times, where every post-halving year, that's how the cycle has ultimately ended. How's it going this time? Well, let's go take a look, right? So far, we already know if you look at the monthly returns, Bitcoin has gone up in July, and August is still, not even halfway through, so the jury is still out on whether that will remain green. But if it does, let's suppose it plays out like the historical pattern, right? So up in July and August, pull back to the 20-week SMA in September, if it repeats how it always has, and then up into whatever the market cycle top is going to be. I have no idea, but I'll stick to the risk metric, which would then probably set up the midterm year bear market, right? Something like that. Now, I don't know exactly where that top is going to be, but I will say there has been a pattern of diminishing returns, unfortunately, and if you take a price range from every September pullback, you'll notice that after the let me go to the first cycle first, right? After the first cycle from the 20-week SMA in September, Bitcoin then rallied about 1,000% to then put in the market cycle top. In the cycle after that, it rallied about 500% after the September pullback. In the cycle after that, from the September pullback, it rallied about 70%, okay? So the bull market support band in September will likely be higher than it is now. Currently, the bull market support band for Bitcoin ranges around 105 to 107K. So maybe in September, that 20-week SMA could correspond to around 110K, plus or minus a few $1,000s, right? Plus or minus a few K, $110,000 plus or minus a few thousand. What's a few $1,000, my friends, right? So then it would set up a potential final rally into the market cycle top. Now, let's suppose that the 20-week SMA hits around 110K here in a few weeks, and then let's suppose Bitcoin gets a pullback to that level after hopefully first rallying up higher. Where would that put Bitcoin? Well, a 20% rally from 110K puts it at 131. There's a chance that it goes to 130 before you get a pullback for the 20-week SMA, right? Let's just go through it, right? 20% from there would be 131. 30% from there would be 143. 40% from there would be 154. Okay, now last cycle it was 70% up, and that would put Bitcoin all the way up at 186. Now, if you subscribe to the diminishing returns view, then what that would suggest is that it might be hard for Bitcoin to get up to that level if the diminishing returns idea as measured from September plays out. It could theoretically go higher than that, and the overall market cycle ROI still exhibit diminishing returns. But I just wanted to show this pattern to everyone, not because I'm suggesting that it has to play out, because it doesn't have to. Anything can always happen in markets, whether you like it, doesn't really matter. Whether I like it, doesn't matter. The market does not care about your feelings or my feelings. All we can do is be a student to the market and try to learn from it as we grow older, learn from our mistakes. If you don't learn from your mistakes, you're basically just destined to repeat them. So I'm just thinking, hey, if we're sitting here and it's the end of August and Bitcoin is doing pretty good and it just feels like there's no stopping it, I'm gonna be thinking, look guys, every single September we get that pullback to the 20-week SMA. And if that happens, it would likely be scary, not really for Bitcoin, but you know what would be scary for? It'd be scary for the altcoin market. Because I think, notice how Bitcoin keeps moving and altcoins can't seem to do anything? Why is that? Why is it that Ethereum keeps doing well, but altcoins are not? Well, I'm glad you asked. Again, it's because altcoins never went to their range lows, whereas ETH already went home. So arguably the reason you're seeing that altcoin weakness, people keep saying it's manipulation this, manipulation that. That's just a narrative because they got caught on the wrong side of the market, right? They probably would prefer had they stuck with Bitcoin and Ethereum at this point. Instead, they're watching their altcoins just bleed both Bitcoin and Ethereum over the long haul as they scream out manipulation. But I'm telling you, the main reason is not due to that. It's just due to the fact that alts never went down to the lows on their Bitcoin pairs, which I think is going to happen probably, within the next couple of months. You can see in 2017 it actually happened in late October, early November. So I'm still expecting that ultimately to play out. And of course, the reason why Ethereum already has gone through that, the reason why ETH Bitcoin is already doing so well is because, well, Ethereum went home, right? Whereas alts never went to the range lows. So again, that's how I think this is ultimately going to play out. So watch out for that. Again, it's that September pullback that will likely start the process of alts bleeding back to Bitcoin, but it would likely be a potential rally after that September pullback that would then be responsible for the altcoins going lower on their Bitcoin pairs. Again, people always want to know, do alts go down against Bitcoin because Bitcoin's going up or because Bitcoin's going down? And the answer is yes. Right? They go down against Bitcoin no matter the direction of Bitcoin USD. You're probably tired of hearing me say it. That's the way the cycle works. And especially that's the way the cycle works when you're at higher interest rates like we are this cycle. Now, next cycle, maybe it'll play out a little bit differently. Maybe Bitcoin dominance will top sooner next cycle. I actually think that's the most likely scenario for next cycle. But for this cycle, obviously, it was mostly just a Bitcoin-led cycle. And it's just a reminder, as always, that Bitcoin leads the bull market, not the altcoins. And a lot of people spend years yearning for that alt season that only lasts for a few weeks, maybe a few months at most. And then for the rest of the 4 years of the cycle, you basically just see Bitcoin bleed. Again, Bitcoin leads the bull market. After Ethereum goes home, which it did in April, it then joins in. When do altcoins join in? Well, they join in after they go to the range lows on their Bitcoin pairs, which still has not actually happened. So again, I'm not saying altcoins can't go up on their Bitcoin pairs until about late August. They're still likely going to try to catch a bid. But the point that a lot of people are missing is that they're just bleeding to Ethereum during that time. Now they're on about 50% against Ethereum since Ethereum went home. So this is the pattern, right? The pattern that we just talked about. That is the pattern of how all Bitcoin bull markets have ended. Up in July and August, a September pullback, a rally in October, and then you get some type of market cycle top sometime in Q4. That's how it's always happened. Could this time be different? It could be, but sometimes, if it's not broke, why try and fix it? And, the question that I know that I'll see down in the comment section below is, what would make Bitcoin go down in the midterm year? It could be on any number of things, but I really do subscribe to the idea that narrative follows price, not the other way around. So if you just look at the chart, you can see that Bitcoin always does poorly in midterm years, even though it does really well in July and August and then Q4 of post-halving year. So whatever the reason is that if Bitcoin goes up from here, there's going to be a narrative to follow it, whether it be treasury companies, whether it be ETF flows, whether it be, the administration talking about it, right? There's always going to be a narrative to support it. What could be the narrative for next year? I know a lot of people think, it could be a lot of different things, but what I think it might actually be next year could just be, we might find ourselves in a situation where the Fed is just not willing to lower rates as much as the markets really want them to. They'll probably lower rates this year, just like they did last year. But you might get into a situation where they just can't lower them as much as maybe the market would want, and the reason could be that the long end of the yield curve might revolt when that happens, just like last year. And I did a video about this, if anyone's interested, about the real estate market a few days ago. And there's this common misconception that a lot of people have that the Fed cutting rates would then lead to mortgage rates going down. That's not actually true. If you look at mortgage rates, if you look at the 10-year yield, we know that the Fed cut rates for the first time this cycle in September of 2024. And when they cut, the 10-year yield went up, right? It went up a lot. In fact, it rallied from 3.6% to 4.8% while the Fed was cutting rates. And so, if you think about it, if the Fed cuts rates again next month, then there's a decent chance that the 10-year yield rallies again. So maybe that's the narrative. You know, you truly get your higher for longer. And it's one of those things that the Fed's not necessarily going to be able to fix, right? A lot of people think the easy solution is just to lower rates. But it's not so simple, right? If the Fed lowers rates too aggressively, the bond market will revolt and the long end of the yield curve will go higher, making it even more difficult for people to get mortgages. And if that happens, if the Fed lowers, last year the Fed lowered rates and the long end yield curve went up and mortgage rates got more expensive, right? Mortgage rates went up. A lot of people have forgotten about that, right? And now people are saying the same thing again, right? They're saying, all right, lower rates, fix the housing market. I think if the Fed lowers rates again, let's say a couple of times this year and the 10-year yield goes up, then the market might start to, you know, get the memo that you can't just lower rates to fix all our problems, right? You have to have other mechanics. There's a lot of other mechanics at work. And so I think there's going to be some type of complication with that might set up the 2026, the potential 2026 bear market for Bitcoin. But again, that doesn't mean that Bitcoin can't go higher between now and then. It just means that, you know, when you get to next year, just remember, a lot of people are going to be screaming certain things, but there's a good chance that the narrative does change, and it'll likely change if the price of Bitcoin starts going down. But that's not where we are just yet. I think right now we're in that August phase where the market's going to go up in post-halving years. Likely going to see a pullback in September, and then likely that will then lead into the final rally to the market cycle top, if history is any indication. If you guys like the content, make sure you subscribe to the channel, give the video a thumbs up, and check out the sale on Into the Cryptoverse Premium at intothecryptoverse.com. Link is in the description below. I'll see you guys next time. Bye.
That was ultra lame. I totally lost my birthing pod. Oh, I really hate that. I didn't even know what this thing was, and I went in there and lost the birthing pod. Great. Alright, well that's all for today's run. Thanks for watching. Appreciate y'all. Be optimistic. The future is ripe with opportunity. Just enjoy your life. Bitcoin's 121,500. Good games. Peace.